Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 20 minutes until the start of equities trading. And Mark, we've got futures here in Europe pointing to the upside, up by 0.4% on the FTSE 100 futures. We've had a lot to think about, though. US futures look a little bit more range-bound. The Asia session a bit more range-bound. Busy thinking about the Fed and inflation and commodities, but also digesting so much news from the tech sector. It does feel as if we're treading water just a little this morning.
I think that's right. We are treading water, and that is often the way in the session before the FOMC. But the backdrop is it's been a very, very strong earnings season. Stocks are at record highs. They're at record highs for good reason. At the moment, unless there's a catalyst to derail us, the overall backdrop is quite a positive one.
And let's get to that earnings story once again. We need to have another conversation around some earnings reports this morning, and this time it's Deutsche Bank's asset management arm, DWS. It pulled in less client cash than expected in the first quarter. The firm reported €1 billion of net inflows for the period, missing the €4.6 billion estimate. The bulk of the new money went to DWS's passive exchange-traded funds and alternative investments. Buoyant markets helped boost assets under management to a record €820 billion, though. Let's speak now to the CFO of DWS, Claire Peel, who joins us now. Claire, very good to speak to you. So some of the numbers did beat estimates. I'm looking at pre-tax profit numbers and others. Assets under management, as I say, lifted. But what's the story behind the net inflows? It did seem as if this was not what the market was anticipating. Was the market just way off beat, or did something unexpected happen? What's the story behind the net inflows?
Good morning. Hello. Yes, let me come on to the net flow composition, because I do think we have to look through that. But firstly, just to recap, as you pointed out, that we have had a very strong start to 2021 with really positive results in the first quarter, with a near record profit before tax of 249 million, and that's up 39% on last year and up 17% on the prior quarter. And that's really supported by revenue growth and, as you pointed out, a record level of assets under management of 820 billion. So really strong start to the first quarter of 2021 after what was a very unique year, of course, last year. If we look very specifically at the net flow number, in total 1 billion of net inflows, but excluding cash, it's 9.7 billion of net inflows. And so I think the look through of the asset quality and the asset composition of that is quite important to consider. We did see cash outflows in the first quarter as there's a change in investor appetite, and we see a shift going into other asset classes. But in the 9.7 billion, excluding cash, that's again a near record for us in terms of quality of flows. Passives and ETFs continues to be very strong at one side of the barbell, 7.4 billion of inflows there, which was our highest quarter, and compares to 17 billion for the entire of 2020. So a really strong market growing share of ETFs in Europe in our first quarter. And on the other side, alternatives and also some of our active higher margin asset classes also attracting inflows. So I think very important to look at the quality of inflows and how that is supporting us in developing our revenue growth and profitable growth, which is a big key focus for our next stage of our corporate strategy.
Good morning, Claire. I hear you on the quality of flow story, that it's cash outflows and there's inflows into the passive sector that's done very well, and slightly better quality inflows than the outflows that are coming out in cash. But is this going to turn around? In next quarter, are we going to again have an emphasis on quality of flows and it's going to be a disappointing inflows picture, or do we think that there will be better inflows next quarter? Is this going to turn around? Next quarter, are we going to again?
Well, we have a target to deliver a flow rate of greater than 4% of net flows over our medium-term horizon. We're very committed to that, and we're very confident that we'll be able to deliver against it. I think the cash movement that we've seen in Q1 is quite unique, and of course last year we saw cash inflows in the environment that we were operating in, with cash being a safe haven. So I would expect that we would see a continued growth in our flows overall as we go into subsequent quarters this year. And I think the quality of the flows will deliver against the revenue and the top line, which is what we want to very much focus on. Our targeted growth areas are passive and alternatives where we're investing into growth. And we're quite happy that we've seen the returns come through from that in the first quarter by an increasing market share in the passive space and continuing interest in other asset classes with a strong theme around sustainability and around ESG, which another subset of our cut for Q1 was 4 billion of inflows overall. So really we're focused on the products and the asset classes within that.
Yes, so let me ask you a little bit more about which types of products investors have appetite for then, Claire, because you've mentioned passives and alternatives. I wonder what kind of alternative assets are we talking about here, or which kinds of passives? Can you give us any more granularity?
Asset classes within that. Yeah, so maybe on the alternative side, in the first quarter, we've seen inflows in infrastructure assets, in real estate, and in liquid real assets as well. So really across the suite of products that we offer. We have a subsequent launch coming up in our infrastructure funds for the remainder of this year. We've seen that grow quite steadily in previous quarters, and real estate continues to be a very popular investment area. So we have a suite of innovations coming on that front. On the passive side, again, I think continued product delivery and product innovation is very important to really meet client demands in this evolving environment. And the ESG and sustainable side is where we're finding ESG equivalents in the passive suite as we launch those each quarter. Product delivery and product innovation is very important.
When it comes to competition in the ETF provision market, where you've been quite dominant in recent years, how does Amundi's purchase of Lixor kind of change your strategy in terms of the competition there?
As we launch those each quarter. I don't think it changes our strategy in terms of continuing to meet client demand and continuing to focus on net flows. So we've had a record first quarter inflows, beating really where we stood at the end of last year as well. So we will continue to focus on growing market share. Positioning may get shifted as different collaborations take place, but I think when it comes to attracting cash and attracting inflows into ETFs and maintaining a good suite of products that meet client demands, it's product innovation that we'll be very focused on and really monitoring our market share of flows.
So focus on product and innovation, Claire. Maybe also focus on M&A. We understand you're looking for a transformational deal. Can you give us your thoughts on how much support you're getting in pursuit of that deal from Deutsche Bank, 80% shareholder, of course, in your business? How supportive is Deutsche Bank of this effort? And what kind of assets are you going to be looking for? Is this all about upsizing, scaling up in Asia? Can you give us your thoughts on how much support you're getting?
Yeah, so when it comes to M&A, we've always said first and foremost, we will, of course, focus on our own organic growth. We are investing into growth this year, so that will always come first. And I think that's demonstrated in our results this quarter, is paying off. So that's first. But we are very focused on inorganic growth. There is mergers and acquisitions taking place, consolidation in the industry around us. We observe that very, very closely. But we are very protective over what we have today, and we will only engage in a transaction which we feel can deliver us incremental scale, incremental distribution channels, or add to the product range that we have today, which of course is already very diversified. Asia and China is very much of interest to us. We see China, of course, having significant growth over the medium-term horizon, and that will be an area of focus and attention for us.
Claire, thanks very much. Thanks for joining us. Claire Peel, the CFO of DWS. Thanks very much for coming to speak to us on the European Market Open. Let's get an update on some of the top stories we're covering this morning with the Bloomberg First Word News Update. Here's Laura Rice.
Thanks, Anna. The European Commission wants the power to levy fines or block deals by foreign state-owned companies. The proposed rules obtained by Bloomberg seek to answer complaints from European businesses that Chinese state-backed firms get support they cannot match. Chinese business groups have already complained about the draft, which could change before it's set to be proposed next week. Sources tell Bloomberg that President Biden isn't planning to increase the estate tax as part of his tax hike plan. During the 2020 campaign, the president pledged to increase the estate tax along with capital gains and corporate income taxes. Still, his plan will end a major benefit for wealthy estates that reduces the tax. It's time to get back to the office if you're not already there. That's the message from Wall Street titan Jamie Dimon. JP Morgan is the first major US bank to tell its staff they'll need to be back in about 2 months. It says by early July, all US employees will be in the office on a rotating schedule. There will be a 50% staff cap until social distancing rules are relaxed. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Mark, Anna.
Laura, thanks very much. Interesting to keep track of the return to office story. Coming up here on the European Market Open, we'll look at your stocks we're watching. We were spoilt for choice this morning. We will keep an eye on Deutsche Bank as the German lender posts its strongest quarter in 7 years. Lots to talk about then. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know.
Wednesday, the Fed decides. The Fed is on hold waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television. Wednesday, the Fed decides. The Fed is on hold waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed.
Welcome back to the European Market Open. 7 minutes until the start of cash equities trading for this Wednesday morning. Let's get the stocks we're watching. Danny Berger has had to cut down a very long list to just 3. Danny.
That's right, Anna. Well, in general, I should say that the banks that have reported today had some very strong numbers. So I've just pulled out 2 for us. That's Lloyd's and Deutsche Bank. Deutsche Bank, their FIC numbers, I mean, absolutely blowing it out of the water, coming in at a 34% rise. That compares with an average 17% rise for the rest of Wall Street. But they did caution in an interview with Bloomberg that the gains might be slow. This might not be repeatable in the second quarter. Lloyd's, of course, this one's much more dependent on the UK economy, but also beat for them, helped by some impairment credits. It improved its outlook, says that it's going to have a progressive and sustainable ordinary dividend, so that should certainly help out share prices. Finally, WPP, I know you're speaking with them later, and I just say advertising is back. This is a good sign for just companies in general, that they're spending. The question is going to be, how do they keep up with the change to digital advertising in the realm where we have this dominated by big tech giants?
Yeah, absolutely. A lot of fast-changing parts, aren't there, when it comes to advertising and the tools that advertisers and those businesses that serve them have at their disposal, the amount of data they have from big tech. Danny, thanks very much for joining us, our markets reporter, Danny Berger. Of course, and as Danny said, I'm going to be speaking to the CEO of WPP a little bit later on. Mark Reed will be joining us for an interview at 8:30 a.m. UK time. So it's earnings here, Mark, and it's easy to get lost in the detail. And the detail can be fascinating, and the detail can move share prices and make and lose fortunes, of course. But when it comes to the big macro pictures, give us your wise words on what you're looking at ahead of the European Market Open. So it's earnings here.
Well, the big story is inflation. It is particularly in this quarter or this 6 months. But with FOMC tonight, that's an extra focus. And these earnings stories are all playing into that. Most of the CEOs and CFOs we're talking to are talking about producer price pressures. And that shows that this inflation will be probably a bigger scare than the FOMC is flagging right now. It doesn't mean it'll be sustainable, but it'll certainly be a big scare in the next couple of months. And that's what we're focused on.
Yeah, plenty of focus on that inflation story then and the various threads that lead in that direction, whether it's soft commodities or metals. Lots to talk about there. Mark, thank you very much for spending the past hour with us. I'll be back with the European market open next. Futures pointing a little bit higher here in Europe, perhaps a little bit of catch-up necessary with the US yesterday. Euro Stoxx 50 futures up by 0.4%. US futures a little more mixed, fairly flat this hour. This is Bloomberg. I'll be back with the European market open next. Futures pointing a little bit higher here in Europe, perhaps a little bit of catch-up necessary with the US yesterday. Euro Stoxx 50 futures up by 0.4%. US futures a little more mixed, fairly flat this hour. This is
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts. Visit bso.org/now, where the music.
Welcome back to the European Market Open. A minute to go until the start of cash equities trading for this Wednesday morning. Here are your headlines. Deutsche Bank's big beat. The lender posted its strongest quarter since 2014, boosted by its trading unit. It is Fed Day. Investors look out for Jay Powell's views on inflation and the accelerating recovery from the pandemic in the United States. And Alphabet revenue smashes estimates and buyback plans boost the stock after hours. Microsoft also beats the street, but not enough for investors. It is Fed Day. Welcome to the second hour of the European Market Open, everybody. We've got 40 seconds or so to go, 20 seconds, sorry, to go until the start of the European Equity Trading Day. And this is what the futures outlook looks like right now. So futures are suggesting we'll be a little bit higher, perhaps some of the gains coming through on the London market. The FTSE 100 seen up by 0.4%. The fate of the banking sector, big pharma, and no doubt commodities prices could have something to do with that. So as we get these European equity markets opening up, we're thinking about all of the earnings stories we've had this morning. We've had plenty of earnings news out from companies in all corners of Europe, essentially. We've been from Spain to the UK to Germany through the earnings releases so far this morning that I can just think of off the top of my head. There have been plenty of them. The stock 600 here in Europe fairly flat this morning. The FTSE 100 then opening to the upside, up around 0.3%. The IBEX up by 0.2%. The CAC 40 in Paris up by 0.3%. So the stock 600 jumps a little as we get more of these markets opening to the upside here across Europe. We'll be focused in on the banking sector to see if we get any response to those numbers from Deutsche Bank, Lloyds, Santander. Some fairly positive stories in general being told by the banking sector this morning. We'll also look for any read across from higher yields. We have had that as part of the narrative over the last 24 hours, certainly the US 10-year a little bit higher. So all of that in focus this morning. Let's get to our first markets conversation of this hour then. European equity markets, as I say, opening to the upside. Bond yields are rising again as markets look ahead to updates on government and central bank stimulus. That's as President Biden is set to address Congress, and the Fed is giving its policy statement later today. Investors will be looking out for Fed Chair Powell's views on inflation and for any signs of the central bank pulling back on asset purchases as the economy gathers strength. Let's bring into the conversation Yuko Takano, Newton Investment Management Global Equities Portfolio Manager, who joins us this morning. Yuko, very good to speak to you here on Bloomberg TV. Let me ask you about the rising yield environment, and then we'll come to some of the earnings stories this morning. Yields on the US 10-year, 1.63% right now. We did see some upward movement in yields, some selling of bonds in yesterday's session. Is this a sign of something to come, something that's going to threaten equities, do you think, a higher yield environment?
I think definitely we saw that kind of scare in Q1 of this year already. And then it kind of was a bit subdued over the past month or so. So I can definitely expect an environment where investors do have incorporated the fact that, yields are going to continue to go up with the, stronger economy post-COVID recovery. So in that sense, yes, it's definitely something that we're concerned about. It impacts all of the discount rates on the equities that we own in our portfolios. So definitely something to think about. Having said that, I am not really sure how much higher yields can go up from this point onwards. So I would say much of that is already baked into the stock market.
Yeah, that's interesting because some people suggest to us, if you think yields are going to go higher, if you think we're going to see more of that reflation trade that we talked about earlier this year, Yuko, then you want to consider owning bank stocks. But I see from your notes that you're underweight bank stocks. Is that because you don't see the reflation trade playing out much further from here? If you think yields are going to go higher, if you think we're going to see more
so we've always been structurally underweight banks, but we have increased our bank exposures slightly over the past couple of months due to this, possibility of a reflation trade. I do think in the long run that there are other sectors that are or continue to be more attractive. We're a very highly concentrated portfolio and we're bottoms up stock pickers. So in that sense, I would say that, we don't feel uncomfortable not being super bullish on the banks.
Okay, and as bottom-up stock pickers, Yuko, you look at the earnings season, you comb through the earnings reports from the companies that you own, that you have in your global equities portfolios. What has impressed you? What has stood out as a surprise to the upside then from some of the companies that you follow?
I would say, like you saw in the earnings announcements yesterday, I think tech continues to be an area of resilience, and that, partially has to do with the fact that they are very resilient businesses in nature, and they're very asset light and IP heavy. I also think that, they will continue to benefit as, economic activity overall continues to surge post-COVID, and you can see that in the Alphabet earnings from yesterday.
Yeah, we'll certainly dig further into your thoughts on tech in just a moment, Yuko. Another sector that's front and centre these days is anything to do with commodities. And I want to think about, one of the themes that you like to invest around is EVs, electric vehicles, and copper and other commodities needed in the production of electric vehicles have been doing good business of late. Yuko, do you see that continuing? Do you see that commodities drive higher as something that you want to follow?
That's a really good question. So in our portfolios, we don't invest directly in commodities, and we don't really invest much, to be honest, in the mining sector. We think that the EV angle can be played through a lot of the parts manufacturers, like battery manufacturers, because they do play directly onto the theme, and we do feel like that's a more comfortable way for us to invest.
Yuko, thanks very much. Stay with us. Yuko Takano, Newton Investment Management Global Equities Portfolio Manager. She's going to stay with us as we bring you our next conversation with another company CFO. Then we'll get more from Yuko a little bit later in the programme. Coming up here on the European Market Open, we'll focus in on pharma. We'll talk to the CFO of Sanofi about the drug maker's earnings and its latest efforts to develop a coronavirus vaccine. They're still trying to develop that. We'll ask, what is the expectation from that project? This is Bloomberg. Coming up here on the European Market Open, we'll focus in on pharma. We'll talk to the CFO of Sanofi about the drug maker's earnings and its latest efforts to develop a coronavirus vaccine. They're still trying to develop that. We'll ask, what is the expectation from that project? This is
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Hear from leading economists. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. Just 9 minutes into our session this Wednesday morning, European equity markets fairly flat actually on the stocks Europe as a whole, but we do see some moves to the upside from some of the larger equity markets on your screen. Now let's turn to the pharmaceuticals industry. Sanofi's first quarter earnings beat estimates, boosted by demand for its blockbuster treatment for eczema. The French drug maker's COVID vaccine development has lagged some of its peers. It expects results from the phase 2 study from one candidate next month. months. We're joined now by the CFO of Sanofi, Jean-Baptiste Chatillon. Jean-Baptiste, really nice to speak to you. Thanks for joining us here on Bloomberg TV. Let me start by talking about the earnings, and then we'll move on to talk about COVID a little. So the EPS numbers coming in well ahead of expectations, but you've confirmed your outlook. Is there a sense that there's risk to the upside for Sanofi later in the year?
You're right, we have a great quarter, and we enjoy something which is new in Sanofi, which is a sustainable growth. After 2019, 7.2% upside on the EPS, 9.2 in 2020. Now we are delivering 15% on this first quarter, 9.8 without one-off. It's a great trend. It's a great trend in Sanofi. And it's also a great opportunity this quarter to present our maturing pipeline with priority asset, RSV, which has shown in phase 3 that it was meeting its endpoints. So two great news for Sanofi and for patients in this first quarter. Growth on pipeline, which is going in the right direction with a huge unmet need, which is RSV.
Let me ask you about pipeline development, Jean-Baptiste, because some other pharmaceutical companies have talked about delays in clinical trials and therefore in pipeline development because of COVID-19, because of health systems, entire health systems being entirely distracted over the past year by dealing with something else. Is this something that's going to weigh on pipeline development in the future?
It might be for the industry, but honestly, in Sanofi, great job from all the teams all over the world, and we are holding our pipeline development in a very good shape. And by the way, RSV is not late, is ahead of time. We are effectively beating the expectations on the development of this new drug. So good news from that front. The teams are improving their game in terms of digital, and they are really delivering incredibly. And the pipeline is there and will not be late.
Jean-Baptiste, you're working on two COVID vaccine candidates at the moment. They're in clinical trials. You've given an update today on the timing. You're also helping in the production efforts behind, I think, 3 of the vaccines that are currently on the market and approved in various locations. Why do we need another vaccine? Would it be better for your business or indeed for humanity to focus on higher levels of production of the existing vaccines that are already approved?
That's a great point. I think Sanofi is the only pharma actor who is going to contribute to improve the worldwide capacity for the 3 leading vaccines which are available right now with BioNTech, with Pfizer, and with Moderna. We just announced it yesterday. So we are strongly committed to fight this pandemic in Sanofi. And of course, this will not change the course of our 2 internal candidates, because our teams are working extra hours, they are pushing the walls to make this capacity available. But at the same time, when we see how the pandemic is unfolding in terms of variants, in terms of maybe being there for several years, society, the US BARDA is really asking us to go on working on our 2 candidates. That's what we're doing, and we think they could be very useful in the years to come.
Yes. Is the work that you're doing on these COVID vaccines, though, is it focused on the original version or the original variant of COVID-19 that emerged in China, or will it stand up to the various variants? Because others in the sector, of course, are moving their products on to try and tackle some of the newly emerging variants. How will your vaccine take on those?
Yeah, so the current development are, of course, on the first strain, but we have in the preclinic, we are, of course, putting on the bench and starting to work in our labs preclinically on the new variants. So, of course, it will be part of of the developments we will pursue.
And back to the other products that you make, Jean-Baptiste, at Sanofi. Some critics might question whether your business is too reliant on one particular medicine, on Dupixent. Is that a criticism you hear from shareholders? Is this something you're thinking about?
Yeah, that's an interesting point, because Dupixent is effectively a miracle drug, and with a high safety profile, high efficacy profile. But it's just the beginning of the story of this incredible drug, which will reach, we think, above 10 billion peak sales, and that's just the very beginning of the story. It's not just one drug. It's a drug which addresses multiple diseases, like you mentioned asthma earlier on, but of course it's atopic dermatitis, nasal polyposis, and we are developing it in many other diseases where unmet needs are very strong, for instance, in COPD. So it's just the beginning for Dupixent. And we are not worried, and well, not questioned yet, as I said, it's very early in the cycle, but also because in our pipeline, currently in our priority assets, we have many blockbuster potential. I mentioned RSV, it's a huge unmet need, and one of the first reasons for hospitalization of children, but we also have many other assets in oncology, like our third, or I could mention in MS, tolebrutinib, which is being developed in multiple phase 3 by Sanofi. So the fact that in Play to Win, the strategy initiated by our CEO, Paul Hudson, we are really focusing on very specific areas, but only with blockbuster potential.
Okay, Jean-Baptiste, thanks very much for your time. Jean-Baptiste Chatillon, the CFO of Sanofi, giving us an update on the earnings this morning, but also on the COVID fight, of course. Let me just bring you some other news lines that are just crossing the Bloomberg. The EU Parliament has backed the UK trade deal, concluding the Brexit process. So these headlines just crossing in the last few minutes or so. This, of course, means that the EU Parliament has voted in favour of the arrangements that essentially came in on January the 1st. So they've been in place for a while. The EU Parliament took some time to consider the details, because they were, of course, reached, the agreement was reached very hurriedly, if you like, or quickly before the deadline, around the December-January period, or just before January the 1st. There are still ongoing conversations about the Northern Ireland Protocol, but broadly, in the main, the EU Parliament has backed the UK trade deal, concluding the Brexit process 6 years after that Brexit vote. Let's take a look at some of the stocks that are on the move then this morning. For that, here's Bloomberg's Danny Berger.
Anna, I just want to concentrate on one theme that really seems to have captured the market, and that's bank earnings. Now, something really interesting is going on here, because we've seen with earnings that beats haven't done that much to move the dial in terms of gains really across the equity market, but it is doing that for banks, so perhaps expectations were lower for the sector. So Lloyd's, one of the best performers, seeing a beat on their earnings, also talking about resuming dividends, so that's surely a good sign. Over in Germany, Deutsche Bank, an absolutely blockbuster earnings. They reported FIC trading that was 34% higher. That compares to 17% on Wall Street. So that's one of the biggest gainers as well, up 6%. And as my next stock, I also brought up Commerce Bank. It doesn't have earnings, but it's rising in sympathy with Deutsche Bank and really the other bank earnings. If you look at the Stock 600 Bank Index, every single stock, it has 40 members, is moving higher, save for 3. So BBVA, Barclays, NatWest, whether they're UK specific or more international, they're all seeming to get a bid today with these solid earnings. Now, if banks is one theme, the other theme in the markets today, but perhaps more macro, is what's going on with commodities. Finally, they're getting a break from all of those gains. So up here, I have iron ore, I have wheat, I have copper as well. We're looking at wheat, for example, falling from an 8-year high, copper falling from its highest since 2011. Now, Goldman Sachs thinks that these commodity gains can continue, but at least for today, perhaps a little bit of a breather from those inflationary scares with commodity prices moving higher, Anna.
Yeah, interesting stuff, Danny. Yeah, Basic Resources stocks fairly flat today, taking a pause from what we've seen has been a really strong move to the upside in commodities prices. Thanks to Danny for that. Bank stocks, the biggest gaining sector across Europe, up by just over 1% for the sector as a whole this morning. Coming up on the programme, Google parents Alphabet's first quarter revenue has smashed estimates. We'll discuss the US tech sector next. This is Bloomberg. Move to the upside in commodities prices. Thanks to Danny for that. Bank stocks, the biggest gaining sector across
now about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Welcome back to the European Market Open. 21 minutes into our European trading session, and stocks fairly flat at the aggregate level. You see some movements to the upside in some of Europe's largest markets, though. The banking sector certainly doing very well this morning, as we were hearing from Danny in the last part of the program. Let's turn to another sector, and that is technology and tech earnings. Google has seen a surge in ad sales. That's as businesses look to capitalize on the economy reopening. Google's parent company, Alphabet, reported earnings that topped estimates. The firm also unveiled a $50 billion buyback. The shares rose in late trading. We're joined still by Yuko Takano, Newton Investment Management Global Equities Portfolio Manager. Yuko, thank you very much for joining us once again. Let me ask you about your thoughts on technology. Regulatory threat to the technology sector seems to be something that's often on people's minds. Is that something that puts you off? We're joined still by Yuko Takano, Newton Investment Management Global.
Yes and no. So I think that for the big tech names, each case is different in terms of what types of regulatory implications there are. So in the short term, obviously, as news comes out, this is a big concern for us, and we continue to monitor the situation quite closely. Having said that, I think that there's antitrust laws there for a reason. I think that anything that kind of promotes innovation, promotes more competition, is great for, firstly for the overall economy, but also for the companies themselves. And you've seen time and time again in the past where history repeats itself, and either companies are broken up or are forced to spin off some of their entities, and that enables them to actually focus even more on their capital allocation, which is actually better in the long run for these companies. So it's not just all bad news. I think that there will be some positives that come out of this as well.
It's interesting to see in the specifics around Google parent Alphabet and the earnings story there, or where the boost came from in the first quarter. There's a lot of reference to advertisers advertising for travel and leisure and things that we haven't been able to do.
Yes.
And I suppose that's just a nice reminder, isn't it, Yuko, that we shouldn't think of the tech sector as monolithic. We shouldn't think of it as all, it's not all Amazon. It isn't all sending stuff to your home that you can't go out and get. There are going to be some tech businesses that will manage to navigate lockdown and also reopening.
I mean, exactly like you say, I think that's a really, really good point. I think that, the reason why some of these companies are very attractive is because, A, they're very highly resilient businesses, but B, also because they're very asset light and IP heavy. That for us as investors means that it's got really high return on invested capital, which is all very positive. But at the same time, it enables the companies to be very nimble and very cash rich. And I think all of these factors combined makes them very strong businesses.
We spoke to a pharmaceuticals business in between our conversations, or I spoke to a pharmaceuticals business in between our conversations, Yuko, this morning. And that makes me think of some of the long-term thinking you've been doing around healthcare and around life longevity. How investable is this as a theme? Where are you seeing money going that looks promising with investment returns in terms of fighting some of the diseases away from COVID-19 that we need to be fighting over the next decade?
Yes. So we have a future of life fund that invests in the longevity theme, and we're very, very positive about the sector and about the theme. So longevity is not just about the healthcare sector. Obviously, there's a lot of innovation going on in terms of pharmaceutical innovation. There's like Alzheimer's is one really big area. Diabetes is another one. Those are very obvious places that we can invest in. But at the same time, there's other elements within longevity that we find very attractive. For example, the prevention side of things. and prevention can include, pharmaceutical interventions, but it also has a lot to do with lifestyle and managing your diet. So we're definitely interested in the nutrition side of things. The other thing that we're really focused on when it comes to longevity is the area that, the elderly like to spend in. So things like home improvement or, hopefully travel when travel comes back.
Yeah. Yes, when travel does come back. And I really wanted to ask you about food innovation, Yuko, but no time today. Another time. Thank you so much for joining us. Yuko Takano, Newton Investment Management Global Equities Portfolio Manager. Yuko will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Coming up, we speak to the CEO of WPP. Mark Reed joins us to talk about the organic sales numbers that came in better than anticipated for this business. Fast-changing environment, though. We'll talk about that. This is Bloomberg.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day. This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar. This rally just keeps on going. But there is a tipping point.
Welcome back to the European Market Open. Half an hour into our European trading day here in Europe. And this is the picture for you. We have the Stocks Europe 600 fairly flat overall. And that doesn't seem to make sense when you look at what's going on the larger markets. But the AEX is actually in negative territory, weighed down by the payments business, Adyen, ASML in the tech space, also to the downside in the Netherlands. And so that's partly what's driving that Stocks 600 move to the downside. So that's the picture in terms of those overall markets. Let's get to the GRI. You can see from the sector breakdown that we do have banks to the upside. Danny Berger was taking us through some of the individual corporate reports we've had from the likes of Deutsche Bank this morning that have helped to lift that sector, and other names not reporting but rising in sympathy. So the banking sector moves to the upside today. To the downside, travel and leisure under pressure a little bit in today's session. Now, the advertising giant WPP's sales are bouncing back. That's as global brands restore marketing budgets they'd cut during the pandemic in an effort to get consumers spending again. Joining us now is Mark Reed, the CEO of WPP. Mark, very good to speak to you. So your organic sales number coming market, what is it that has been going so well? Let's start there.
Yeah, we came in at 3.1% and the consensus actually was down about 1.5%. We've seen a pretty broad-based recovery, across. We saw growth in 15 of our top 20 markets. And I think, as you said, I think clients are seeing a bounce back in consumer confidence or growing consumer confidence. They're looking through the current level of restrictions to, really a very strong economic recovery in 2021. Now, there's no doubt that parts of our business, retail still down 4.5%, travel and leisure down 35% still in the first quarter. So there are parts of the economy where client confidence is not there, but I do think we'll see that come back pretty strongly as we go through the year.
You have not boosted your guidance, though, for the overall year, Mark, today, and you've also cautioned that there's still a high degree of uncertainty going forward. What is it exactly that you're uncertain about or cautious about? I know we've come through a pandemic, so there's been a lot of uncertainty, but what is it about the recovery that leaves you uncertain?
Well, look, I think that we gave quite a broad range of guidance. We said mid-single digit, and I think we're holding that, though. I think we will expect to be, closer to the upper end of that than perhaps we would have done back in December when we gave the guidance. But there's no doubt that it's really, I think the direction of travel is very clear. It's upward, but the pace of recovery in certain markets is slow. There's a terrible situation going on in India at the moment, and talking to our India country manager, really severe lockdown there and impact on people. Western continental Europe, the recovery is probably somewhat slower than it has been here in the UK. I mean, the UK came back 4% in Q1, which, despite the restrictions, is a pretty strong growth. So I think it's really more about the pace and the speed than it is about the direction of travel.
You mentioned various sectors and how they performed in the first quarter. You said travel and leisure was still down for you, Mark. I was looking at the Google results, though, overnight. They showed a surge in ad sales related to travel and also to retail. Does this just reflect a difference in timing across the Atlantic? Is the US just ahead on that recovery?
Yeah, probably the US is a little bit ahead in terms of travel. I think the other thing is that much of our work is in brand building for travel companies, and that's probably going to take something of a backseat in the short term to measures that really drive sales, where Google will naturally benefit. But as you say, I mean, they had an amazing result, up I think a third in their ad sales business. Really strong growth at YouTube overall, and that I think reflects the shift into digital media. We saw the same thing in our business. E-commerce sales up 50%. Spending through connected television up 90%, much growth in digital media. So I think that in those parts of the media mix, where we work with Google and Facebook and Amazon, we are seeing strong growth as well.
Yes, let me ask you about working with some of those big tech giants. Google and Apple killing the ad cookie is the headline I read this morning. It's becoming harder, perhaps, for some of that data that marketers love to use to get hold of some of that. But some of that perhaps plays to your strengths. Maybe that benefits you. I wonder what kind of new advice and services you're giving to clients as a result of this disruption amongst these big tech firms.
Yeah, look, I think there's no doubt that the cookie allowed a degree of tracking in an online world that we'd never have allowed offline. So I think that moving to a greater degree of privacy for the consumer is the right thing to do, and in the long run, it will benefit our clients. And certainly, clients are turning to us. We launched a new unit, Choreograph, bringing our data capabilities together to advise clients in a privacy-first world how they can use their data responsibly and with consumer permission. And I think in the long run, it's the right thing to do. In the short term, it may be a little bit painful. I don't think it's going to change the shift of ad dollars into digital media, though, in any way.
Let me ask you about your stock price, and I know most CEOs will tell me, and I'm sure you'll also echo these thoughts, Mark, that you manage the business for the long term and not with a focus on day-to-day share price moves. But thinking about longer-term share price performance, the stock price has risen slower maybe than peers this year. What are you doing at the business to try and close that gap?
Well, look, I think, as you say, we are focused on the long term, and we try not to look at the share price every day. We've had a pretty strong recovery since the nadir of last year. I think our share price has doubled. So I think it's really, perhaps the further you fall, the more you have to rise. So, but as you say, we're focused on the business and really creating long-term shareholder value, and the investments that we're making today in creativity and technology designed to get us there.
We've been thinking a lot about inflation over recent weeks here at Bloomberg TV. Mark, I talk a lot to people about inflation and the drivers of it. I wonder what kind of pricing power you have in your business, you're seeing in your industry, given the difficult times of 2020 and the recovery now.
I think we do have stronger pricing power, if that's the right phrase, in the digital parts of our business where, demand is strong. Now, I think inflation, anecdotally, has always been seen as good for the advertising business. We'll have to see what that is. But the main thing is, can we invest in those new areas of our business? Because I think that's where we have the opportunity to differentiate what we're doing. WPP was named by Forrest as a leader in e-commerce services recently, and that's a massively growing area of demand from our clients as they shift to seek their sales online.
Mark, thanks very much. Really good to speak to you. Thanks very much for joining us. Mark Reed, the CEO of WPP. Let's get a focus on some of the big stories we're covering here at Bloomberg this morning. A Bloomberg First Word News update. Here's Laura.
Thanks, Anna. The European Commission wants the power to levy fines or block deals by foreign state-owned companies. The proposed rules obtained by Bloomberg seek to answer complaints from European businesses that Chinese state-backed firms get support they cannot match. Chinese business groups have already complained about the draft, which could change before it's set to be proposed next week. Sources tell Bloomberg that President Biden isn't planning to increase the estate tax as part of his tax hike plan. During the 2020 campaign, the president pledged to increase the estate tax along with capital gains and corporate income taxes. Still, his plan will end a major benefit for wealthy estates that reduces the tax. It's time to get back to the office. That's the message from Wall Street titan Jamie Dimon. JP Morgan is the first major US bank to tell its staff they'll need to be back in about 2 months. It says by early July, all US employees will be in the office on a rotating schedule. There will be a 50% staff cap, though, until social distancing rules are relaxed. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Coming up on the programme, the future of London. 6.2 million voters decide the next mayor on the 6th of May. Today at 11 a.m, I'll be hosting a debate between Sean Bailey, Sian Berry, Sadiq Khan and Louisa Porritt as they compete to become the city's next leader. We'll discuss their plans for crime, transport, housing and the reopening post-pandemic, hosted by Bloomberg and London First. Hear it on London DAB and on your Bloomberg terminal on Live Go. They are not the only candidates, of course, standing in this. We have a full list of candidates for London's mayor. They can be found on the London Elects website, londonelects.org.uk. This is Bloomberg. Laura Wright here in London. Coming up on the programme, the future of London. 6.2 million voters decide the next mayor on the 6th of May. Today at 11 a.m, I'll be hosting a debate between Sean Bailey, Sian Berry, Sadiq Khan and Louisa Porritt as they compete to become the city's next leader. We'll discuss their plans for crime, transport, housing and the reopening post-pandemic, hosted by Bloomberg and London First. Here is on London DAB and on Bloomberg terminal on Live Go. They are not the only candidates, of course, standing in this. We have a full list of candidates for London's mayor. They can be found on the London Elects website, londonelects.org.uk. This is
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday.
We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
It's our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I can do as a leader of this organization.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
Those were some of the world leaders and top executives gathering for the Bloomberg Green Summit, a virtual event focusing on the core issues of climate change. Some really interesting thoughts in that collection for you. Now, the Biden administration has pledged to cut emissions by 50% as the country rejoins global climate efforts. However, while governments announced such ambitious targets, my next guest says that in order for investors to get it right, the focus on decarbonisation must be examined from a total portfolio level. Joining us now is Jennifer Wu, JP Morgan Asset Management's Global Head of Sustainable Investing. Jennifer, very good to speak to you once again. So we'll come to that whole portfolio point in just a moment. I just wanted to reflect on how much more engagement you're seeing from corporates as a result of the new stance from a new U.S. administration. What difference has that made to the conversations that you're having?
Yeah, no, thank you for having me here. So I think it has certainly made a huge difference in our conversation with companies, with now not only the U.S. but other countries renewing their commitments and actually setting pretty ambitious targets by 2030, as well as aiming to be carbon neutral or net zero aligned by 2050 or 2060. So I think it's sufficient to say that the race to zero has indeed started. And what's really quite different this time is how, like what we're seeing in Europe, right, with the UK government actually enshrining these commitments and plans by setting up laws. So we're really hoping to see a paradigm shift in how companies should be planning CapEx for the next 3, 5, and 10 years from now. And I think the other thing that's also important is that we're also starting to see companies in some of those hard-to-abate sectors that are also carbon intensive, such as aviation, shipping, and industrials, starting to have conversations around how to decarbonize their business operations, right? And these are, as you would know, sectors that really require innovations in technology. So again, government plays a very critical role here in providing incentives for those to be developed. I think at the end of the day, from an investor standpoint, actions are critical, right? Governments have set these targets, but how do we actually get there? What legislations are they going to be introduced is going to be critical.
When I talk to some airlines, Jennifer, not all, but some airlines focus on the per passenger sort of levels of pollution that are created and focus on the energy efficiency of their aircraft. Is that going to be the full story when it comes to that kind of industry, or are we going to be talking about reducing carbon emissions by some other metric?
Sectors that really require innovations in technology. I think we need all different kinds of measures to actually get to some of these targets that governments are setting. So, right, the concept of polluters pay is going to dominate how the economy is going to develop over the course of the next 10 years, right? This is not a concept that's going to go away. And then in addition to that, the whole race to developing greener and cleaner technologies will also have to come into play, because otherwise it's going to be very difficult for us to actually get to net zero, right? Putting a price on carbon is one thing, which will provide incentives for consumers as well as corporates to become more efficient and potentially travel less, if you like. But at the end of the day, to really remove emissions or drastically reduce what's in the atmosphere requires better technology, right? We need to reduce the actual emissions by way of, employing different kinds of technologies in the aviation sectors, by potentially, switching to alternative fuels, not in the near term because the technology is not necessarily ready yet, but definitely over the course of the next 10 years, so such that we can actually get to a, say, 55% of reduction or even more by 2030.
Yeah, and this is a good example of an industry that will need old-fashioned fuels, if we can call them that, hydrocarbons, into the future, certainly in the short term, Jennifer, as we try to transition and try to find alternatives. How have we progressed in our understanding of the possibility of assets becoming stranded, though? Because whilst there will still be demand for those older technologies, there is a tendency amongst many asset managers to try to avoid things that don't do well on an ESG score. So how do we understand stranded assets at this point, and what kind of funding is going to be available to those kinds of sectors?
Yeah, I think it's a really good question. I think the most important message to take away for investors is that corporations are actually going to react very quickly to these legislations, and many of them have already started doing so. So the incorporation of the transition to a net zero economy has to be front and center for us as we think about ESG broadly, right? So the way I think about it is that in the past few years, we say ESG is everything, but climate needs to be everything now. And the hard work is really ahead of us, because companies are trying to figure out how to decarbonize their operations. We also need to look at, to your point, stranded assets and a pathway to total portfolio view. It's really challenging, because if we look at very near term, say in the next 10 years even, the reality is the projection for global GDP is still continue to grow, and some of the largest emitters in the world, like China, for example, who consumes more coal than any other countries, their commitment is to get to peak emissions by 2030. Right? That's what that means is that overall emission is likely going to be on the rise in the next 10 years as well. So from a pure corporate standpoint, what you're looking at is if you're an oil and gas company, it's good business, right? If I look at the very near term, because economy still needs oil and gas as fuel to really make sure that we can continue to manufacture and produce in the way that we want. So I think what's required is legislation, right? Put a price on carbon is going to be critical, and I think that's what COP26 should really be focusing on, right? And then also, more importantly, how do the countries collaborate so we don't go back to the old way of developed markets starting to export, although they can't really do that now, carbon-intensive industries to less developed world, which really is not going to create a net negative impact on carbon emission by 2030.
Yes, trying to avoid a situation, I suppose, then of regulatory arbitrage. Jennifer, thank you very much. Thanks for joining us. Good to speak to you this morning. Jennifer Wu, JP Morgan Asset Management's Global Head of Sustainable Investing. No doubt more from Jennifer as we head towards the COP meeting later on this year. Let's get a Bloomberg Business Flash. The top corporate stories we're covering this morning. Here's Laura.
Thanks, Anna. Starbucks global growth fell short of expectations. Gains were expected across all regions after the weakness of last year's lockdowns, but global same-store sales only increased 15%. That's overshadowing a rebound in the coffee giant's key markets outside of the US and China. Deutsche Bank has seen its best quarter in 7 years. The German lender is raising its outlook after fixed income traders outperformed most of their Wall Street peers. Deutsche Bank also dodged losses from the collapse of Archegos Capital Management. Santander's had a boost in its bid to restore profitability eroded during the pandemic. The bank saw its US earnings jump while booking lower costs and charges. Underlying profit jumped to the best results since the second quarter of 2010. Santander is shedding thousands of jobs in Spain and shutting a fifth of its UK branches. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London. Coming up on the programme, Wall Street prepares its return to the office. Jamie Dimon becomes the first executive to bring his US employees back into the building. We discuss that next. We'll get the latest. This is Bloomberg.
Most of their Wall Street peers. Deutsche Bank also dodged losses from the collapse of Archegos Capital Management. Santander's had a boost in its bid to restore profitability eroded during the pandemic. The bank saw its US earnings jump while booking lower costs and charges. Underlying profit jumped to the best results since the second quarter of 2010. Santander is shedding thousands of jobs in Spain and shutting a fifth of its UK branches. Bloomberg Business Flash.
Laura, thank you. Laura Wright here in London. Coming up on the programme, Wall Street prepares its return to the office. Jamie Dimon becomes the first executive to bring his US employees back into the building. We discuss that next. We'll get the latest. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I had seen how computing power had been growing at an exponential rate, and memory storage and disk storage all have been growing very rapidly. But batteries and energy storage have been growing at a very, very slow rate of about 3, 4, 5% per year. So it takes about 20 years to double energy density in batteries at that rate.
That was the QuantumScape CEO, Jagdeep Singh, the company turning heads with its claim to have built a next-generation battery that could increase the range of an electric vehicle by as much as 50%. You can read more about this firm in the Big Take special. That is on the Bloomberg terminal and on the Bloomberg website. Now to the story that we mentioned before the break. JP Morgan has become the first major US bank to mandate a return to the office for its entire workforce in the United States, this is. In a Tuesday memo, staffers were told to start making arrangements. Joining us is Danny Berger. And Danny, how soon are JP Morgan employees expected to get back into the office? This isn't everybody in every day, is it?
No, it's definitely not. And the time frame that they've given their employees, as you say, in the U.S. is in July. So let me read from you from the memo that was sent out yesterday. It says that they would fully expect by early July, as I said, all U.S.-based employees will be in the office on a consistent rotational schedule. So that rotational schedule bit, that's really one of the key things here. Because of social distancing guidance from the government, they can't get everyone back at once. So their plan at the moment is to get at most 50% of people in. In terms of protections once they're in, they are encouraging people to get the vaccine, but they're definitely not mandating it. This isn't altogether surprising considering that Jamie Dimon, since really September, he's been very public and vocal about the damage that work from home does, not just economic damage, but social damage as well.
Yeah, and certainly we've heard from other US banking executives, at least, with some strong thoughts. Does this mean we'll likely see other Wall Street banks then following suit?
I think that is likely, Anna. And as you say, we've heard from other executives who have voiced similar things to Jamie Dimon. I think the question here is, what model do they choose? Do they choose the big bang, as one former JP Morgan executive put it, of getting everyone in at once? Or is it more easing in? David Solomon, again, he has called this an aberration, the fact that people are working from home, that they're going to correct as soon as possible. So we're basically just waiting to see what model Goldman takes here in getting people back, Anna.
Yeah, okay. Thanks very much to Danny Berger there with the US story. Here's a little bit of a take on the European banking story around this very theme. Deutsche Bank sees flexible working for up to 3 days a week. That is the comment coming through from von Moltke, who we heard from a little bit earlier on the earnings story. The opening of New York and London offices will come in the next months, he says. He sees a range of 40 to 60% for flexible working. So there's some interesting commentary coming through from Deutsche Bank when it comes to offering flexibility in terms of work location. That is it for the European Market Open Surveillance Early Edition is up next. European equity markets then fairly mixed actually this morning. A mixed bag. US futures a little lower. This is Bloomberg. Here's a little bit of a take on the European banking story around this very theme. Deutsche Bank sees flexible working for up to 3 days a week. That is the comment coming through from von Moltke, who we heard from a little bit earlier on the earnings story. The opening of New York and London offices will come in the next months, he says. He sees a range of 40 to 60% for flexible working. So it's interesting commentary from Deutsche Bank when it comes to offering flexibility in terms of work location. That is it for the European Market Open Surveillance Early Edition is up next. European equity markets then fairly mixed actually this morning. Mixed bag. US futures
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
The United States stock market is very overvalued on virtually every metric.
The bottom line is clear. If you're vaccinated, you can do more things more safely.
For vaccinated people, outdoor activities without a mask are safe.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance, the Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Deutsche Bank posts its best quarter in 7 years, confirming it dodged the fallout from Archegos. Santander reports decade-high adjusted profits. Our interviews with the CFOs coming up. The big buyback, Alphabet revenue blows past estimates. Google's parent says it will repurchase $50 billion of shares. And Bloomberg learns that President Joe Biden will not expand estate taxes ahead of today's funding proposal announcement. Well, good morning, everyone. It's Wednesday, so topple day. You can say it's halfway through midweek. Now, let's get straight to the top stories, and it's about banks. Deutsche Bank has seen its best quarter in 7 years after its fixed income traders outperformed most of their Wall Street peers. The German lender is raising its outlook and says it's on track with its dividend plan. Adjusted profits are interviews with the CFOs coming up. The big buyback. I think we're having a couple of technical difficulties. I said it's Wednesday. It's halfway midweek, and that's what happens usually when you're too confident about getting through the weekend without any hiccups. Now, we spoke to the Chief Financial Officer of Deutsche Bank, James von Moltke, really confirming that the lender dodged losses from the collapse of Archegos Capital Management. It was a good conversation. Our bureau chief over in Germany did that. At the same time, and this is what we want to look at the same time, it's something that we need to keep a very close eye on, because he further talked about what was to come. Of their Wall Street peers. The German lender is raising its outlook and says it's on track with its dividend plan. Okay, so we have a lot of banking stories. We have Santander. We also have Nomura with some changes at the top, and then we have Deutsche Bank. So to round everything up, here's our Danny Berger. Hi, Danny.
Hi, Francine. Look, I'm here. I'm ready. I'm roaring to go. I think it's sort of a strange thing that's happening with banks, because for a lot of earnings, we've seen that expectations were really high in the market. I mean, think about Tesla. We talked the other day. It didn't move despite the big beat. But look, when we're seeing banks in Europe beat, they are moving. So Deutsche Bank, the big one, up almost 6%. At the top of the board for the stock 600, Lloyd's as well, both of them beating. Deutsche Bank, this huge FIC trading number. So overall, the best performing sector today is going to be the stocks bank index. It was higher by more than 1% at one point. But let me flip up the boards and show you banks that didn't report earnings today, but still are in the green. We have German banks, perhaps sympathy with Deutsche Bank there. We have NatWest, perhaps reflecting Lloyd's. And we have the French banks as well. BNP is due to report soon. And I think that expectations being low is really reflected through the screen. All of a sudden, you're in this moment where investors are saying, hey, okay, maybe European bank earnings are going to be stronger than we expected. Maybe the picture is sustainable, and they, too, will have very strong trading numbers like their U.S. peers, perhaps even stronger, considering Deutsche Bank gained 34% in their FIC trading. That compares to an average of 17. So, Francine, I think one of the big equity stories in Europe today is a repricing of these banking shares.
Yeah, and it'll be interesting to see going forward, actually, with some of the other ones, the big ones, also reporting. Danny, thanks so much, and actually great work for all of the earnings season banking news that you've had to cover. Now, Google sees a surge in ad sales as businesses look to capitalize on their economy reopening. First quarter revenue for parent company Alphabet came in at about $45 billion. The firm also unveiled a $50 billion buyback, which sent shares higher in extended trading. Well, joining us now is Alex Webb. He's our Bloomberg Opinion tech columnist. Alex, thank you so much for joining us. I mean, $50 billion in terms of buyback is pretty significant. Will it attract the wrath of regulators and a lot of the countries to try and do this digital taxation?
I think actually, in a sense, this buyback is a consequence of regulation, because the pressure on Google and other big tech companies to ensure they're not allowed to do much deal making means they're sitting on a huge pile of cash and have to find ways to spend it. And clearly, returning it to shareholders is the only thing you can really do at scale, given you're not allowed to do that many, at least they're not particularly obvious, transformative deals. So in a sense, shareholders are benefiting from regulation.
Alex, not everything was rosy for Alphabet. What was the spot that we should be looking at a little bit more closely?
Well, I mean, look, Alphabet is clearly just the parent of Google. Most of Google's revenue comes from search, and that is overwhelmingly good. It is recovering. That was something that this time last year didn't look so promising, because people weren't, looking for, weren't searching the internet for holidays, for, big ticket purchases, and that meant there was no need to advertise for them, and as we know, Google gets most of its money from search ads. Now, that business is now recovering. People have a lot more disposable income, and they're looking for ways to spend their money as the lockdowns ease. There are other parts of the business which, they have been growing, but perhaps not as well as might have been expected, not least Google Cloud. It still struggles to compete a little bit with Microsoft and Amazon. And then, the business that never makes any profits at all is, of course, the other bets. That's things like their healthcare ambitions. They still make, a $1.5 billion loss.
Alex, we're also expecting more earnings. We have Facebook and Apple. Are they both expected to beat?
Well, I don't know if we can say whether they're expected to beat or not. They're expected to have, good numbers. Clearly, the recovery of the advertising industry is very good news for Facebook. As I said, disposable income means that people have more money to spend on the hardware that Apple sells. The question, I think, is going to be, the thing I'm really looking to hear is Mark Zuckerberg's comments on the crackdown on online tracking that is happening both on mobile devices from Apple and on web browsers from Google, the extent to which that is affecting Facebook's business going forward. Even with that, I think there's a good chance that the advertising spending is more than offsetting any concerns and wrinkles that might be emanating from those increased headwinds.
Alex, thanks so much. Alex Webb, their Bloomberg Opinion tech columnist. Now, coming up ahead of today's Fed decision and Joe Biden's funding proposal in Congress, we also have a Bloomberg scoop. The president will not be expanding estate taxes, so that we'll be discussing next. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We have lost too much time. China has resumed its growth. The US is booming. The EU must remain in the race.
French Finance Minister there, Bruno Le Maire, urging the European Union to speed up disbursements from the flagship stimulus package so the bloc can keep pace with America. But ahead of Joe Biden's address to Congress and a policy decision from the Federal Reserve, some investors are cautious on the region. While Jeffrey Gundlach of Double Line Capital told Bloomberg that U.S. stocks are overvalued in every measure and that the Fed's stance on inflation is nothing more than guesswork.
We don't know. Nobody knows. Most concerned about the fact that the Fed thinks they know. There's plenty of indicators that suggest that inflation is going to go higher and not just on a transitory basis for a couple of months. So we'll see. That's how I think the Fed is trying to paint the picture, but they don't really, they're guessing.
Well, joining us now is James Lord, Morgan Stanley Global Head of FXEM. James, I have a million questions, especially on what we'll find out in terms of GDP and actually how the Fed will position themselves today. I mean, what investors and what Dollar really wants to know is when will they start talking about possibly tapering?
Yeah, sure. Hi, Francine. Thanks very much for having me on the show again. Well, we think that this evening's Fed meeting, it's just too early for them to be making any significant changes to the language. We think that will come in the summer, potentially at the July meeting, for them to signal that sufficient progress has been made in order to signal tapering to start in January 2021. So we think there's a little bit more time here. We think there's still a window for US bonds to sort of stabilize, potentially even head a little bit lower. If they redouble down on that dovish message today, we just think it's a little bit too early for them to be making any big changes.
James, I mean, one of the big questions, and actually I've seen quite a lot of notes from banks today, I'm trying to figure out with the Families Act plan, right, from the U.S., how much funding can the U.S. still do? So this goes back to exactly, where we are on the U.S. 10-year. If it's at 1.6, as it currently is and stays there, do they still have room to maneuver?
Yeah, absolutely. I think there's levels of interest rates are far from being at a point where it would cause any concern about the ability for the U.S. government to further expand its deficit. I mean, we think that we'll see what details are announced, but our base case assumption is that in year one of the American Jobs Plan and the American Families Plan, you'll see a sort of net deficit expansion in the range of between 250 to 500 billion. And we're waiting to see more details to kind of further shore up those numbers a little bit. But ultimately, that should be something that, with the Fed continuing to do purchases, even if they begin tapering next year, it's something that the market should be able to absorb, in our opinion.
So how difficult is it to see exactly what Dollar does on the back of it? So at the moment, we have, I think, 2.25 trillion in terms of infrastructure spending. It's over 10 years. And then we'd have an extra 1.8 because of the Families Act plan, which we'll know more about later.
Yeah, so I think the dollar. I mean, if we see Treasury yields start to break above the recent range, above 170, then this will clearly put some upward pressure on the dollar. But I think investors will be paying probably a little bit more attention to the Fed meeting, and I think that will ultimately control how much the dollar would react to any aggressive deficit expansion from the Treasury. So I think if our view on the Fed comes through and they just continue to hammer home the message that it's just too early to be making any major changes, then it should keep the yield curve under control. It should keep the dollar under control. If anything, reinforcing that message today could see yields head down a little bit from here, with potentially seeing 10-year down to around 140 over time, which would give a little bit of downward pressure on the dollar as well.
James, what do you worry about in the U.S. economy? So we have GDP later this week. There seems to be, I guess, possibly a mismatch about, the rollout of the vaccine that is a great success in the U.S., but actually the uptake of the vaccine with lower numbers than in the U.K. So do you worry about vaccine lockdowns, or do you worry about runaway inflation?
Well, we're worried about both, really. I mean, both are risks to the outlook. I mean, our US economists are certainly flagging that there is a risk of an inflation overshoot later this year and as we head into 2022 because of how much stimulus has been applied to the economy. But at the same time, when you think about Fed policy, the Fed has clearly indicated some thresholds around herd immunity that they're looking at before, that would allow them to feel much more confident about the U.S. outlook, which makes vaccine hesitancy a downside risk to the economy. So, I think those risks are two things that we need to be mindful of. I think the good news is that there's a little bit of time before we will really have to worry about either of them, because in the short run, any high inflation prints will be largely dismissed as sort of transitory by the market and potentially the Fed. And the vaccination rate, whilst it's softened a little bit, is still pretty high. And the J&J vaccine is being rolled out again in the US, which may help. And I think there's still some way to go before, I think, being too concerned about vaccine hesitancy really causing damage to the outlook.
James, thanks so much. James Lord there of Morgan Stanley stays with us, and we'll talk a lot more about emerging market currencies next. Now, let's also get to the Bloomberg First Word News. In London with me is Leanne Gerrans. Hi, Leanne.
Hi, Francine. In the US, President Joe Biden is urging Americans to get vaccinated. He is pointing to new guidance that people who have been inoculated can now socialize indoors without masks. The change in rules might help convince people who have been hesitant about getting their shots. According to Bloomberg's vaccine tracker, about 140 million Americans have had at least one dose of a vaccine. Now, the European Commission wants the power to levy fines or block deals by foreign state-owned companies. The proposed rules, obtained by Bloomberg, seek to answer complaints from European businesses that Chinese state-backed firms get support they just cannot match. Chinese business groups have already complained about the draft, which could change before it is set to be proposed next week. And it's time to go back to the office. That is the message from Wall Street titan Jamie Dimon. JP Morgan is the first major US bank to tell its staff they will need to be back in about 2 months' time. It says by early July, all US employees will be in the office on a rotating schedule. There'll be a 50% staff cap until social distancing rules are relaxed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, India battles its worst coronavirus surge in the world. The official death toll surpasses 200,000, but experts believe the actual number may be higher. Later on in the program, we speak to one of the country's leading biologists, and if you have any questions for him, just IB us at IB plus TV Go. Up next, we discuss the impact of India's second wave with James Lord. This is Bloomberg.
President Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Wednesday, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacroix here in London. Now let's get straight to the banks, and Deutsche Bank has seen its best quarter in 7 years after its fixed income traders outperformed most of their Wall Street peers. Now the German lender is raising its outlook and says it is on track with its dividend plan.
It's always, difficult to simply annualize a first quarter, but our accruals are actually mechanical, subject to some rules that the ECB has laid down. So there's not too much messaging in that. But I think the encouraging thing is, with 300 million of an accrual for distributions already done in the first quarter this year, and of course we'll continue to accrue from profits in the remainder of the year, we can begin to show the first installment of the capital return that we promised investors.
Deutsche Bank CFO there, James von Moltke, also confirming that the lender dodged losses from the collapse of Archegos Capital Management.
We did see an event with a prime finance client late in the first quarter. As we said, we were able to exit the collateral positions without a loss. In fact, we were able to return excess collateral to the client. We're very pleased with the way our risk management function through the process, both in advance of the market events and then in the liquidation and managing through that event.
Now, at the same time, Santander delivered its highest profit in more than a decade. The bank booked a 500 million euro restructuring charge for the quarter as it continues with its post-pandemic cost-cutting drive. The chief financial officer, Jose Garcia Cantera, said the outlook was positive.
We did see
this is the entire restructuring charge that we expect for the year. So we wouldn't expect to have more restructuring charges. These correspond mostly to the UK and Portugal. But again, this is what we expect for the whole year.
Let's turn to tech now, and Google also sees a surge in ad sales as businesses look to capitalize on the economy reopening. Now, first quarter revenue for the parent company Alphabet came in at over $45 billion. The firm also unveiled a $50 billion buyback, which sent shares higher in extended trading. Well, tech earnings are in full swing. Google reported a surge in ad sales as businesses and unveiled a $50 billion buyback. So that's exactly what we were explaining. At the same time, Microsoft earnings topped estimates for the 9th straight quarter. So a lot going on with these two companies, and we also have Facebook and Apple after the bell today. Now let's check in on how the tech giants are trading in the pre-market session with our Danny Berger. Danny, a lot to look out for.
Definitely, and you really put this just in perfect context for me, because it really is a tale, as I wrote up here, a tale of two different tech giants. You have Alphabet pre-market surging more than 4.5%. It looked very similar in aftermarket trading too. And this was a really positive earnings for Google, because before, a lot of its ad sales, they stayed strong at YouTube, but it really is that internet searches which are important. And so this is just a good barometer for businesses in general, that they're spending again. But of course, it's that $50 billion buyback, Francine, which is really boosting earnings. At the same time, Microsoft beating, but because its market cap had gotten to something extreme, I think people were really looking for an earnings that was better than what was expected. I know it's a little strange. You beat expectations and you fall, but just generally this earnings season, people want to see companies beat expectations to a really large degree and give a forecast that's also just spectacular given where these lofty valuations are.
Danny, I can't stop saying $50 billion in buyback. Can you actually put it into context for us?
Absolutely. So it sounds big. It is big, especially for Google. Its history of buybacks is actually somewhat recent. It doesn't do a lot of these. It really started regularly doing buybacks buybacks in 2018. So you can see before this time around, the biggest buyback it had announced was $28 billion. So nearly twice as much is what they've announced here. Now, if we just look at the history of all buybacks, specifically tech, that $50 billion number is not the biggest, but still very big. Easily taking the prize here is Apple. The biggest buyback program it's announced on the open market was $100 billion, Francine.
Danny, thanks so much. As always, Danny Berger there with a full roundup of all of the earnings that we're getting this week and plenty more to come. We're only Wednesday. Coming up ahead of today's Fed decision and ahead of Joe Biden's funding proposal in Congress, a Bloomberg scoop, the president will not be expanding estate taxes. We'll discuss that next, and this is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Brand new Boston Symphony Orchestra and Boston.
Wednesday, the Fed decides. The Fed is on hold waiting on inflation, but for how long? Coverage begins 2 p.m. on Bloomberg Television.
Composers and musicians, plus.
Deutsche Bank posts its best quarter in 7 years, confirming it dodged the fallout from Archegos. Santander reports decade-high adjusted profits. The big buyback, Alphabet revenue blows past estimates. Google's parent says it will repurchase $50 billion of shares. And Bloomberg learns that President Joe Biden will not expand estate taxes ahead of today's funding proposal announcement. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, 28th of April. I'm Francine Lacqua here in London. Now, U.S. President Joe Biden is set to make his first speech to Congress after almost 100 days in office. The president is expected to highlight his progress against the pandemic while calling for bipartisan support on his $2 trillion infrastructure package. But plans, or actually sources, say he will abandon his campaign promise to increase estate taxes as he unveils funding measures for his American family plans. Well, joining us now is our D.C. morning editor, Kathleen Hunter. Kathleen, what a big day, of course, for the markets and for President Biden. How significant, first of all, is the speech tonight?
Well, I think it's going to be potentially hugely significant. I mean, it's an opportunity for the president to speak directly to the American public. We know that there's not been a lot of Republican support so far for the types of things that the president has talked about doing. And so I think the strategy here is really to make the case directly to the public and try to get a groundswell of public support for these types of initiatives. Obviously, the types of things Biden is talking about might not be very popular with wealthy people, but certainly is focused on helping working class families and the middle class. And I think that that's something that I think represents a shift somewhat in the role of government in American life, but something that Biden is firmly behind at this stage.
So how will it differ from other presidential addresses to Congress? I mean, he's spending money, and he's actually spending quite big. We're talking $2.25 trillion for the infrastructure plan over 10 years, and this would be an extra 1.8.
Exactly, and it's also important to remember it comes on top of the $1.9 trillion pandemic relief package that was signed into law in March. So we're talking about very big numbers here across the board. I think that, it's going to be different philosophically, I think, in that Biden isn't shrinking away from the idea of spending big and expanding the role of government. I mean, big government is definitely back when you look at the White House, and that's certainly a shift from what we've seen over the last really 4 decades, going back to Ronald Reagan. Just logistically, it's going to be a bit of a different speech because, it's the first major indoor event we're seeing at the Capitol since the January 6th insurrection. So there's going to be real restrictions both related to security and related to COVID-19. So there's not going to be a full chamber of lawmakers. There's only going to be about 200 people in attendance. So it's going to be a bit of a different type of atmosphere. And I think it's going to be, I think that does reflect that this is really a speech that's meant for the American public. It's meant to be telecast across the U.S. and not necessarily meant for the members of Congress that are sitting in the chamber as much.
Kathleen, of course, the president is also raising taxes to pay for it, but what kind of response are we expecting from Republicans?
Well, Republicans, are already talking about a lot of what's in this plan. We're learning the details over the last couple of days. We'll learn still more this evening, perhaps. I think a lot of what the president is talking about doing has been out there and telegraphed for many weeks now, and we've already heard from Republicans, a drumbeat that these are massive tax increases, that it's spending that doesn't have to do, that it's unnecessary spending, and I would expect that we would hear those types of criticisms continue as we, move forward and Congress begins to take up the plan.
Thank you so much. Our D.C. morning editor there, Kathleen Hunter. Now, India battles with the worst coronavirus surge in the world. The official death toll surpasses 200,000, but experts believe the actual number may be higher. Up next, we speak to one of the country's leading biologists. If you have any questions for him, just IB us at IB Plus TV Go. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, India's second wave of coronavirus continues to worsen with no clear end in sight. International aid is en route with desperately needed hospital equipment making its way to the country. President Biden told Prime Minister Modi he intends to send vaccines from the U.S. to India, but did not specify timing for a decision or shipments. Now, the world's worst second wave has seen the official death toll surpass 200,000, though experts believe the actual number may be higher. Despite being one of the world's largest vaccine manufacturers, only 1.8% of the population is fully vaccinated. Well, joining us now from Pune in India is Lingadahali Sashidhara. He is Ashoka University Dean of Research and Professor of Biology. Professor, thank you so much for joining us. First of all, how did we get here? India had a first wave in 2020, and a lot of people thought that actually you had reached more or less herd immunity. What were the missteps or the variants that has led to this awful and tragic situation today?
Okay, so if you remember when we had a severe lockdown, large number of people are working in big cities. They moved out toward the rural areas. And then the lockdown was lifted. They all came back to the cities. And much of the infection that we had in the first wave is already mostly in the major cities. And the people sort of came back and then started getting infected. And initially there was a silence, slow spreading. Many deaths were a bit low, so people didn't realize that the infection is spreading, particularly in December, January. And then sort of, it started peaking, and now we are facing a major crisis. It was sort of predictable, and it's our failure that we didn't predict right.
Okay, so we're now April 28th. What is the right way of dealing with the crisis now? Apart from asking for urgent medical equipment being sent from abroad, I guess, broadening out the hospitals, what should the Prime Minister do now?
Well, I think we have to reorganize our facilities better. In fact, now somehow we have to manage the crisis with the international support, particularly for the medical equipment, oxygen, cylinders, ventilators, and so forth. But, if it starts spreading to our Tier 2 and Tier 3 smaller towns, and that's where we need to be internally, completely self-sufficient. And I think we need to ramp up our oxygen production plants, oxygen cylinders, and all the medicine supplies. And of course, we need to ramp up our vaccination.
Professor, is there a danger that, and this was one of the concerns in the UK, as the number of infections rise really significantly, is there a danger that if you vaccinate at this exact time without going into full lockdown for at least a couple of weeks, you can create actually even more dangerous mutations of the virus?
Well, lockdown is now going to sort of slow down the vaccination. Vaccination, it's still continuing even during the severe lockdown. But I think there is still a worry about the new variants. Already there is an Indian variant. We are talking about what is called double mutations. If there is a new variant which is so different, then it may even escape immunity or the immunity induced by the vaccination. That's going to be dangerous, which is unlikely, because if you look at the way the biology of the virus, the spike proteins, if it varies too much, it will not be able to enter the immune system. And so there are certain limitations to the virus itself, how much can vary. And I think most of the known vaccines people have simulated looks like it's going to protect a very large number of variants of the virus. But I think there is still...
Professor, if you look at exactly, what you're living through in India, is it also the younger that are being affected? Like, what can you tell us about what it's like on the ground? We keep on reading.
It's extremely stressful. It's extremely stressful to see people dying because of lack of oxygen supply. It's not because the infection fatality or case fatality is very high. In fact, it should be less than 1%. And we are now experiencing more than 2% case fatality simply because we are not hospitalizing the patients early enough. We are not providing the medical care early enough at the right time. I think it's a system failure. I think we are all to be blamed. It's extremely stressful to see people die. Extremely stressful.
Is it affecting the young in a disproportionate way to what you were to what we thought in 2020?
It's definitely younger than what we've experienced in 2020. 2020, the most of the people who died were 60 and above. Now it is between 45 and 60. That age group is sort of dominating the deaths. Still, the 60 and above are, at higher rate, but because there are so many of them already vaccinated, that rate is coming down, particularly in April. And 45 and 60 age group is now more vulnerable.
How do you explain that, Professor? I mean, is it impossible to explain actually what's shifted to make much more?
Well, we do not have enough biological evidence. Yeah, sorry. We do not have sufficient biological evidence for this, particularly perhaps the new variant that we are all, for example, in places like Pune, the new Indian variant is, dominant. In places like Delhi, the UK variant is dominant. Perhaps Indian immune system is not being able to cope with these two kinds of variants, and even younger people are succumbing to the infection.
All right, let's hope it gets better very, very quickly. Linga Dali Sashidhar there, Ashoka University Dean of Research and Professor of Biology, joining us today. Now, coming up, Sweden's economic rebound helps the SMB beat estimates. So we go back to some of the corporate stories and some of the macroeconomic stories that we've been watching. The bank unveils a private wealth arm to cater to the growing number of rich people in Scandinavia. Up next, we speak to the chief executive. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe and give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy, and we need companies to step up.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Microsoft beat expectations for a ninth straight quarter, but this time investors were just not satisfied. Shares were lower in extended trading despite a jump in cloud sales. The software giant's market cap had been flirting with $2 trillion the past few days, and many investors were looking for an even bigger blockbuster quarter. Now, Deutsche Bank has seen its best quarter in 7 years. The German lender is raising its outlook after fixed income traders outperformed most of their Wall Street peers. Deutsche Bank also dodged losses from the collapse of Archegos Capital Management. The lender is working on a flexible return to office policy, allowing staff to work from home for up to 3 days a week.
It's a range of 40 to 60%, we think, of flexibility, and it'll really be up to the employee, but in a structured way with the manager, so that we sort of know when people are expected to come to the office, and we're pleased with the way in which we've been able to formulate that process.
And global growth at Starbucks fell short of expectations. Gains were expected across all regions after the weakness of last year's lockdowns, but global same-store sales only increased 15%. That is overshadowing a rebound in the coffee giant's key markets of both the US and China. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now let's get today's Bloomberg Big Take. Batteries are all the rage as the electric vehicle space gains momentum. And one Silicon Valley startup, QuantumScape, is turning heads with its claim to have built a next-generation battery that could actually increase range of an electric car by as much as 50% and could cut charging time to less than 15%. QuantumScape CEO Jagdeep Singh recently spoke to Bloomberg News' Akshat Rathi.
If getting a third-party lab to test ourselves would get rid of these kinds of random attacks, it'd be something that we consider. Do you really think, Akshat, that if all the data we had shared had in fact been generated by a third-party lab, that anything would have been different about that particular report? Because that report was not interested in the facts, right? And let's be honest here. I mean, first of all, I want to be candid, right? There is a legitimate short thesis you could have about QuantumScape, right? And that short thesis would be around, well, this is great. It demonstrates some amazing results in terms of the capability of these cells, but they still have yet to scale up the production and the factories and the time that it takes, all that. Those are uncertainties. And so somebody could say, you know what, I believe that's going to be harder than they think. Legitimate point. We don't argue with that because they're entitled to opinion. The problem is that's not what the short seller was doing. He shorted the stock most likely on Wednesday. On a Thursday morning before the market opened, he published a report full of lies, misinformation, and innuendo. Later that day, as the stock price dropped, he probably covered his short already. So he was already gone from the market. This had nothing to do with a belief that the company's fundamental risks were fundamental. This is about essentially market manipulation, and that's what I have a problem with. So I'm not sure that a third-party lab, having tested these results, even if all the data in our presentation came from a third-party lab, would have changed that particular scenario. But I'll be honest with you, we don't intend to have our strategy be driven by a random short seller looking to profit on the markets. However, the questions you're bringing up for people like you who are legitimate observers of the industry, if it makes you feel more confident in the data, then it's something that I think we will in fact consider.
What do you imagine the future of lithium-ion batteries? Not 2025, when you might be able to get into a car, but 2030 and 2035 and 2040.
I'm not sure that a third-party lab. Well, a couple quick points here. One is that because battery chemistries are so long-term in nature, they don't change very rapidly. Again, as we discussed at the beginning, lithium-ion in its current form has been around for about 30 years with relatively incremental changes over that period of time. It's not impossible that lithium metal with solid state could drive another few decades worth of battery technology with relatively small improvements to what we're doing today. So we think what we're doing is so fundamental that it could easily be the basis for the next 20 years of battery battery improvements or beyond.
Well, that was QuantumScape Chief Executive Jagdeep Singh. The company turning heads with its claim to have built a next-generation battery that could increase the range of an electric car by as much as 50%. You can read about the company in the Big Take special on the Bloomberg terminal and website. Now, to the banking story. And Deutsche Bank has seen its best quarter in 7 years after its fixed-income traders outperformed most of their Wall Street peers. The German lender is raising its outlook and says it is on track with its dividend plan.
With relatively small improvements to what we're doing today. So we think what we're doing is so fundamental that it could easily be the basis for the next 20 years of battery.
I think we were hoping to hear from the Chief Financial Officer of Deutsche Bank, James von Moltke, but we'll bring you that story a little bit later. He also confirmed that the lender dodged losses of a collapse of Archegos Capital Management.
Did see an event with a prime finance client late in the first quarter. As we said, we were able to exit the collateral positions without a loss. In fact, we were able to return excess collateral to the client. We're very pleased with the way our risk management function through the process, both in advance of the market events and then in the liquidation and managing through that event.
At the same time, Santander delivered its highest profit in more than a decade. The bank booked a €500 million restructuring charge for the quarter as it continues with its post-pandemic cost-cutting drive. Now, the Chief Financial Officer said the outlook was positive.
This is the entire restructuring charge that we expect for the year. So we wouldn't expect to have more restructuring charges. These correspond mostly to the UK and Portugal. But again, this is what we expect for the whole year.
Well, over in Scandinavia, Sweden's economic rebound has helped lender SEB beat estimates. The bank has indicated that its client base is growing wealthier, prompting it to adjust its business. That's why SEB has unveiled a private wealth arm to cater to rich clients across Scandinavia. Well, joining us now from Stockholm is Johan Torgeby. He's the SEB Chief Executive Officer. Johan Torgeby, thank you so much for joining us. When you look at some of the capital buffers that are required at the moment, should financial authorities actually loosen the reins a little bit on these, and especially on dividends, before the planned September 30 deadline, given the pretty encouraging news we had from banks?
Yeah, I mean, I don't think it's necessarily a timing stress. I think the September date, which is what we are operating under, is fine. I think we have an annual cycle to adjust the capital structure through dividend or share buyback, and I think that's fine. But I think it's very clear that we go into a more data-based approach this time, rather than just having one size fits all.
So what exactly is your preference right now? Would it be a share buyback or a special dividend?
No, I think we will start. We've just announced last quarter a new dividend policy. So the basis is for us to pay out 50% of the distributable income that we earn in a year, and then have the dividend share buyback program as a flexible tool to adjust this also during the year, should retained earnings increase or not. They can also be adjusted from growth opportunities you might identify in the market that you want to pursue. So the adjustment will take some time through dividend and share buyback, but right now, no clear answer on how.
Johan, give me a sense of how you're thinking there of share buybacks. Would this be a last option, or is it something that we should, that you're considering for, 2021?
No, we would consider it for 2021. It's not the last option, but we would always start with the dividend policy being, let's say, fulfilled, and that is the 50%. If we pay out 50% of retained earnings, we then have a capital buffer target from the board of having 100 to 300 basis points of buffer to the minimum capital requirement. In order to adjust to come into that type of, call it, fairway range, we may use share buyback. So it's the adjustment on top of the dividend policy.
Give us a sense of how you became the go-to bank for SPACs in the Nordic region.
I think that was a very kind acronym. I think we've had very few, and we might have been involved in the first one. So we'll see where this goes. But I think we have a very strong position in corporate investment banking, and hence this has a very international connotation. We, of course, try always to be the most international corporate bank in this part of the world, and I would assume those two things have played well in this aspect. we may use.
If you look at some of the things that that you've announced, which is, for example, a private wealth unit, why now? Is now the right time to make a name for yourself in this space?
Well, as I would recall or describe the long-term history of SEB, private banking has always been a very strong area and something part of our DNA. In the last kind of 10 years, we've identified quite clear new trends around savings and investments, one of which, of course, very many successful entrepreneurs have done very well in the Nordic region. We also see a succession in generation where the new savers and investors of the world are much more digitally inclined than in the past, and we think we have not performed as well as we want. This has been a very important area of the bank, and the name change from private banking and private wealth management to family office is just to be more clear and also symbol that we are now trying to invest and establish ourselves in a better way.
Johan Torgeby, thank you so much for joining us. He is, of course, the Chief Executive Officer of SEB. Now, Bloomberg Surveillance, the early edition, continues in the next hour. Matt Miller joins me out of Berlin. Kelly Langs joins me out of New York. We'll have a full roundup of the earnings. We have, of course, the banks. We have quite a lot of news also in the tech space. We had Alphabet, the parent company of Google, and then later on we have Facebook and Apple. The other thing we're watching, of course, is vaccination across the world. We'll have a full roundup of what that means for markets, and we look at Fed decision day as well. This is Bloomberg.
If you can just scan all the incoming mail, all the incoming luggages, it's going to be a massive time saver. And it means that we can capture a lot more of the illegal wildlife trade that's currently going undetected.
So our focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
If you can just scan all the incoming mail, all the incoming luggages, it's going to be a massive...
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
This is really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The bottom line is clear. If you're vaccinated, you can do more things more safely.
For vaccinated people, outdoor activities without a mask are safe.
It's very different walking through a hospital now in most parts of the country than it was just a few months ago, and that's because of the vaccine.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lyons.
Well, good morning from London, Berlin, and New York on this Wednesday, April 28th. Our top stories today. The Fed stays the course. Policymakers expected to make no changes to interest rates and the bond buying program. President Biden fills in the details. He'll unveil that giant spending plan and wants to use tax hikes to pay for it. Progressives say he's not going far enough. And Deutsche Bank bounces back. The German lender raises its outlook after the best quarter in 7 years. So let's begin with that breaking news on President Biden's American family plans. Joining us for all of this is our Bloomberg editor-at-large, Marty Schenker. Marty, this is basically almost an add-on to the infrastructure plan over 10 years, 2.25. This is how to make people feel better, and it's an extra 1.8. What are the details?
Well, the details are this is the return of big government in Washington, and sort of it essentially is the end of the Reagan era that dominated Washington politics for almost 40 years. It is a transformative plan that would allow for free child care, free community college for Americans, a permanent child care credit for lower-income Americans, and it does fulfill a promise that Biden has made that he is going to take care of the least advantaged taxpayer.
One of the interesting things, I think, Marty, is that we don't get a bump up in the estate tax. It doesn't hit more people at lower levels. A couple can pass on $24 million before they're hit with the rates that can climb to 40%. Wouldn't that have been one of the redistributive tools that makes the most sense if you want to raise taxes on the rich?
Yeah, you know, Matt, the estate tax, or what people commonly refer to the death tax, is a very touchy issue for Americans and for Congress. And it's clear that Biden's advisors felt that they were doing so much in other areas that doing something on the estate tax itself would just be a step too far. What's interesting, though, that the step-up basis on inherited businesses and investments is in the bill, in the proposal, so that would take care of some of the inheritance tax issues.
Marty, the president is going to try and sell Congress on this package in his address tonight, but he'll also be talking to the American people. Is there popular support behind this kind of spending?
Well, in the briefing that the administration gave us, they claimed that many of these proposals do have popular support, and it is targeted to make sure that people understand that this is an American families plan, not necessarily a tax increase. But the GOP is going to paint this as the beginning of the big spend, big tax era for the Democrats. And the American people are ultimately going to decide which way this counts.
So who supports this change, Marty? Is there anyone from the Republican Party that could actually get behind it?
It doesn't look like it, but, you know, they can put through these tax increases through the Senate with just 50 votes. So Joe Manchin has been very skeptical, so holding that coalition together is not going to be easy. Plus, the state and local tax exemption issue still rides supreme in New York and in California and Illinois, and they're going to have to do something about that. The American people are ultimately going
Previously, economists would have come out with concerns about these kind of tax increases. Reagan-era economists, as you point out, Marty, hurting economic growth. Are we hearing any of that? I haven't seen too much of it.
No, you're not hearing a lot of it, but I think you're going to start hearing a lot about it as this moves its way through Congress. Yeah, the argument is that the U.S. growth rates over the last 4 decades far exceed those of, for instance, Europe, that has many of these programs that Biden is proposing. But there's controversy over whether that's really the root cause of why U.S. growth, economic growth, has outstripped the world.
Marty, you were talking about the lack of a likelihood that any Republican is going to get behind this. Joe Manchin, also a moderate, is a factor here. But what about the progressives? Because they have been pushing for even more spending than this. How could that complicate the negotiations on Capitol Hill?
Well, you know, it's true, Kayleigh, that the progressives, even though Joe Biden is going big, as a Business Week cover said a couple of weeks ago, for some progressives, it's not big enough, and that they think that this is the moment to get things like student debt taken care of. But so far, the Biden administration has done a pretty good job keeping the progressives in the tent, and we'll see whether or not they go outside the tent as this works its way through Congress.
All right, Marty, thanks very much for joining us this morning. Marty Schenker, Bloomberg editor-at-large on, you know, this is one of the issues that doesn't just drive markets on a day-to-day basis, but a longer term. I'd say one of the twin issues along with Fed policy. And we will have special coverage of President Biden's address to a joint session of Congress later on today. That starts at 8:30 p.m. in New York. It's 1:30 a.m. London, so maybe you'll have to set your DVR for that. Let's get on to bank earnings. Deutsche Bank raised its outlook after achieving the strongest quarter for 7 years. Fixed income trading outperformed Wall Street peers once again, and the bank dodged losses from the collapse of Archegos. Deutsche Bank CFO James Molka told Bloomberg he expects some of that trading beat to slow down in the current quarter.
We would not expect a similar pace to the first quarter. It's, remember, a very difficult comp for the industry in the second and third quarters, because those were particularly buoyed by the environment that we had last year. Nevertheless, we see a sort of encouraging ongoing activity.
It is pretty amazing that Deutsche Bank continues to outperform its Wall Street peers in terms of fixed income trading, and that Christian Saving did so well compared to his predecessors in terms of earnings this quarter. For more, let's bring in Bloomberg's Danny Berger. Danny?
Matt, yeah, Deutsche Bank definitely not anymore the problem child of European banking. And look, I think kind of what we're witnessing with seeing this stock rise more than 7%, its biggest gain in 5 months, is that unlike a lot of U.S. companies that reported, expectations perhaps weren't as high for the European banking sector. So that gives us a picture when you get these blockbuster earnings from Deutsche Bank, it can indeed move higher. And I want to put that FICC trading in context, Matt, because it is very impressive. A 34% gain. The average gain on Wall Street was just 17%. And sure, Von Molko there talking about that it's going to be difficult to keep up in the second quarter. But if it's gaining more market share, if it's gaining on its Wall Street peers, that is a promising trend that's going to help the stock move higher. Of course, also helping things out was the fact it was able to dodge any Archegos damage, though I should say a small cost, but definitely a cost in the earnings there associated with the fallout from Greensill. Francine?
Danny, thanks so much. Danny Berger, there was some outstanding reporting also through, of course, all of the Archegos scandal from when it started. Matt, the other story today is Nomura suspending some of the executives and maybe replacing the risk head post Archegos. I have to say, Matt, I was surprised yesterday because we had a story looking at Credit Suisse and UBS also looking at removing some people tied to risk management. And the only thing I could think of is, you know, why would you wait so long to actually look at what happened and kind of, you know, have a change of scenery if they should have done better?
Yeah, well, they're very different cultures, right? Zurich and Tokyo. Credit Suisse, I think, was pretty merciless with getting rid of, firing a number of highly placed individuals, while Nomura has taken its time. It's more under the radar. They've suspended or moved some of the people working in these leadership positions. So I think it may all just come down to a different culture between how the Japanese operate and how the Swiss operate.
Yeah, I think Nomura also lost some 2.9 billion. I think, Credit Suisse is almost double that. Kaylee, apart from the banks, what else are you watching?
Well, Nomura was higher by about 1.5% in the Asian session overnight, really just rallying in tandem with Japanese equities more broadly. The Nikkei closed higher by about 0.2%, and we really saw gains across Asia. The Hang Seng in Hong Kong was higher by about 0.5%, as was the CSI 300 in China. In foreign exchange, I would note one of the big underperformers in the G10 space is actually the Aussie dollar, weaker against the US dollar by about 0.3% after weaker than expected inflation data, indicating that policy normalization there may lag behind even the Fed. I would note, though, that the Indian rupee is stronger against the dollar for a third day, despite the ongoing virus crisis in that country. As for what the picture looks like in Europe, it is a bit mixed. We are just fractionally lower on the Stock 600, though we are seeing gains for some of the other indices. The UK FTSE 100, for example, up about 0.2%. Gains for the DAX and the CAC as well. The euro is weaker against the dollar today, sitting at 120.71. And I would note that the rally we've seen in some of the commodity complex, the ags, the industrial metals, is cooling off today, though we are seeing Brent crude just fractionally higher, just above $66 a barrel after OPEC Plus said yesterday it is going to go ahead with its plan to slowly increase supply as demand picks up. As for what the picture looks like here in the U.S., it was big tech that was under the most pressure yesterday, and once again, NASDAQ 100 futures pointing lower by about 31 points, down 0.2%. After we got mega cap tech results after the bell yesterday, we have more on deck today. But before we get to those tech results, we also have to get through the Fed decision. And ahead of that, yields are moving higher. We're just shy of 1.64% on the 10-year Treasury yield, which is the highest in about 3 weeks. It'll be interesting to see if the Fed even talking about tapering and what they say about inflation. On inflation, I would note the 10-year break-even rate is sitting at 2.41%, which is the highest since going back to 2013. And with that higher yield story this morning, Francine, the dollar is broadly stronger in the G10 space.
Kaylee, thanks so much. A lot to watch out for now. Coming up next on tech earnings, Hussein Kanji, Hoxton Ventures partner. We'll talk, of course, about Alphabet, the Google parent, and the $50 billion buyback. We'll also talk about Facebook and Apple later tonight. Stay with Bloomberg for our coverage of President Biden's address to Congress. That starts at 8:30 p.m. in New York, 1:30 a.m. in London, and this is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Bloomberg Surveillance Early Edition. I'm Kaylee Lines in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, Francine, Matt, I want to take a look at some of the stocks moving in pre-market trading in the U.S., all of them companies that reported earnings after the bell yesterday. First up, Alphabet, the parent company of Google, up more than 5% in pre-market trading, revenue blowing past analyst expectations. The story really is, Francine and Matt, that as the economy reopens, businesses are spending a lot more on digital advertising. So that aiding the company, plus a $50 billion share buyback, is boosting the shares this morning. To the downside, though, Microsoft, it did beat, had a record quarter when it came to revenue, beat on earnings for the 9th quarter in a row, yet that was not enough to impress investors. Shows just how high expectations were going into the print. That stock is down by 2% in early hours, and getting absolutely pummeled in pre-market trading is Pinterest. They beat in the first quarter. That's not the issue. The issue was the outlook. User growth, they say, will be about flat in the U.S. in the second quarter. As people emerge from the stay-at-home world, they're not going to be signing up for Pinterest as much. It's that pulling forward of demand, a similar story to what we saw with Netflix last week. And as a result, those shares are down by 10.5% before the bell, Francine.
Kaylee, so Alphabet gained 5.2%, so let's start there with Hussein Kanji, partner at Hoxton Ventures. Hussein, thank you so much for joining us. When you look at what Alphabet is, I mean, 50 billion, first of all, is a huge number. I mean, it's actually the size of, a smaller GDP, or, GDP in smaller Eastern European countries. But overall, they lost money also for deliveries in the drone, but also the driverless cars division, I think, not autonomous vehicles. Does that tell us something about the future, or do they just need to spend at the moment to make sure that once it's viable, they're there first?
Well, I think all of their future bets are losing money right now, but that's expected. They're almost like venture capital bets at the moment. So you're waiting for them to invest, and they take a lot of resources, I think. I mean, driverless cars are not a couple of $1 million of investment. They're going to be a couple of billion of investment. They're prepared to do that. We won't really know the answer for that for another 4 or 5 more years, unlike what some of the publications are saying. I don't think driverless cars are around the corner anytime soon. It's going to take quite a bit of time, I think, before they're on the road.
But they have the money to do this, right, Hussein? I mean, this is kind of the point of these moonshot investments. I guess this one is now less of a moonshot than it would have been 5 years ago. They're generating enough from ad revenue to support these kinds of mid to longer term bets.
Exactly. I mean, I think they're playing the role of what's around the corner in the future, and how can we be prepared to write the check? And, these are not the checks that the venture capital community is going to be able to write, because it's just too capital consumptive. So the winner for these kinds of things is going to be one of the bigger companies, which is prepared to write the check and has the resources. So they're diverting the cash flow into these portfolio more speculative bets, but I don't think they're that speculative, because I do think they're kind of around the corner, and they're prepared to make the investments to see if this could be the next big thing in their kind of portfolio of assets as a holding company. It's a smart strategy, but it's them basically playing venture capitalists.
Hussein, it's interesting. We talk about so many of these tech companies being winners during the pandemic, and the thought has been that they're going to lose as the world reopens, but Alphabet actually benefiting in kind of this convoluted way from the reopening of the economy. How long can that last, and are there any other tech players that can continue to see growth even in a post-pandemic world?
Well, so I think that's the big question. I think everyone's usage numbers are going to come down as kind of the world goes from buying stuff and being in this kind of forum and all online back to kind of doing real experiences. But these are really strong companies at their heart, and so even in the real world economy, I think a lot is actually driven by the online players in terms of just discovery and advertising. So I think they've got some real fundamental strengths behind them on a secular basis, irrespective of the pandemic. The pandemic, I think, just accelerated the consumption because everything was taking place online. So, I think Facebook is in the same spot. I think Amazon's in the same spot. I think Apple's in the same spot. The biggest question mark, again, for someone like Facebook is just what happens with all the privacy and tracking information that Apple is now taking into the product.
Absolutely. It seems to be the biggest concern for Facebook of all of them, Hussein, because, once you start subscribing to paper towels on Amazon, that's pretty sticky, and it looks like we're going to have a hybrid work model going forward. People are going to still need iPads and iMacs, but Facebook is the one thing that doesn't really seem to add any value. You only do it maybe if you're stuck at home because there's literally nothing else to do. Once people are allowed back out into the world, what's to keep them on Facebook?
And you see that by the way in the data. So the Facebook consumption as well as the YouTube consumption during the pandemic kind of skyrocketed up, but everyone's forecasting that's not going to stay. And Apple devices actually sold quite a bit as people started using them for educational purposes at home. They needed more Macs and more iPads. Those were sluggish businesses before the pandemic, and they kind of accelerated. There's this open question of what do you need Facebook for once these privacy controls kind of comes in. I think the Facebook argument is that a lot of shopping is going to take place on Instagram, and they're going to be able to drive commerce, but that is still a yet to be determined. And it's an open question, I think, whether they will really suffer from these things, both pandemic as well as privacy, or whether they find a new business that kind of grows them up.
That's all I need, Hussein, even shopping on Instagram. I mean, I didn't find enough ways to spend money. Hussein, when you look at, Apple, so it's also reporting, what are you expecting from them? Can 5G really drive demand for the next cycles of some of the hardware they're selling?
Yeah, so I've been pleasantly surprised by what Apple's been able to do with both the iPads and the Macs, which are sluggish, and then there's a question of the phones. The phone business has come kind of roaring back to life in terms of its upgrade cycle, predominantly based on China. So the Chinese growth has actually been really good for Apple this year. The Chinese economy, unlike other places, is kind of ahead of the curve on the pandemic right now, so life has kind of returned more back to normal over there than anywhere else in the world. And then the question for Apple is just what happens with 5G, and if replacement cycles used to be about 3 years for the iPhone, they've gone to about 4 years. But I think everyone's expectation is with 5G rolling out in the U.S., people are going to try and upgrade their Apple devices. So they're kind of most analysts are forecasting there's going to be a big upgrade wave for Apple that is going to benefit from later this year.
Hussein, thank you so much. I actually have 5G. It doesn't work great at the moment, even in London. Hussein Kanji, partner at Hoxton Ventures, joining us on all of these FANG stocks. Now, coming up on Bloomberg Technology, Brad Smith, Microsoft's President and Chief Legal Officer. You don't want to miss that interview at 5:30 p.m. in New York, 10:30 p.m. in London, and this is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia. For the region has been close to 24% last year. Almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Kaylee Lyons in New York. We're actually talking about colors. But on to the Bloomberg First Word News, and there was a tense encounter in the Persian Gulf between the U.S. Navy and Iran. The Navy says an American warship fired warning shots when Iranian Revolutionary Guard vessels got within 68 yards of the ship. Now, the Navy released black and white video of the incident. Saudi Arabia is in talks to sell a 1% stake in Saudi Aramco. Now, the sale could be worth about $19 billion. According to Crown Prince Mohammed bin Salman, the kingdom is looking at a deal as a way to lock in a custard demand for the country's oil.
There's going to be something very soon. There may be a sale to key main investors that will be announced in the next 1 or 2 years. I don't want to give any promises about deals finalizing, but there are discussions happening right now about a 1% acquisition by one of the leading energy companies in the world. This deal could be very important in strengthening Aramco's sales in the country where this company resides.
China is the largest buyer of Saudi Arabian oil, and Walmart's fight against the $15 minimum wage is putting it in the inequality spotlight. Rivals such as Amazon, Target, and Best Buy all pay at least $15, while Walmart is the nation's largest employer. Its resistance risks pulling attention away from its improved pay, plus education and maternity leave benefits. In February, the retailer said it would raise the average wage paid to its associates, but not to the minimum, to more than $15. And I couldn't believe when we were talking about the story, Kaylee and Matt, 1.5 million people are employed by Walmart. Coming up, it's Fed Day. We'll look at rates. This is Bloomberg.
There is renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine. Brazil and Indonesia are dependent on this vaccine, so questions are starting to mount on how is this going to affect the global immunization effort. But what's also
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Wednesday, the Fed decides. The Fed is on hold waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
Even if the only access they have is to a Chinese.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, Matt, we're also watching the Fed, but of course this kind of pales into comparison to what we heard from President Biden and of course his Families Act plan.
Yeah, absolutely. I mean, the Fed, you said it yourself at the top, not expected to really do much. And it's unlikely that we're also going to get very many signals as to when they will do too much or even talk about doing more. So the tax plan, I think, is key for investors right now. You're going to see capital gains tax, the money you make from investments, double if you make more than $1 million a year in your household. That's huge.
Yeah, it's huge, and of course that could move treasuries, which would then have an impact on the funding and what the Fed could do. So it's all linked. Kaylee, what are you seeing on the markets?
Well, there's so much going on. We have Biden's address to Congress. We have that Fed decision. And also we have results after the bell from two of the mega cap technology companies, Facebook and Apple. It is so much for the market to digest on a Wednesday. Where that leaves us at this point in the European session is just fractionally lower on the stock 600, down just about 0.1%. Here in the U.S., big tech continues to lag, but we are seeing S&P 500 futures just higher by 1 point. They've been fluctuating a bit between gains and losses. Ahead of that Fed decision, the
huge, and of course
the 10-year yield is up 2 basis points, sitting at 1.64%. That's the highest in about 3 weeks, and that move higher in yields has the dollar stronger on the day. Now, of course, as I mentioned, it is also earnings season. We have a number of stocks moving on the back of the results they reported last night in pre-market trading. Advanced Micro Devices is higher by a little more than 4%. They beat in the first quarter, but it really was the fact that they raised their full-year outlook that is aiding sentiment this morning. Visa is also higher by about 1%. It saw debit volumes up 31% in the U.S. in the first quarter as all those stimulus checks hit Americans' bank accounts. The company saying they see the beginning of the end of those pandemic spending woes. You do have Starbucks moving to the downside, though. Global comp sales missing estimates coming in at 15%. The street was looking for 17% growth, so those shares are lower by about 1.5%. And then Facebook, it has not reported yet. That's due after the bell. But Google and Alphabet and its report after the bell last night underscored the strength in digital advertising that the company is seeing as we emerge from the stay-at-home world. So that is giving a little bit of a lift to Facebook shares ahead of its results, higher by the better part of 2% in early hours, Matt.
All right, very interesting to see Starbucks. You know, I thought that was pretty interesting that people aren't coming out, at least they aren't coming out and then going into a Starbucks as much as you may have thought. And of course, as we were talking about earlier, it's going to be fascinating to see if people stay on Facebook as they go out and don't go back into a Starbucks. Have I given Hillary Clark a shout out lately? I don't think I have in the past couple of days. Our charts queen put this beauty together for me from Goldman Sachs data, and I think it's just fascinating. For those listening on radio, this is a chart that goes down and to the right, but that indicates easier financial conditions than we have ever had. Goldman Sachs says financial conditions are the best that they've ever been on record, Fran, which is why I think it's going to be difficult for the Fed to get more dovish than they already are today.
Yeah, and I think the markets will keep on pushing for some kind of timeline on when at least they start talking about tapering. So the Fed is all but certain to hold steady today as officials assess the accelerating recovery. Billionaire bond king Jeff Gundlach says the Fed is guessing when it comes to its view on inflation.
We don't know. Nobody knows. Most concerned about the fact that the Fed thinks they know. There's plenty of indicators that suggest that inflation is going to go higher and not just on a transitory basis for a couple of months. So we'll see. That's how I think the Fed is trying to paint the picture, but they don't really, they're guessing.
Okay, they're guessing. Nobody knows. We hope Ralph Preuser knows. He's a global head of rates research at Bank of America Global Research. Ralph, as always, thank you so much for joining us. Before we get on to Fed specific, if we put the funding into context, so with this additional Families Act plan from President Biden, it's $2.2 trillion on the infrastructure plan over 10 years. This is an extra 1.8. Is it okay when Treasury yields, the 10-year yield is at 1.6, but is it not okay at 2.5? And actually, is that the level cutting off point that we should be watching out for, how acceptable it is that yields rise?
Lots of difficult questions all wrapped into one. So first of all, higher supply should support higher rates, right? But as you pointed out, at some point this will become self-defeating because there will be a concern that the amount of funding that needs to be spent will ultimately require lower rates to be sustainable, as well as there will be questions of the extent to which higher rates will ultimately undermine other asset classes, be it credit or equities. The way we've been looking at it is to say that rates can easily go towards 2.25 by year end, but after that things should get stickier, and not so much because we're worried about how much debt there is to fund and what level of rates you need to fund that, but rather because at those levels of rates we expect to see demand crystallize, primarily from two sources. One, from global fixed income portfolios, because at that point US rates will start looking very attractive on a cross-market perspective, as well as within a global asset allocation process, because at that point fixed income will also look attractive relative to equity markets and will start to look very attractive as hedges to equity markets.
Ralph, give us a sense of actually, what the conditions are that you see for the Fed to start tapering, because, they probably don't want to say it, but this is what the market wants to know.
I think we're a long way away from tapering itself. I think the interesting question is what are the conditions that the Fed needs to see to start talking about tapering, and how long does it take to get us there? And I think that is something that we can expect to see in the next few months. It's probably too early for today, but we would be very surprised if that debate doesn't intensify over the course of the summer, so maybe as early as the June meeting. And definitely we would expect a lot more detailed discussions about it around Jackson Hole and the September meeting.
How important is the commodities rally, Ralph? Goldman Sachs and UBS both saying that this hot run isn't even close to done. Goldman Sachs saying raw materials are going to surge 13.5% in the next 6 months. These input costs must be, if not difficult, at least notable for manufacturers.
Sure, but I think that is the interesting bit of the inflation debate, right? We know we are going to get very supportive elements for inflation coming through from commodity prices in particular, and the oil price base effects from last year, which will result in some fairly dramatic headline prints in the US over the course of the summer. But to your point, the big question is how much of those price increases can actually be passed on to consumers, and how much of it will just translate into margin compression. And the hope, obviously, is that with the amount of demand stimulus that we're getting in the US, pricing power will be relatively healthy, and at least there will be some element of pass-through, which will help to get inflation, more sustainably towards target. But that's not necessarily the case elsewhere, and obviously the extent to which we are dependent on these commodity imports also varies significantly across countries. But I guess that's the interesting part of the inflation debate. For now, we are reasonably relaxed about it.
Well, Ralph, we've already had a number of consumer goods companies here in the U.S. in their earnings reports say they are going to raise prices due to those higher input costs. So the translation into CPI is interesting there. And of course, CPI is one of the data points where we saw an upside surprise over the last month or so. And yet we haven't seen the corresponding move in yields that we'd think we would, in that they haven't really moved materially higher. Does GDP tomorrow change that?
Possibly, but I think the key bit to remember when it comes to the translation of CPI into into rates is via break-even, right? And we have seen a very dramatic adjustment in break-evens already. Pretty much every forward point on the break-even curve is pricing in, the Fed meeting its target. The question is, at what point is the market going to be comfortable to price in that overshoot that the Fed is promising us? And in which part of the curve will we see that? We do think that we ultimately need to price that overshoot, in particular in those, between years 2 and 5 or 3 and 6, because that is where that overshoot is most likely. But ultimately, we probably need to get past the hump on those base effects and see that sustained increase in inflation for that second leg of the break-even repricing to come through.
Ralph, thanks so much. Ralph Proser, their Global Head of Rates Research at Bank of America Global Research. Now, stay with Bloomberg for our coverage, special coverage of the Fed rate decision and news conference by Chair Jay Powell. That starts at 2 p.m. in New York, at 7 p.m. in London. Of course, the markets will look at that, and they'll also look at what Joe Biden has to say. We had details in the last 39 minutes. Up next, EU lawmakers marking the final step in the years-long Brexit drama. We'll discuss what that means ahead with Thomas Byrne, Ireland Minister of State for European Affairs. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
This is Bloomberg Surveillance, the early edition. I'm Francine Lackman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, EU lawmakers have now given approval to the post-Brexit trade deal with the UK. It marks the final step in the ratification process and ends 4 years of fraught negotiations. The agreement excludes services, which accounts for about 80% of the UK economy, and the implementation of the deal in Northern Ireland is a key point of contention. Well, we're delighted to be joined today by Thomas Byrne. He's the Irish Minister of State for European Affairs. Minister, thank you so much for joining us. We have a number of questions to ask you, including the Northern Ireland Protocol, some of the riots that you've seen, and also some of the concerns going forward with vaccinations. But if we start with Northern Ireland Protocol, will this be a point of contention for the next 3, 4, 5 years, or are you expecting the situation to settle?
Well, I certainly hope that it settles, because I think that the big problem with Northern Ireland, apart from all of the other issues that we're aware of, is the lack of certainty over the last few months in particular. I think now that the Trade and Cooperation Agreement is now finally ratified in the European Parliament, that's put to bed as such, it gives certainty to that process at least. I think we will work on focusing on giving Northern Ireland the certainty that it needs. The certainty is there in the protocol to the withdrawal agreements that we've been signed up to. And I think we're determined with the European Union, and I would say with the British government too, to ensure that that is operated and put in force in the most efficient and most effective way, and to be fair to every part of the Northern Ireland community, while also, of course, protecting the single market, which is so vital to our countries, the European Union.
But, Minister, what exactly does this mean? I mean, concretely, have you had assurance from the UK Prime Minister that this will be dealt with? Have you had assurance from the EU that this will be dealt with?
Well, what's happening at the moment is that there are discussions going on between the EU and the UK about implementing the protocol. So the protocol that will be brought in is agreed, it's in place, and everybody has agreed that it will remain in place in accordance with the terms of it. What's happening at the moment is operationalising it is always difficult. And I think the EU and the UK are both engaged in a good faith way to make sure that it's operationalised properly. And there's work going on at a technical level, there's work going on then at a political level as well. But I think everybody's united in the desire to bring certainty to the situation in Northern Ireland, and to protect the gains of the peace process and to protect the open single market. What's happening at the moment is that there are discussions.
Have you had any serious security concerns? I mean, has there been a point when you've started to truly worry about the peace?
Well, we're always worried about it. Michel Barnier at the last meeting of the General Affairs Council of the European Union said the peace was fragile. I thought that was a really good word to use, but how right he was. Because over the last number of weeks we've seen riots, we've seen some violence, we've seen police officers injured and attempted murder of one particular police officer. So the situation is fragile and delicate. And I think it's not all related to Brexit, to make no mistake about that. But I think the uncertainty there in relation to the implementation of the operationalising protocol has certainly contributed to the difficulties there. So I think we need political leadership in Northern Ireland to give leadership there to every community, and many are trying to do that. But also between the EU and the UK, we need to see movement on implementing the protocol. That is starting to happen. I acknowledge that, particularly on the UK side, where we were complaining of at various points in the recent past, but that has changed. I think it needs to change as well for the sake of the political and social situation in Northern Ireland. But make no mistake, there are so many other issues there as well, including severe economic deprivation. I think it's about time that leaders try to show the benefits of Northern Ireland for inward investment, particularly its place in the single market, but also retaining its place in the customs territory of Britain. Gives it a unique vantage point for both the British market and the European market as well. And I think if we start to see those benefits accrue to Northern Ireland, and political leaders encouraging business to see those benefits and to use those benefits, I think then we will see more stability in Northern Ireland, more economic progress, and indeed more social progress, and all of those are back.
Can I ask about, Irish sovereignty within the EU? When I see Brussels trying to impose a universal tax regime on all of the different states in the EU, I wonder if it kills competition. Isn't it good to be able to attract different businesses to your shores with your own sovereign tax policy?
Absolutely, and that's been a cornerstone of Irish industrial policy over the last many decades. And it's not simply an ideological view in relation to low tax, but this is why we ideologically believe companies have low tax. It's not that at all. It's a way of attracting good quality companies into our country, to have our educated workforce there to attract those companies in as well, and to give them jobs, to keep people on the land. We don't have a huge amount of natural resources, but what we haven't got in natural resources, we've made up for in the educated resources of our workforce and our society, which are really attractive companies. And obviously taxes a key part of that, and will remain a key part of that. There's so many other attractions of Ireland at the moment for inward investment, and we're certainly in the market for that. The truth is that Irish sovereignty as a small country, I think, is brought into effect really by being at that European table and sharing sovereignty in many key day-to-day areas, but retaining our national sovereignty on those important issues such as tax. Having said that, we're very much working as part of the OECD at a global level. So clearly there's a lot of work going on in relation to that, and we continue to work with that, but we certainly have to protect our interests, our economic progress, and we've seen benefits. I mean, sometimes companies have come to Ireland for the tax, but stayed for pretty substantial developments in terms of manufacturing facilities, in terms of research and development, and we see that more and more. I think is
Thank you so much, Thomas Byrne, there, the Irish Minister of State for European Affairs. Now, coming up, Deutsche Bank sees its best quarter in 7 years. Part of our interview with the Deutsche Bank Chief Financial Officer, James von Moltke, is up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Access the financial world on demand.
It was a very successful quarter across the board for the company. So the profits were the highest in 7 years, at $1 billion after tax. And frankly, all four businesses performed well in their environment. Of course, it was an outsized performance for the investment bank, as you've seen for us and our peers, with over 30% year-on-year increase in revenues. Strategically, really no change. We're executing on our strategy. We have been in the process of in a sense, strengthening the franchise quarter after quarter, getting better and better client engagement, and frankly executing on the strategies that Mark Fedorcik and Ram Nayak set out, I think very clearly at our Investor Day in December. We're seeing the implications of that, but it doesn't represent a change in strategy, rather a strong execution of that strategy in favorable market conditions. Of course, it was an outsized performance.
Well, that was the Deutsche Bank CFO, Chief Financial Officer, James von Moltke, speaking with Bloomberg after Germany's largest bank raised its outlook and reported its best quarter in 7 years earlier today. Now let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance. We used to speak about Deutsche Bank for like hours on end when we co-anchored together. I know you're focused on the Fed ahead of your special show, Tom, but also looking at banks, and actually, for the moment, this earnings crop seems to be significantly better than what we had in the past.
It's significantly better, and what's important there is the margin explosions that we're seeing across sectors. Certainly you saw it with Google yesterday, just extraordinary results, way above. I know Citigroup was a bit cautious, and they noted that Google came in way above street expectations. We go to Apple after the Fed meeting today, and a lot of excitement about what they'll do. And Francine, I think one of the wild cards here globally, and something that Chairman Powell has to take in, is Asia's doing pretty darn good.
Yeah. The other thing, Tom, so if you look at the Fed, right, it's all about guidance that markets hope to know about what needs to happen for them to at least start talking about tapering. Are we, how far ahead is this?
Miles away. Let's look at a chart which shows the foot on the 2-year yield. There's no question about it. They have stayed where they are, and there's every indication, Francine, they will stay there. What does it take to move? Down they go. The pandemic comes in. The 2-year yield crashes down to zero, and it's been level. Francine, there's real no indication that they'll turn this around. They need the number one thing I'd look at, Francine, is wage growth. It's not there yet.
Yeah, it's absolutely not there yet, but it's something that I don't know whether it changes with what, but Joe Biden's announced. I mean, this is pretty significant, and it goes to the some of the things that we call here succession laws.
Well, I don't know what the British process is on this. I defer to you and John Farrell on that. What I would say is it's going to run into a maelstrom of analysis and critique on both sides of the aisle in the legislative branch. It's an executive moment tonight. David Weston leading our coverage, but Francine, I'll tell you, the executive branch turns to the legislative branch to dispose. Who knows what that will be? It's not there yet.
Yeah, interesting. I'm looking forward to all of that coverage. Tom Keene, co-anchor of Bloomberg Surveillance. Now, this is what else we're watching for the rest of the day. As Tom was saying, it's a lot about earnings with Apple and Facebook, Kaylee.
Yep, more mega caps reporting after the bell, Francine. With Facebook, I'm watching specifically advertising revenue. Do they benefit from that boost in digital ad spending we saw evident in Alphabet's earnings? Also, user growth. Will it slow as we emerge from the post-pandemic world like we saw with Facebook? For Apple, I'm watching Mac sales, iPhone sales, anything they say about the global semiconductor shortage. But really what's going to be interesting is if Apple beats, do they get rewarded for it? Because, Matt, this stock trades at a forward PE multiple north of 30, which really just underscores how high expectations are, Matt.
Yeah, that's going to be fascinating, and I will be watching that too. But in a broader sense, I'm watching to see if there's going to be any pushback from, Nobel-type economists on Biden's tax plan. It seems like we're all out of freshwater economists. If you look at the most influential economists today, you come up with all these saltwater names: Krugman, Stiglitz, Piketty, Summers, Sachs. There just isn't anyone out there with the clout to push back, Fran.
Yeah, I'm watching the Fed. Look, we have a special show around it. We were talking about it with Tom Keene, and we're expecting for them to talk about this accelerated momentum in the economy without giving the clues to markets about what it would take for them to start talking about tapering. Coming up in the next hour, all of that will be discussed with David Balin, Citi Global Wealth Chief Investment Officer and Global Head of Investments. This is Bloomberg.
travel minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
As things normalize, you're going to see a shift back towards services, and that means taking some of the pressure off the goods sector.
Ultimately, what we have to figure out here is, are we heading into a period of peak data? And peak data historically has been met with corrections.
All eyes really are on what constitutes substantial progress right now.
The good news is, long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is the busiest day of the week from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures positive by almost 1/10%. A Chairman Powell news conference later in Washington, a presidential address, and Tom Keene, a ton of earnings in between.
Yeah, wrapped around it in between, starting here really in 1 hour. We're going to see a lot more earnings, John. I'll give you one idea, John. Apple has gone from 26 gazillion shares to 16 gajillion shares over 8 years. They have retired 38% of their stock in, let's call it, a decade. Why is that going to stop? And that's one of the major thrusts of big tech, witnessing Alphabet share buyback yesterday.
Alphabet, $50 billion buyback, Tom. Yeah. Absolutely remarkable. But when we talk about Google, can we talk about the quietest 30% rally year to date that's come from that company in this stock market?
You know,
unreal.
You read my mind, folks. We don't talk to each other before the shows. Lisa and I sometimes, commiserate about children. Farrell and I were not on speaking terms, so it really works. And John, what I would suggest is you and I are on the same page. First thing I looked at is year-to-date returns for these equity markets, and they haven't gotten enough love so far. People don't realize it's a double-digit 2021.
Nobody thinks it's a shock that you and I don't talk. Lisa, you and I do talk, so let's talk about Google. This is a clean reopening story. I say clean because this is not 3M. 3M yesterday, the industrial, the manufacturer here in America, talking about what? Transport costs, raw material costs. Google's not talking about that. Alphabet in the ad business has got great exposure to reopening in America without the worries about costs. And you saw that yesterday.
And that, to me, is the biggest idea here, the idea that big tech also is exposed to the cyclical trade, in particular with respect to increased ad spending, as well as leverage to the tech world, which is going going to only continue to get dominant as people move to a work-from-home environment. We are seeing that stick with a number of banks, even as people start to get back to the office.
Got to do a couple of things this morning. Got to head down to Washington, D.C. and get an update on the president's $1.8 trillion family aid plan. We'll do that a little bit later in the program. Here's the price action to kick things off for you. Equity futures on the S&P 500 look like this. On the S&P, in and around all-time highs, up 3. We advance almost 0.1%. In the bond market, did you see the sell-off yesterday? Just picking up a little bit in treasuries. Yields higher, back through 160. Yields up 2 basis points on a 10-year, Tom, to 164.13. And in foreign exchange, short of 121, euro dollar 120.69, and down 0.2%, going into a Fed decision, Lisa, and Chairman Powell news conference.
Yeah, the 7-year auction yesterday proved yet again to be a bit of a hiccup for the bond market. At least that's what we're seeing today. What you're talking about, John, 2 p.m., that's when we get the FOMC, the Fed rate decision. 2:30 p.m., Jay Powell will be giving a press conference. Substantial further progress. What does that mean? Not only what does transitory, will they double down on this idea of transitory and give a sense of what they're looking for in inflation, but what is the measure of progress in the labor market? Then after market, you were mentioning, John, Apple and Facebook. We're going to get both of those earnings. Apple, expect a lot of discussion about supply chain kinks. Also looking for a pretty massive earnings after their announcement yesterday that was trying to get ahead of any potential ramifications on the tax or on the regulation side. Facebook, very interesting to see whether they'll enjoy the same kind of boom that we saw from Alphabet in terms of revenue from advertising. And then 9 p.m. is that American Families Plan announcement from Joe Biden. We've gotten a look at the $1.8 trillion proposal, $800 billion of tax cuts and credits, $1 trillion of spending. This comes in addition to the $2.3 trillion infrastructure spending plan, on top of the $1.9 trillion plan that he passed in the beginning of the year. John, I can't keep track of all of these proposals, and what I am wrapping my head around this morning is what's realistic? What has enough support, both within the Democratic Party and possibly on the fringes, to actually get through?
It is the race to get some big things done down in Washington, D.C., a key part of programming through the morning on Bloomberg TV and on Bloomberg Radio. I want to touch base on just the stock move this morning in the pre-market. It's Alphabet absolutely flying, Tom, off the back of those better earnings, and absolutely flying also off the back of a $50 billion additional buyback plan, and you're seeing that again this morning from various companies.
That's a media favorite and all that. Microsoft, let's remember, didn't do all that shabby as well, not as well as Google, but I would go to something you can drop in your foot. Good morning, Dennis Gartman, and that is Stanley Black & Decker. John, I don't know if you're familiar with their American heritage, but you mentioned 3M yesterday, and they're raising their organic revenue growth. They see organic revenue growth, John, 11 to 13% for the entire year. This is a company that makes drills.
Oh, I'm familiar with the heritage. I'm just not sure you're familiar with the products. You ever used one of them, Tom?
Yeah, I'm like, can you come up and fix this?
Yeah,
like,
something like that. I've got the
a
equipment.
window.
He's got one in the closet.
I bought some Stanley Black
I think the
& Decker
surveillance
products.
snap
That
is
sounds
on
about
about
right,
3
Tom.
p.m. Could I see it like at 3:30? Thank you.
Yes, I imagine that's how it plays out in a
Yes,
Keene
got
household.
that right.
We are both familiar with the heritage. We are both unfamiliar with the products. David Balin joining us now, Citi Global Wealth Chief Investment Officer and Global Head of Investments. David, let's just talk about, I think, the key discussion right now, the best way, the cleanest way to get exposure, durable exposure to a better American economy.
Well, first of all, I want to be Tom's repairman, but other than that, I do want to say that this is a pretty extraordinary time, and you've actually hit upon a couple of those themes. Number one is incredible revenue growth for technology companies, and the benefit, of course, to their stocks. But that's what's benefiting the economy, this incredible efficiency and incredible flexibility of companies, global companies and U.S. companies. Number two is, and you use the great example of Stanley Works, the idea of what growth is to come. When we talk about an economy growing 6 to 8% after a pandemic, there are two aspects to it. One is the actually ability to spend, right? And that ability to spend is due to household savings, and that ability to spend is actually due to the fact that people have not had the opportunity to leave their home to do things, to begin doing work for themselves, right? And what we're seeing is a pent-up demand from the consumer, as well as, right, an enormous amount of stimulus, and as well as the fact that people are going to begin to act as they did, a year and a half ago. All of that is happening at the same time. You asked another question, I think, in your programs, yesterday, which is what's sustainable? And that will be very interesting. Lisa talked about this in the intro just now, which is, some companies are going to be able to keep this boost of revenue. a company like UPS reporting extraordinary shipments and things like that. To the extent that people continue to work from home, that will continue to take place. And so this change of behavior that's definitely going to be underway for the next couple of years, companies that have challenged it, that's going to be a big deal. The more people are adapting to work in the future based upon what they learned in the pandemic, the more we have this sustainable revenue growth that you're seeing now.
Hey, David, the big fear out there, I want you to address this, and we see this along the way for different reasons, but now front and center is margin compression. OMG, units, price, revenue, down we go. And on the income statement, we're going to see some forms of margin compression. I don't see it.
Well, I do see it, and I think you're going to see it on a temporary basis as certain things are really in short supply. You know, when the economy reopens, the other thing is we're going to have all of the inputs, except for labor. All of the inputs are going to go up a great deal in terms of their cost, right? All of the commodities, the cost of actually shipping goods and services. The fact that there is going to be, you know, the way I put it, 16 months of inventory needs to be produced in 12 months to not only satisfy current demand, but to refill the supply pipeline. All of that's going to take place now, and that will cause some delays, and it also will cause prices to go up. I also believe, however, that this will be passed through to the consumer because the leaders are going to see margin compression. Now that brings up the idea of inflation. People talk about it, and there will be, I think, temporary inflation for the course of the next 12 to 18 months. We want our clients to own tips right now. And the only thing we really love in the fixed income market, other than high yield, are tips because they actually will capture this type of consumer inflation. But it won't be forever. It'll just be for this particular boost of time.
Well, and the temporary inflation boost hinges in the idea that we're not going to get a material shift in the economy. And here you had Google yesterday announcing a $50 billion share buyback. Is that good or bad for you as an investor after all of these investors that they wanted to see investment in the infrastructure of companies, the investment in actual productivity going forward? Share buybacks doesn't get that done.
Well, they really don't have much of a choice. When you're just handed, literally boatloads of cash because of the fact that your investment is in human capital. If you think about it, that is, they have excess cash, they're doing buybacks. Who else does it benefit? Well, it benefits all of their employees as well. They simply don't have the internal research and development costs that are required, necessary to sustain the growth that they have. It's not going to be building new manufacturing plants. It's just going to be hiring new human capital, and they will do that. And that's why they're going to benefit both their shareholders and their employees by doing so.
David, always good to catch up with you, sir. Great to catch up on this market too. David Balin, Citi Global Wealth CIO and Global Head of Investments. A little bit later, Apple coming up a little bit later after the closing bell, following what we heard from Microsoft and Alphabet yesterday. Then tomorrow, Tom, it's the next big one too. It's Amazon on deck.
Yeah, beneath the radar is the rumors on Apple. I'm not even sure if this is out in the zeitgeist. Yes, the leadership here, of course, is from our wonderful Mark Gurman, who's front and center. But the M1 chip, John, they're already modeling out a press release of the next chip. I mean, Apple's looking beyond with all the investment in North Carolina and that to the M1X or the M2 chip, which is substantially fancier. Maybe we'll hear about that today.
And Tom, you started this. Do you know how many messages I've had over the last couple of days about a potential stock split over at Amazon tomorrow? I know it's what you want.
Why do we have
it's what you want.
No, I don't care. Come on, I don't have an axe in this. John,
you don't?
Explain to me. No, I don't. Explain to me why we have a $3,000 stock price. I mean, it's not Warren Buffett out in Omaha. This is part of the American fabric. They ought to bring the thing down to a Dow equivalency so they can join the index that matters.
It's 2021. You don't need to be in the Dow. Let's be clear about that, one. And two, there is such thing as fractional share ownership as well, Tom.
There is.
Do you really need a stock split in 2021?
If you want to be in the Dow, 33,834, Amazon should be in the Dow.
Amazon should be in the Dow. Okay. I'm not going to bite back. I'm not doing that this morning. We're too busy. Need too much energy for later on today, Tom. I'm not going to bite back on the Dow. Just not going to do
Jerome Powell quotes the Dow.
Chairman Powell quotes the Dow, does he?
Yep.
Oh, my God.
When they look at financial conditions, do they look at the Dow?
No, they do not. They look SPX.
John, how long has this Dow argument been going on between you and Tom?
I don't know.
No, this goes back to my mother. My mother used to sit there with a martini in her hand, screaming about the Dow at 300.
Let me tell you about my mother. Next block.
Come on, the Dow.
Coming up,
matters, John.
7 a.m. Julian Emmanuel at BTIG.
Cambridge Associates uses
There's so much
Julian
going on,
Emmanuel
TK.
uses SPX.
Got a $1.8 trillion family aid plan down in D.C. Got no interest in arguing about the Dow this morning. Here we go. The market that matters. S&P 500 futures up 3.
Oh,
The
no.
advance, almost a
John
tenth of
Farrell
1%.
faces formal probe over apartment refurbishment.
Okay, we can talk about that in just a moment. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Tonight, President Biden will unveil a $1.8 trillion plan to expand educational opportunities and childcare for families. It will be paid for in part by the largest tax hikes on wealthy Americans in decades. Amongst the legislation's provisions, pre-kindergarten and community college would be free, and the child tax credit would be extended. Meanwhile, fund managers would lose their carried interest tax provision, and the top tax rate for individuals would go back to 39.6%. Fed Chair Jerome Powell is expected to maintain aggressive support for the economy. Fed policymakers wrap up a two-day meeting today. They're all but certain to hold interest rates near zero. They're also expected to repeat a pledge to keep buying bonds at the current rate of $120 billion a month. And a grim milestone for India. The number of deaths from coronavirus went over 200,000, a 52% increase in infections that outweighed declines in most other regions. New global cases of coronavirus rose for the 9th straight week by a record 5.7 million. Deutsche Bank has posted its strongest quarter in 7 years, and it's raised its outlook. Fixed income traders outperformed most of their peers on Wall Street. Income from buying and selling debt securities rose 34%, and Deutsche Bank avoided loss from the collapse of the Archegos Capital Management. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
If you go up to 40% capital gains tax, that's a really big problem, and that's a huge headwind for the U.S. stock market. Another huge headwind, of course, would be the wealth taxes that we're talking about. Those seem much less likely to pass to me, but those would be other issues that would greatly discourage small business investment.
Was Jeffrey Gundlach there, the Double Line Capital CEO and CIO. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Wednesday morning. Ahead of the Fed and ahead of an address from the President of the United States. S&P 500 futures slightly positive, up, let's call it 2 on the S&P 500 to 41.81. In the FX market, euro dollar stable, negative by about 0.2%, 120.69. And yields have been creeping higher in the last 24 hours. That continues today, up another couple of basis points to 164.13. Tom Keene bringing up apartment refurbishment. So let's talk about one that took place at Downing Street. It's unclear how that refurbishment of that particular apartment, that flat of the Prime Minister's, was refurbished and who funded it. The UK and the Prime Minister facing a formal probe over his apartment refurbishment. That is what you were alluding to, Tom, a couple of minutes ago on this program.
Ancient American tradition, Mary Todd Lincoln really having it out over what she spent. The president, this is a few years ago, John, really having to work on that. What I would note, John, is our good friend George Osborne probably was called in because he's from the family of Osborne and Little, and you got to know that Boris picked that fabric to get it done.
I'm not in a position to confirm that this morning, Tom, and I think it's probably a conversation you and I should have offline,
John,
and not here.
10 Downing Street, it's got to look nice, right?
I agree that it's got to look nice, but it depends where the money comes from.
Okay,
and if it comes from a party donor, you might get in a little bit of trouble.
I would have done it in Tots Blue.
You would have done it in Tots Blue?
Yes.
I thought it was Tots White.
Actually, Chelsea Blue would be a bigger statement
Chelsea
right
Blue.
now.
Chelsea Blue. Okay.
Yes.
Should we move on from that?
Continue.
Such a quiet morning, isn't it?
It is a quiet morning.
So
Let's go to the
quiet.
speech tonight. David Weston leading our coverage tonight. Look for that on the president's speech. Benjamin Bain joins us now. Ben Bain of Bloomberg News, thrilled he could be with us as well. Ben, I read Nancy Cook's article very, very carefully. Is this thing dead on arrival, or will there be subject to amendment in the coming months?
I don't think it's dead on arrival. This is going to be the centerpiece of a lot of back and forth here in D.C. over the coming months. Certainly, everything that's in this this plan that we're going to hear about tonight is quite unlikely to actually make it over the finish line. This is kind of the opening salvo here, right? I mean, and what you're going to hear from the president, I think, is a lot of things that Americans watching tonight probably sounds pretty good to them. You're going to hear about free pre-K. You're going to hear about more money for to be able to go to community colleges for free. You're going to hear a lot of things that he talked about during the campaign, and a lot of Americans probably would like. So I think what he's going to do tonight is he's going to sell this not to the 200 members. There's going to be less people than normal because of the pandemic in this chamber, but he's going to be trying to sell it to the American public, and some of the stuff is probably popular.
Okay, this is great. It's Washington talk, John. McConnell in Kentucky calls this a liberal wish list.
Called it a bait and switch, Tom. Called it more than that. And Ben, I think it's hard to call it a bait and switch when so much of this was talked about on the campaign trail. What is in this that's surprising to you?
Yeah, I mean, look, these are things that he did talk about at the campaign trail. I think, though, there is some surprise here just how much, the president is going forward with some of the things that the progressive side of his party have wanted for a long time. I think there was, some thought going in that we weren't really sure where President Biden was going to lead from. He's always talked about trying to be that deal maker. You look at his time in the Senate, that's where he was. What we're seeing here is a lot of things that progressives have wanted for a long time. So it's not a surprise because he talked about during the campaign trail, but he's actually coming through with a lot of things. Not all of them. Some things are left out of there, but for the left side of the Democratic Party.
Ben, what's the strategic logic in introducing this $1.8 trillion bill right after the $2.3 trillion proposal for infrastructure spending that's still very much not off the ground?
Yeah, I mean, I think that's kind of the open question here. I mean, you can look at it on one hand and you're like, this is a little bit like kind of flooding the zone here, right? I mean, everything is coming out. I think you mentioned earlier that it's a little bit even hard to keep track of all these proposals that are out there. This is now the third big trillion-plus plan. One of them's gone through that the president and the White House have put forward. I think what they're trying to do is basically put everything out there and kind of probably see what they can get. I think we're going to see a lot of back and forth here.
They put the estate tax out, and I believe that was jettisoned in the last 48 hours. What's the next tax lift to be jettisoned?
Well, I mean, so there's a few things in here that Republicans are certainly unhappy about. One thing I'm particularly paying close attention to in here is this carried interest provision. If you remember back to 2017 and the fight with Trump's tax cuts, that was a big win for private equity. They were able to keep that in there. They hold these investments for 3+ years, and that is a really, 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 really important thing for the industry. And there's going to be a big fight in Washington over that.
Ben, let's talk about that fight just to wrap things up. I've heard a lot of people talk about the biggest changes since the Reagan administration. If anyone wants to bring up the 1984 Electoral College map and have a look at what the mandate looked like for Reagan, it's very different to what the mandate looks like for this administration. How important is that?
Well, I think it's very important, and we're also in a situation here in Washington in general right now where the electoral campaigns don't start 6 months before an election. I mean, people are talking about 2022 already. So there is a window here, and back to your earlier question about why all these proposals are coming out right now, I think there's a realization that if they're going to get something done, we're coming up on 100 days here, there's a limited window here for this administration to really go after the big priorities, and that seems to be what they're doing, and they're hitting them one by one, and I suspect this is not going to be the last one we see.
Ben, great to catch up. Ben Bain down in D.C., Bloomberg's very own. Tom, elections have consequences. How many times have we heard that over the years, over the decades, over the centuries? And they do. And that election, that runoff in Georgia, those runoffs have had huge consequences.
Yeah, get out the calendar. Yeah, the elections have made this strategy that we see, but I would look forward, John, and that it's May, and pretty soon it's going to be August, and pretty soon the primary season is removed. But by spring of next year, this tax history of 2021 will be part of the electoral dialogue in every single congressional district.
And this administration has talked about unifying the country and not Congress. Let's see how united the country is behind some of these policies, Lisa.
Yeah, we've gotten polls that signify that they are sort of more behind it than perhaps the Republicans seem to be signifying. The interesting thing is, even within the Democratic Party, there is so much disagreement. I mean, you think about what was not in this $1.8 trillion proposal, a SALT cap removal. How is President Biden going to make this plan appealing to the likes of Chuck Schumer, John?
Yep, it's going to be difficult, and we haven't even talked about Senator Manchin yet this morning either. Coming up, Will Power, Baird senior research analyst on a big 24 hours for earnings. Alphabet behind us, Microsoft too. Some of the numbers coming out of these tech companies continue to be absolutely amazing. After the close a little bit later, we will have Apple, then it's on to Amazon tomorrow. Ahead of all of that, the price action looks like this Wednesday. We have a Fed decision a little bit later too that we haven't even discussed in the first 25 minutes of this program. Equity futures up 4 points on the S&P 500, up about 1/10%. Yields higher by a couple of basis points, following up yesterday's sell-off with another nudge lower on a 10-year Treasury, yields higher to 164.31. In the FX market, euro negative by about 1/10%. Here we go. Euro dollar 120.74.
Surveillance correction. The Dow was 700 when my mother was lecturing me about it, not 300.
Thank you. Should have brought that ETF, Tom.
Yeah.
This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The COVID boost is gone. From New York City for our audience worldwide, live on Bloomberg Television, this is Bloomberg Surveillance, and here's the price action. This Wednesday morning, equity futures up 4 points on the S&P, advancing about 0.1%. It is the least talked about equity market rally. Over the last month, we're up more than 5% on the S&P. We are totally desensitized by this rally now as we approach new all-time highs. Switch up the board and talk about the quietest 30% move I think I've ever seen. It came from Alphabet year to date, and hardly anybody's talking about it. Google is up by 30.72% year to date. I put 3M up there too. That's up a little more than 11%, and now I'm going to tell you why. We've been talking about reopening in America and the best way to get exposure and leverage to that theme. And I think the conversation almost exclusively around the traditional cyclical companies, the manufacturers, the industrials, names like 3M. Yet when 3M came out with earnings yesterday, where was the discussion? It was about costs, raw material, transportation. When Alphabet came out, where was the discussion? It was just about pure growth, leverage to a cyclical upturn and reopening. And Tom, that came from ad spend. And what didn't we hear? We didn't hear what we heard from 3M. Costs, transport, labor concerns, all of those things, they are not the concerns of the team at Alphabet.
And the Alphabet margins were really, really quite good as well. Love much more of that. Of course, analysis of Microsoft as well. Look forward to the close with the Romain Bostic this afternoon. Will Power joins now from Baird. Really been looking forward to this with his outperform on Apple. Will, I want to note the privatization of Apple. Since 2012, they've eliminated a very large percentage of their shares. They're down to 17 kajillion right now. Share buybacks are part of the fabric there. Do you just assume that continues in this boom economy?
Tom, great to be here. Thanks again for having me. I think the short answer is yes. I think it has become a key piece of the fabric of the company. And the reality is, it's become a good way to try to help reward shareholders with the prodigious cash, really, that they've continued to produce. And this is a company that we forecast to produce free cash flow approaching, $80 billion. And despite spending a lot on R&D and other growth initiatives, they've continued to produce excess cash. And I think, as you know, they've had a policy to try to return that net cash position to neutral or effectively zero. And that suggests we're going to continue to see, aggressive buybacks. They've approached, call it, $30 billion a quarter. We expect that to continue going forward.
Are they going to announce a dividend increase today? I've seen that out in the zeitgeist. And if they do that, do they reaffirm their position by making it a near double-digit dividend increase?
That's a good question. It's not going to surprise me if we see a dividend increase. Whether it's double digit or not, I don't know. But my suspicion is we'll see an additional, kind of doubling down, if you will, on commitment to both buyback and dividend increase. And I think it's likely we'll get that as part of the earnings release. There's been no official announcement in that respect.
Will, what did you make of the announcement yesterday or earlier this week from Apple that they were going to invest $430 billion, I can't even say it, it's that much, in U.S. infrastructure?
Well, look, it's a commitment to the United States and investment generally, right? Because they're certainly making investments outside of the United States as well. I'm sure there's a political angle to that as well. I think they like to emphasize the fact that they are a significant taxpayer already, given all the tax that they're taking on the regulatory front. But I think it also just speaks to the confidence they have in the business going forward, right? And the investments they want to make to ensure they have the production capabilities, the skill sets, and the R&D investment they need to continue to remain in a leadership position.
Well, and Tom accused me perhaps of being a little bit cynical yesterday because my immediate reaction was this is entirely a PR move ahead of different antitrust regulations potentially coming down the pike as well as higher taxes. And yet, how much does this sort of underscore the supply chain pressures that we expect to hear about in today's earnings release?
Well, I think that's certainly an element of it too, right? And Apple's a company that's been a master of supply chain over the years and has continued to look for ways to diversify supply chain. And I think you're right. I think there is an element of PR. We've seen similar announcements to the magnitude of $350 billion and the like over the past couple of years with respect to commitment. So I think it continues down that path they've been on in terms of laying out a longer term vision. And again, I think also, as I said, I think speaks to the confidence in the business and the opportunities they still see ahead.
Will Power, the last time around, the joy was a rebuild in Asia, not just China, but Asia in general. Do you look for a further recovery of their Asian growth?
Well, I think they've continued to see success across the globe. I mean, you look at the terrible situation in India and Brazil and some of these other geographies. It's unclear to what degree they get impacted, short term, from COVID. So that's still a wild card geography. By geography, but as best we can tell, demand remains robust across product lines and across geographies. We're again expecting 20% plus growth across really all the product lines as we move into this quarter, and I think solid growth across geos as well.
I got to make some news here, Will Power. Your target's a 155, but what's your sum of the parts valuation when you break this down and you value services and all the rest of it and all the products in that? What's your sum of the parts statistic?
Yeah, well, Tom, that's a good question. Look, I mean, I think one of the things to call out here is if you look at wearables and services on a combined basis, that's almost $100 billion, business.
How much is that per share? Wearables and the stuff Lisa buys, how much is that per share?
Yeah, well, I'd have to go back and do that math and come back to you. I guess,
come on, you know it cold.
On a per share basis, but I can tell you on a revenue basis, it's almost a third of the business, and on a combined basis, growing north of 20%, right? And that's what's helping drive this mix shift.
Yeah, all I can say,
he talks
Tom,
like an economist. We're not going to get a straight answer out of Will Power.
Tom, all I can say is that my tech cash is probably less robust than vet bills. There is a question, if you want to talk like an economist, Will. When you zoom out, a lot of people say, especially with tech stock valuations, they've gotten somewhat divorced from fundamentals. Yes, fundamentals look amazing, and yet the valuation is hinged very much on yields remaining this low, on inflation remaining low. What's your view on that? How vulnerable are Apple's shares to the idea of yields moving materially higher?
I think less vulnerable than some of my hyper-growth names. So, as an example, I cover many of the high-growth software SaaS names like Zoom, RingCentral, Twilio, right, which were all rocket ships last year, but have been under more duress due to rising interest rates. And so I think it's a much bigger focus there than it is on some of the big tech names. And tax rate will be something to watch, certainly with Apple and some of the other big tech names. Again, it kind of speaks to the fact that they pay a significant percentage of profits. out in taxes. So it's certainly something to keep an eye on as it pertains to the broader market in the tech space. But I think, a bigger impact on the true high growth names. Apple's growing at a much faster pace right now, but I think by and large isn't seen still as a double-digit long-term growth at this point.
Will, when you talk about taxes, what would have a bigger impact in your view? A higher overall tax rate or closing some of the loopholes that big tech companies have enjoyed to evade or to get away from some of the high taxation rates?
Yeah, that's a good question, and I'm not sure I have the perfect answer to that. I think it's probably the higher tax rate overall. And again, I think as Apple points out, they believe they're the highest corporate taxpayer in America, already, right? So it suggests at some level they're not using perhaps every single loophole that perhaps they could, but all companies are always going to look to try to maximize their profits.
Well, Mrs. Keene emails in, and she wants to know, a hitter like you, when you go to these road shows and you do all your Apple chit chat and all that, do you get like the Hermes watch swag? Do you get like the watch band from Hermes at $489 for the watch band?
No, I'm like everybody else. I'm still paying for it. If you want to talk to Tim Cook about that for me, that'd be great. I'd love to be able to test out some of those products.
We'll do that when we talk. Yeah, I'm sorry, Lisa. That just says, $489, Lisa, is a watch band. That says Lisa Abramowitz.
Oh yeah, you know me. It's basically, how much is that AirTag again, John? You said it was something like $400.
What happened to this conversation this morning? Well run, Will Power, Baird Senior Research Analyst. Thank you, sir. Thank you very much.
See what we did there, John? This is really important. We're going to do Apple earnings here. It's going to be margins and iPod and that and all that. The adults are looking at the use of cash, John, and the use of cash, like you've mentioned through the morning at Google, is just extraordinary.
There's a big change at Alphabet, though, Tom, under Ruth Porat as the CFO. We've got to underline that. Porat's really driven that change too. And they're still going to invest a ton of money into that company as well. That's not going to be a major shift over at Alphabet, but the buyback and the capital returns. And I think Tim Cook did the same thing over at Apple. That's what's amazing about Apple. When Tim Cook came on board, we talked about innovation without Steve Jobs, and he just turned it into a balance sheet machine. Just turned it into a capital returns machine, Tom, and just literally minted money for investors.
John, I mentioned the Hermes watch band, and I get an email from Mohammed El-Arian.
What did Mohammed say? Did Mohammed
thought
buy
I was
one?
trashing on economists, and I wasn't.
Is that what he thought?
I couldn't get a straight answer out of Will Power. It sounded like a conversation with Dr. El-Arian,
Oh, you're punchy this week, aren't you?
I am.
Why? What's wrong?
The Red Sox beat the Mets, okay?
So you're
the
doing
Red
well.
Sox beat
What's
the
wrong
Mets.
with you?
I'm feeling good.
If this is the good version of you.
Yes.
That is worrying, isn't it, Lisa?
Red Sox beat the Mets. The dreaded Mets.
Not to take a conversation away from this, you guys can keep going, but John, there was something that you said in your market check that I thought was really interesting.
That got cut off by Tom really early. Please, Lisa, please carry on.
Hold on a second, where you were talking about how it's the 5% rally that's the least appreciated rally ever, the 30% rally in Alphabet shares.
I think a quiet rally, just not being talked about, yeah.
Very quiet rally, because it's not traditional. It doesn't have the hallmarks of the bull market in the same kind of way. I was looking at the Russell 2000. It's up 2% this month. It's underperforming dramatically the S&P 500. Bond yields are lower on the month. The idea here that people are ratcheting back, right?
Yeah.
So we have these things that are sort of suggesting slower growth ahead or a peak in markets, while the likes of Apple shares are up by 9.3%. So the sort of staples, the cash cows, are the ones doing best. And that, I think, is underpinning the lack of enthusiasm behind this 5% rally.
The cyclical rally stalled, but the equity market returns have continued.
Right.
What on earth is in your mouth, Tom? What is that? Have we muzzled him now?
Who did that?
This is an improvement, I've got to say.
The mute button to a muzzle.
But I'm pleased that you were paying attention, Lisa, at 6:30 a.m. because my other colleague was not. Coming up, Lawrence Sauer, Johns Hopkins Associate Professor of Emergency Medicine. Might just be Lisa and I for the next 2 hours, which might be an upgrade. From New York City this morning, good morning. Equities look like this on the S&P 500. Futures advanced 5 points, up a little more than 0.1%. Yields up a couple of basis points, 164 on 10, still about 10 basis points from the closing high of the previous month at the end of March. In the FX market, euro-dollar down 0.2%, 120.69. This is Bloomberg.
With the To First Word News, I'm Rishka Gupta. President Biden goes before a joint session of Congress tonight to try to sell his historic spending plan. The president wants money for childcare, universal pre-kindergarten and tuition-free community college. He plans to pay for it with tax hikes aimed at high-income earners. Republicans already have announced their opposition, and some progressives are calling on the president to do more. British Prime Minister Boris Johnson faces an investigation into the refurbishment of his Downing Street apartment. The Electoral Commission says, quote, an offence or offences may have occurred. There are reports that the makeover was originally funded by Conservative Party donors. In South Korea, the billionaire heirs to the Samsung fortune outlined a long-awaited plan to pay one of the largest inheritance tax bills in history. It's an asset transfer of $11 billion that will take place over several years. When Lee Kun-lee died last year, he left a fortune of almost $21 billion. And Saudi Arabia is in talks to sell a 1% stake in Saudi Aramco to what's described as a leading global energy company. The sale could be worth about $19 billion, according to Crown Prince Mohammed bin Salman. The kingdom is looking at a deal as a way to lock in customer demand for the country's oil. Google's first quarter results show a surge in ad sales related to travel and retail. Businesses are boosting digital marketing to capture a public eager to resume some sort of normal life. Google parent Alphabet posted revenue that blew away Wall Street estimates. The company also unveiled a big new share buyback. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
I spent a lot of time last year to just listen, to understand, to reflect.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
President Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Wednesday, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
The bottom line is clear. If you're vaccinated, you can do more things more safely, both outdoors as well as indoors. So for those who haven't gotten their vaccination yet, especially if you're younger or think you don't need it, this is another great reason to go get vaccinated. Now.
That was the President of the United States. We'll pick up on that in just a moment. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Wednesday morning, the price action looks like this on the S&P 500. Equity futures on the S&P going into the Fed, and an address from the President of the United States to Congress later this evening. Up. Equities up 3 points. We advance 1/10%. Yields higher by a couple of basis points too. 164.13. Euro dollar in 0.2%. 120.67. We'll talk about the science in a second, Tom. But let's talk about the reaction of, I think, most people yesterday to that address from the President. That is not exactly the marketing material that I think Get Vaccinated America probably required yesterday. If you get vaccinated, you don't have to wear a mask outdoors. I'm not sure that gets it done.
We get the embargoed copy, and I'll be honest, John, about 3 hours before the announcement, I looked at the embargoed copy and went,
Is that it?
Is that it? Lauren Sauer joins with serious expertise on this. Lauren, this goes back to the giant Frank Ramsey in the 1930s, the advent of game theory through World War II, and Prisoner's Dilemma found by the Rand Corporation in 1950. We are back to the game theory of how we get out of this pandemic. Are we doing a prisoner's dilemma with our masks, or is it going to be a game of chicken?
I think we're going to have to wait and see on that one, but I agree with you. I think we would have liked to have seen a little bit of stronger guidance, a little bit more opening from the CDC, maybe some more statements around what we can safely do indoors. Maybe the message around you can take your mask off if you're outside with family members who have already been vaccinated, and so on and so on and so on. I think we would have liked to shore that up a little bit and just have a clear, concise message on what we can and can't do now.
What does May bring? I mean, April dashes to an end here. What do you and your team at the Johns Hopkins University, what do you perceive our May will look like in terms of vaccination reaction functions?
I think we're going to see a lot more things opening up. I think we're going to see a lot more people moving outside and feeling comfortable doing larger activities, sort of pushing the limit of what those small gatherings are. I think the guidance does help with that, knowing that if you're vaccinated, it does feel safe, and the CDC looks at it as safe to be outside doing activities with other vaccinated people. And so that might push into places or companies using, vaccination record cards or vaccination passports. And I think there is a little bit of concern over that, what that rollout looks like, if it's really piecemeal or more systematic. But I do see that moving forward in a lot of places.
Professor, in your mind, how much of these decisions are grounded in science and how much of it is ethics? Because I'm really struggling with it at the moment. I can't understand whether they're trying to manage behavior of the people who haven't been vaccinated, so telling people who have been vaccinated and limiting the things they can actually do. Has there been some kind of scientific breakthrough in the last week that has led the CDC to say, actually, you don't need a mask outdoors? Or have they just delayed this decision for other reasons?
I think that the science is pouring into the CDC. They have, NIOSH and many of their scientists looking at the data on mask usage, both in the lab and in the population. Studies are coming in from across the globe, and people are doing meta-analyses on them to sort of better understand at a global picture what masking does and doesn't accomplish. So I do think the science is pushing forward, and they're being informed by it. Did something dramatic change in the last week? Probably not. What we're probably seeing is an increase in the vaccination rates, which is great, although it has slowed a bit. We're still seeing the numbers tick up in the U.S., and the CDC feeling more confident in their ability to say enough people have been vaccinated that these are the places we do feel confident in putting our stamp to say this is safe.
I guess does this get put through an ethical filter after that, Professor? Because it's clearly safe for someone who's vaccinated not to wear a mask outdoors, and it was safe last week. It was safe the week before, and they probably knew that it was safe a month ago. And I think at the moment, from my perspective, and forgive me for inserting my personal opinion, and you're the expert, so please push back. From my personal perspective, there seems to be a worry that if you tell me, who's been fully vaccinated, that I don't have to wear a mask outdoors, how do you effectively police that? Because I've not got a big sign on my forehead that says I've been vaccinated, and other people who haven't been vaccinated might go around doing the same thing. And I think this keeps coming back to trying to police behavior, that I don't quite trust the American public to make the right decision. They're not sitting there and saying, here's the science. And I just get a feeling that it's the science through an ethical filter, through behavioral policing. Do you get that sense too, Professor?
I think I get the sense that it's the science through a sort of policy, regulatory, government filter where everything has to have the stamp of approval. There's a liability issue if they say the wrong thing. There's a public media component if they say the wrong thing. And so it creates these layers that create the lag that you're talking about. But then on top of that, I do think that there is this piece of telling people this is the behavior we expect to see, and how do you actually implement that? So they want to make sure that the policies and the recommendations and the guidances are all strong and founded in science. A lot of it is because of what you're saying, where you can't actually police that. So you want to push the guidance forward so that people are able to actually implement and police themselves. But what does that actually look like? I think we continue to be in a wait and see situation.
When we talk about the science of it all, I'm curious about the science of the Moderna and the Pfizer vaccines. There was recent statistics that came out that showed that 8% of individuals are foregoing that second shot for both the Moderna and the Pfizer vaccine. What is the scientific ramification? How much protection do people get from one shot versus two?
Yeah, we do know that second shot is really important in that lasting protection and getting those numbers up into the 90s, which is what we saw in the studies, the percent efficacy. So we absolutely want people to get that second shot. I think anecdotally what we're hearing is people show up, they are offered a different shot than what they got the first time, or an appointment is canceled or moved around, and they get fed up and they don't go back, or they've heard from the media coverage and from these sort of back and forth conversations about, do we actually need to have the second shot right away, or can we push it, which was happening early when shots were more scarce, that maybe they don't need it. And that's what we don't want to see. The shots are available. We want to make sure that people get that second shot, especially if they can get the second shot that matches that first shot. That's really important. And we want them to get it so that we get up to that level, that high 90s coverage, which is so important. You do get coverage after that first shot, although we do see breakthrough between, people getting infected between shots 1 and 2 or very early after shot 2. So we know that second shot is important.
Professor, it's always great to get some clarity and your perspective too. Lawrence Sauer there, Johns Hopkins Associate Professor of Emergency Medicine. There's a lot of frustration around this topic at the moment, Tom, and I don't think that frustration has gone anywhere after yesterday.
Let me ask you, John, because I think you've been really up on the transatlantic ballet. How far are we from vaccine passports? I mean, EU wants them, right?
I think many people in the EU want them, and many people in the United States do not. That's why it's so complex.
I usually have a passport right in here if I have to leave on the Gulf Stream quickly. Come on.
Once again, it's ethical decisions, Tom. This is coming down to ethics. How hard is it to have a passport saying you've been vaccinated? Coming up, Julian Emmanuel at BTIG from New York City, a controversial topic in this country. Equity's up 4. This is Bloomberg.
Oh, I thought it was least
around this topic at the moment, Tom, and I don't think that frustration has gone anywhere after yesterday.
of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of their life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is kind of touched. Immune activation that persists in these individuals. It's never good enough to get rid of it because they never got rid of it in the first place. So it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of their life.
Valuations, particularly, sort of the technology landscape, gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
As things normalize, you're going to see a shift back towards services, and that means taking some of the pressure off the goods sector.
Ultimately, what we have to figure out here is, are we heading into a period of peak data? And peak data historically has been met with corrections.
All eyes really are on what constitutes substantial progress right now.
The good news is long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The quietest Fed decision of the last 12 months from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures up about 0.1%. A ton of earnings through the next 24 hours. Apple after the close. A presidential address in front of Congress. And Tom, a Federal Reserve decision that I've hardly heard anybody discuss so far this morning.
Well, they're not talking about it, but I agree with you. It's off the radar, and maybe that is a mistake. The press conference could be interesting to say the least. On its way, John, to June 16th. Maybe that's an important Fed day. June 16. Our guest coming up says today is the day in 2021. That's a reason to stay with us on radio and TV through the rest of the morning.
June, because we get the forecast in a world where I thought they were de-emphasizing forecast-based monetary policy. Will they really wait for June?
No, come on. Peter Hooper started the show at Deutsche Bank, and all you need to know is they're raising it up, John. This boom economy, they're raising it up, and the question is, how far out do you extend that? The forecasts are a mystery.
We'll catch up with Torsten Slok a little bit later this morning. Looking forward to that. Lisa, the forecasts are a mystery. Had a couple of companies in the last couple of days not offering guidance for this year. Last year it's because the economy was so bad, and this year it's because what? The economy is so good?
The real question to me is on inflation, and this really remains one of the key distinguishing features between a lot of investors. Jeff Gundlach of Double Line yesterday saying on Bloomberg BNN he thinks that a lot of these inflationary pressures do not look transitory. I'm curious whether Fed Chair Jay Powell gives any guidance as to how they will calibrate transitory versus a more substantial wave of inflation, because they might not look at forecasts, but the rest of Wall Street does, and they're going to do it for them, and they're starting to get ahead of them.
Transport costs, raw materials, something that has come up in these earnings calls repeatedly over the last couple of weeks. Here's the price action this Wednesday. We look like this on the S&P 500. Equity futures slightly positive on the S&P. We climb higher by 3-4 points, up almost 1/10%. We have had a lift in Treasury yields over the last couple of days. Yesterday, a push higher through 160. Yields up again by 2 basis points to 164. Tom, I do love you for the sound effects. Give me one more. Euro dollar 120, 69, down 0.2.
Two-year yield is right up against the top of the range.
I'll talk about it right now. The 2-year yield, Tom, has lost its heartbeat over the last year. And if you look at a 5-year chart, and I'll bring that up a little bit later if you don't cut me off again, I'll actually get there and we can talk about it. And that's going to be the issue for this Federal Reserve, whether the front end of that yield curve becomes unanchored before they're ready to let it go and talk about raising interest rates. Unanchored on better data, unanchored maybe on higher inflation. And Tom, that hasn't happened yet.
It hasn't happened yet, but John, what is the catalyst for the markets to take over and tell the Fed like to do? I'm going to go all Marty Zweig on you. Don't fight the Fed.
Either the communication changes or the data changes. That's what it's going to come down to.
Yeah,
and right
okay,
now, the Fed and the market seems to be on similar pages. That can change. I'm with you.
You're giving me 2 transitories. Give me a third transitory.
I'm going to move on. I'm going to get to Lisa and get the day ahead.
I think there's been substantial progress made between you two.
Do you think?
Yeah,
can we
perhaps.
call it that?
Let's
Should we start to taper?
Progress. You guys are working together. Substantial progress is what I'm looking at. We're getting that FOMC rate decision at 2 o'clock. Then at 2:30 p.m., Fed Chair Jay Powell will come out and give that press conference. I personally am very curious to hear what he has to say about substantial progress being made in the labor market. What will it take for them to start to talk about tapering? People expecting that later this year, possibly the discussion, not the actual tapering. A lot of questions, and they're towing a really fine line here, being a cheerleader for the economy while also indicating they're going to keep monetary policy ultra easy. After the bell, we are going to see Apple and we are going to see Facebook earnings. One thing, John, you were mentioning about the rally and this 5% very quiet rally. Even within big tech companies, the share prices have been wildly bifurcated. You've seen Apple shares up more than 9% so far this month. Facebook shares up 1.6%. People sort of looking at some of the regulatory pressure as well as ad spending pressures, and what is their ultimate growth engine? Where is it going to come from? These are going to be some of the questions that Facebook will face after the bell. And then at 9 p.m., Joe Biden will be presenting his American Families Plan to a joint session of Congress for the first time. Expect him to speak about this $1.8 trillion plan as a way to redistribute wealth, inject more fairness into the tax code. Again, John, we are being overwhelmed with plans. What will stick? What has staying power?
A race to get things done down in Washington, D.C. If you missed the first 60 minutes of this program and you tuned in, maybe on accident, maybe deliberately, and you were listening to Tom, you would think this morning was a quiet morning. It's not. This is not going to be a quiet day either. Julian Emanuel of BTIG says, quote, "It is no exaggeration to say that Wednesday could be the most important day for markets in 2021. Julian, it's usually journalists that try and sell stories talking like that. Why?
We're just looking at the facts of the news flow between hearing from the world's largest company by market cap, Fed Chair Powell, and President Biden, particularly in this environment where we're having such an intense debate about inflation and whether economic growth is really in the low 6s, as consensus states that it is, or really more like 8%, and whether the Fed will have to react to that. And of course, we're going to hear that we're going to have more spending and higher taxes tonight from President Biden.
Julian, you have participated like no one in this market. State the bull case right now. State the case on this most important day of 2021 why I should acquire shares this morning.
The bull case is obviously we know that economic and earnings growth continues to power the market ahead. Negative real yields puts people in stocks away from bonds. We don't know how long negative real yields will persist. We do think yields are going to rise, but we don't think it's going to get to a point where it's going to be restrictive for stocks for quite some time. But again, the other thing is the amount of liquidity that's out there. $4 trillion plus in money markets, savings rates near all-time highs. All of these augur well for the continuation of the bull market.
There is a question about inflation, inflationary pressures, and David Bailey was saying we are going to see margin pressures for a lot of companies. Yes, they could pass along some of the costs, but not all of them. Where are you factoring that into your investment thesis?
Well, there's no question, Lisa, that that is something that's building. And for us, what it causes is sort of a drill down into, it's not just at a sector level, it's really a stock-by-stock level. For example, we've heard a lot of commentary from some of the consumer staples companies this reporting season that they will be able to pass their costs along, or they're planning to, and we take them, at their word in terms of thinking that way. Those are the types of companies we want to own. Pricing power is paramount in this market.
Where do the industrials and the manufacturers in America fit into that story, Julian? Because they might have a tougher time.
That is definitely a mixed bag, very idiosyncratic, John. In fact, part of that is just trying to figure out, with copper at $10,000 on the LME, are you going to be able to see the economic activity, to see the infrastructure build, which is why the wrangling in Washington is so important for the industrial sector.
And of course, a firm rule here at Surveillance when the LME is directed, we always go to Mr. Farrell for the follow-up question.
Thanks
John?
for that, Tom. I really appreciate that, but the follow-up question's not on the London Metal Exchange. It's about the 1970s. Every time I mention that decade, Julian, we get hate mail. It's real. Tom said it a million times. Julian, do you really think there's a 1970s parallel here?
There could be, and it's one of those things where we would like policymakers to realize the potential for it, okay? I think part of the healthy aspect of the debate going on in Washington right now is that there is an element of both Democrats and Republicans that think that the spending proposals may be a tad too aggressive and that we have to do it in a more reasoned way. But again, the countervailing point to that is if we start raising taxes, that itself is also a self-fulfilling prophecy in an environment where corn prices are through the roof, lumber, plastics, avocados, you name it.
Avocados, that has been a big concern for Tom Keene and the entire Keene household. There is a question about what type of tax hikes have been already priced into equities. Julian, do you see it at all?
We feel that there is an element of the corporate tax rate rising, probably to the mid-20s. We don't think that capital gains taxes are fully priced. And frankly, when we look at it, we're getting defensive on large cap tech in here as a tactical trade, simply because those are where the majority of capital gains lie looking out the last 4 years. And I think it's a reason why you're seeing these selected reactions post earnings.
Interesting. Alphabet being one of those selected outcomes. Julian, good to catch up, sir. Always good to see you. Julian Emanuel, BTIG Chief Equity and Derivative Strategy. Bringing up copper on the LME. On the LME, copper, 98.13, the high of the previous cycle, 10.160, Tom. So just off all-time highs on the copper on the London Metal Exchange, where we topped out at the end of that commodity super cycle going into the end of 2010, early 2011, 2012.
And John, I really want to mention that, I've done a lot of technical work here on the Bloomberg Commodity Index, which is actually pretty good math. And I guess you can sort of call bear market breakout on commodities, but I don't hear that from all that many of our commodity guests.
What I hear a lot of, Tom, and we've heard it much less so recently, is the supercycle story. Now, as you know well, being familiar with how the supercycle played out last time, I remember covering the bust and spending a lot of time talking to the miners in London who had brought on way too much capacity, invested too much money in digging too many holes. That's not the story this time around. And I think more broadly, will the higher demand be met with higher supply, Lisa? It's not as simple for a mining company, of course. You have to make those decisions well ahead of time. And I don't think think they're going to commit to this in quite the same way they did in the previous cycle.
Which is exactly the reason why Jeff Curry and his compatriots at Goldman Sachs and at UBS are saying that there is a lot more room to run for this commodity cycle because of exactly that. There is more discipline on some of the miner sides as well as some of the shale and oil producers.
Copper just a little bit softer over on the London Metal Exchange. Coming up in the next hour, Dan Skelly, Morgan Stanley, Market Research and Strategy. Looking forward to that. Futures up 5 on the S&P. We advanced a little more than 0.1%. Julian Emmanuel calling today what could be the most important day for markets of the year. This is Bloomberg.
Which is exactly the reason why Jeff Curry and his compatriots at Goldman Sachs and at UBS are saying that there is a lot more room to run for this commodity.
With the First Word News, I'm Rishka Gupta. Tonight, President Biden will unveil a $1.8 trillion plan to expand educational opportunities and childcare for families. It will be paid for in part by the largest tax hikes on wealthy Americans in decades. Amongst the legislation's provisions, pre-kindergarten and community college would be free and the child tax credit would be extended. Meanwhile, fund managers would lose their carried interest tax provision and the top tax rate for individuals would go back to 39.6%. Fed Chair Jerome Powell is expected to maintain aggressive support for the economy. Fed policymakers wrap up a two-day meeting today. They're all but certain to hold interest rates near zero. They're also expected to repeat a pledge to keep buying bonds at that current rate of $120 billion a month. 4 years of political brinkmanship have come to an end. European Union lawmakers gave their approval to the post-Brexit trade agreement with the UK. That ensures that commerce will continue without the chaotic disruption to business a no-deal Brexit once threatened. Still, it doesn't mean an end to hostilities between the two sides. And Deutsche Bank has posted its strongest quarter in 7 years, and it's raised its outlook. Fixed income traders outperformed most of their peers on Wall Street. Income from buying and selling debt securities rose 34%, and Deutsche Bank avoided losses from the collapse of Archegos Capital Management. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're talking about a tax change that would affect, again, the 0.3%, the top sliver of households. The principle here is to equalize the treatment of ordinary income and capital gains.
That's the objective. That was Brian Deese there, National Economic Council Director. You will hear a lot more on this when the President of the United States addresses Congress a little bit later this evening. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here is your price action as we count you down to the opening bow, 2 hours and about 12 minutes away. Equities advance a little more than 1/10% on the S&P. The Nasdaq just a little bit softer, lighter, lower, down 8 on the Nasdaq 100. Yields are higher by a couple of basis points through 164 on 10s going into Chairman Powell's news conference a little bit later. Full coverage, team effort, special programming. Tom Keene leading that a little bit later this afternoon. 164 on 10s. Do you like that, Tom? Euro dollar 120.67. Thank you. Down 0.2%. A weaker euro, a stronger dollar on that currency pair.
The backdrop, John, for this, and we're going to get to Emily here in a moment on the taxes, is, John, we're really beginning to see Jobs Day in May 7. The surveys in Morgan Stanley, well over 1 million jobs created. I mean, John, you wonder if we're going to see all those ramp up here as we go to May 7.
And again, and then we'll do it again and on repeat through the summer. Tom, that's what we need to see quickly. We want to see that unemployment rate come down to maybe a 4 handle by year end. And could we threaten a break below that? That's where the conversation will be in the months to come.
This sort of State of the Union tonight is a boom American economy. We really haven't seen that since the late 1940s. Emily Wilkins on the energy in the room tonight. Emily, what will you expect to see in the room? Are the Republicans going to sit on their hands? Yes. How many Democrats will sit on their hands?
I'm sure Democrats will be up and applauding. I mean, the sentiment throughout the Democratic caucus is that even if you're not on board with exactly everything that the president is proposing, you certainly want to show your support and show unity. But let's remember, it's going to look very different this time. There are only going to be about 200 people in the actual chamber. It's going to be a lot of spacing, a lot of gaps. So definitely a very different energy this year.
Well, okay, I'll take your point on that. And I believe we have just a Supreme Court justice, a Chief Justice attending for the same kind of idea. Emily, which tax do moderate Democrats care about?
I mean, at this point, the biggest push that we have actually seen is about that state and local cap that so many moderates in the House are pushing to have removed. They don't like it there. They're from New York. They're from New Jersey. It's really hurt their constituents. And they're saying that they won't pass a final package unless that SALT cap is removed. And at this point, you haven't seen President Biden touch that cap a lot. It does bring in revenue to the federal government. It does tax the wealthy. Those are both things the administration is looking for right now. But remember, the proposal that President Biden comes off with tonight, that's going to go into the House, and we've already heard from House lawmakers who say that they are going to be changing aspects of that proposal. Top appropriator, very powerful Representative Rosa DeLauro has said that child tax care credit, that's only going to be expanded for a couple years. She wants to make that permanent. Progressives in Congress told me the other week that they want to make sure that there's something in this package that deals with health care, that deals with the high cost of prescription drugs. So look, we are going to see President Biden's proposal come out tonight, but we're also aware that on both sides of the Democratic spectrum, from the moderates to progressives, they aren't 100% on board with this plan, and they want to make sure that changes occur as it goes through the legislative process.
Emily, Lisa has a lot of questions on that, so I'll keep this brief. Just the words of Brian Deese. The principle here is to equalize the treatment of ordinary income and capital gains. Now, they might be able to move closer to that goal. Can they actually achieve that goal?
That's a great question, Jonathan. And yeah, there are a number of Democrats who are sort of looking at that 39.6 number and saying that's a little bit high, but they're going to see how it plays out. You've already seen Senator Joe Manchin of West Virginia, one of the more moderate Democrats, and what some of us jokingly down here refer to as the actual majority leader in the Senate. You've already seen him say that he wants to see these taxes kept low. He's not really jiving with the high numbers that we're seeing from President Biden here.
He's also questioned, Emily, whether the high numbers really matter when it looks at the effective tax rate that companies actually pay. I mean, just looking back to when the tax rate was 35%, data shows that companies only paid 26 to 28%. They paid materially less throughout history based on different loopholes. What kind of discussion is there around what Joe Manchin has suggested, which is close the loopholes, try to make the tax code a little bit more concrete in terms of the actual taxes paid by corporations?
That's definitely a message that Senator Joe Manchin has right now, and it's one that a number of Democrats are listening to. I mean, if they raise these tax rates, it doesn't look good for a number of taxpayers. And then if they're not getting that revenue in, what was the point in the first place? So that's certainly something that Congress is going to continue to take a look at. It really does get into the sort of nuts and bolts. You heard Manchin say, why is this? Why hasn't the federal government gotten as much as they should from these corporations? He's called for an investigation into that. There are other members of the Senate and House who are similarly interested. And I think that's one of those things that we're going to see worked out through legislation. It's just a matter of Congress sort of getting in there, getting into the nuts and bolts of what the president's proposing tonight.
Emily, what's the main opposition to closing these loopholes? Why haven't we heard more on this?
I think that there's always that difficulty when it comes to lobbying groups. There are a lot of lobbying groups out there representing a lot of corporations, and they want to keep some of these loopholes in place. And for lawmakers, it's important to remember what these corporations want to a certain extent, either because they have jobs in their district or because they have these big donations to lawmakers. I mean, Capitol Hill has a lot of people pushing for a lot of different things, and some of these smaller loopholes that aren't going to play well with voters, it's very easy to say, okay, whatever, we'll keep it in there. I don't think the folks back home who vote for me are going to realize one way or another.
Emily, thank you. It's good to see you. Emily Wilkins, Bloomberg Government Reporter on the latest down in D.C. Let me bring you the latest in London, if you'll indulge me just for a minute. We talked about a headline in the previous hour, the Prime Minister facing a formal probe over the refurbishment of his apartment at Downing Street. The Prime Minister responding to those allegations, speaking in Parliament, I paid for the Downing Street refit personally. I will take advice if funding declarations are needed. I have confirmed in full with the ministerial code. People will think it's bizarre to focus on the flat. I have no doubt that people listening right now share that right now. People will think the refit is irrelevant, the Prime Minister goes on to say. He also says, Tom, no laws have been broken over the flat at Downing Street, and he looks forward to the verdict from the Electoral Commission.
Yeah, absolutely. George Osborne emails in on Osborne and Little and suggests, the collection of decorative prints and velvet embroideries offers a modern take on the quintessential English country house. I mean, nothing says 10 Downing Street like Osborne and Little.
The Prime Minister, Lisa, fired up in Prime Minister's Questions over in Westminster, London at the moment. I'm getting reports of that he appears a little bit rattled over all of this.
I'm sure this is not the narrative he really wants right now. He's got to drag this economy out of a really bad recession. He wants to celebrate some of the vaccination efforts, and instead he's talking about the curtains.
The curtains and the flat, and unfortunately so are we on a day where the President addresses Congress a little bit later. The Federal Reserve Chairman delivers a news conference, and we get earnings from one of the most important listed companies on the planet.
But the flat.
Apple, but the flat in Downing Street. We'll talk more on that a little bit later.
And they went through you remember the color code from like 20 years ago, Walmart Blue?
You started this, didn't you?
Walmart Blue, really?
You wanted to go there.
Yeah,
you wanted to go there. Futures on the S&P up 5, on the S&P 500.
He bought Faro and Ball paint.
You reckon?
For the
I think you're probably right, Tom. I mean, just a guess.
The complete Faro and Ball.
Yields up
French
2 basis
gray.
points. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We will invest in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City for our audience worldwide, live on TV and radio, I promise you we will not talk about a flat in Downing Street for the next 10 minutes or so. Equity futures up 4 on the S&P. We advance 0.1%. Doing okay on the Nasdaq, slightly negative. Alphabet, the one to watch, flying up more than 5% in the pre-market. Katie Lyons will run you through the stock movers in just a moment. Talk about a name leveraged to the reopening trade. This in big tech, a $1.5 trillion tech company. That's where the boom is. Switch up the board and get to the bond market. 2s, 10s, 30s. Yields have been pushing higher over the last day. Up through 160 yesterday, up again this morning by a couple of basis points to about 164 on 10s. On 30s, we advanced to about 230, 231. But it's the front end of the yield curve that I think we need to discuss just a little bit more. Tom, I did this for you. I know you're absolutely captivated by it. A 5-year chart of a 2-year yield. Switch up the board. It looks like this. For our audience on radio, it goes up, then it rolls over, and then it loses its heartbeat for the next 12 months or so. And somewhere down there is some price action in the bottom right corner of the chart. Your 2-year yield right now is 0.1759%. The Fed is the elephant at the front end of the yield curve, and right now the market's playing ball. What's going to be interesting for me in the next few months, few quarters, maybe into next year as well, Tom, at some point when the data is surprising to the upside, people start to recalibrate what the Federal Reserve is going to do, and that yield starts to get a heartbeat again, and things start to get a lift. Hasn't happened yet, but that's going to be the one to watch.
And a recalibration of that will be a process or an event, and we will have to see in terms of market stability.
Do you like that, Tom? How we just got along, you know, teed you up, said something back, didn't cut me off. It's truly original.
Great on radio.
Thank you. I appreciate that, and so does our radio audience. Almost 18 basis points on a 2-year yield. Katie Lyons can't wait for this. Romain Bostic, I don't know where Romain is, but Katie, good luck.
Yeah, Romain isn't here for the love fest between you and Tom today, apparently. But, John, you mentioned that Alphabet is flying in pre-market trading. That is absolutely true. The stock is higher by more than 5%. Blew past expectations when it comes to revenue in the first quarter. You can thank Google's ad business. As the economy reopens, businesses are ramping up their digital advertising spending, trying to attract those consumers. Also, $50 billion share buyback. That's not hurting the stock this morning either. I would note Facebook hasn't reported yet. That is due after the bell today. But those better ad trends from Google are lifting sentiment for that stock as well. It's higher by about 2%. You do have Microsoft moving to the downside, though. Forget record quarterly revenue. Forget the 9th in a row beat on earnings. That is just not good enough in this earnings season, given how high expectations were. That stock is lower by 2%. But getting absolutely pummeled in pre-market trading is Pinterest. It's not the first quarter. That wasn't the problem. They beat expectations. It is the outlook. That pulling forward of demand that we saw with Netflix is true for Pinterest. Too, Tom.
You know, I'm so glad you put Pinterest in there. John Farrell, I mean, if Pinterest split, it would be a Dow component.
But Katie brings up such a good point, because pull forward and payback for pull forward is something we saw in Netflix. We saw it with Pinterest. But for other tech companies, we're not seeing it, Katie.
Yeah, it's
other tech companies in the cloud business, we continue to see that acceleration.
Cloud definitely doing strong, but this will be interesting for Facebook too come after those earnings after the bell, John, because maybe ad business doing quite well, but will their user growth be flat like we're hearing from Pinterest in the current quarter? That is something I will be watching. Those shares are down for Pinterest, 11.7% in pre-market trading. We have a number of other earnings movers to keep track of as well. One moving to the upside is AMD, the chip maker. Bullish outlook for the second quarter and raised its 2020 guidance. That stock is up 5%, but another chip stock, Texas Instruments, just had an inline forecast for the second quarter. Again, not good enough this earnings season. That share, those shares down 3%. Starbucks also a little lower. Global comp sales growth just 15%. Analysts were looking for more like 17%. I would note U.S. comp sales growth did beat expectations, and I wonder if people were out at Starbucks using their Visa debit cards to buy their coffee, because Visa saw debit card volume in the U.S. up 31%, Tom. 31% as those stimulus checks hit Americans' bank accounts.
I go in there and get a small black coffee.
I'm a tea drinker myself.
I mean, Lisa, help us here. Are you in there getting the mocha machito?
The mocha
machito.
Mocha machito. Oh yeah, I've got the special mocha machito. You know, I drink the Bloomberg special.
What's the Bloomberg special?
It depends on the day, and it depends when the Tom's
just
making
what you get brought.
Depends on the floor too.
Sauce.
I am caffeine free, as you all know.
I'm not.
Caffeine free.
I have
decaffeinated.
3 cups of
what
coffee.
What does that explain, TK? Indulge me. Come on, tell me.
Kaylee, help me here. Say transitory.
Kaylee, you are allowed to leave.
Can I go next?
Yeah,
you can.
Go ahead.
Kaylee Lyons, thank you.
It's been a transitory experience. Kaylee Lyons, thank you so much for giving
Just
us.
quickly, Satya Nadella of Microsoft with the lead quote in that press release yesterday. Tom, listen to this. Over a year into the pandemic, digital adoption curves aren't slowing down, they're accelerating, and it's just the beginning. That's your lead quote. Can you get any more bullish than that?
Yeah, I think that's a structural change, and that's sort of the issue here. And of course, part of that, John, is a structural market. Dean Kernan nailed the structural change in volatility. We were at 22, 23, 24, and he said, wait, we'll get back to some form of norm at 17 or 18, and we are there. We get an update from Mr. Kernan with Macro Risk Advisors. Dean Kernan, how do we get back to what we remember, 12 or 13 on the VIX?
Yeah, you know, it's time. It's fascinating to look at these cycles, and if you think about, go all the way back to the pre-global financial crisis period, we had a VIX that printed below 10 in late 2006, early 2007. We got to 80 by November 2008, and by December of 2017, we were back at 9, only to hit 80 in March of 2020. So these cycles are long, and it's an eventuality, but as you noted, Tom, we basically had the call that the pandemic destroyed the risk-bearing capital that was effectively allowed to sell options. And so you had a supply shock, and you also had a demand shock. The retail demand for short-dated options was just insatiable. And both of those are starting to sort of reverse, and they're allowing the VIX to settle in. So I don't see 13 or 14, but I do think, 16 or 17 is, I think we'll hang out here for a bit, absent some shock.
Dean Kernan, we mere mortals look at the VIX as a spot price, the present price. What do the future estimates of the VIX tell us?
It's I would say a reasonably normal curve at this point. So typically you have the VIX settling in at a lower level versus 1 month, 2 month, 3 month VIX futures. It's a little bit of a function of supply demand, but it's also a function of very low realized volatility right now. I think something that's fascinating, and you're seeing it in declining volumes. The market's in a little bit of a holding pattern right now. 1 month realized volatility on the S&P is threatening to go below 10, and then jointly, and this would be the first time this would happen post-pandemic, 1 month realized volatility on the TLT at the same time is almost below 10. And that interaction, that combination of volatility in the stock market and the bond market, and then you overlay the correlation of these two, it's actually pretty market friendly right now. So we've got this period where the market's not forcing you to do anything. And what I see in clients who often talk about hedging is they're just not feeling the urgency right now to hedge because the market's not forcing that urgency. And, you'd rather sort of save your premium for a bit of a rainy day. And so I think the challenge for us right now as analysts is to really think about what that set of circumstances is that would catalyze volatility. I don't see it happening right now. I see some problems towards the end of the year, and a lot of it comes back to the conversations you guys are having, which is it transitory, is it not? Is the Fed's kind of catch-up and wait strategy an accident in the making?
Yeah.
I'm worried about the end of the year in terms of the Fed and inflation.
By the way, Dean, I do see Tom Keene taking a drink after you said transitory, so very much on cue. There is a question, though, about what you're talking about. It's very market-friendly. Another way to consolidate what you're saying is it doesn't pay to be bearish or in any way to hedge just being pure risk on. And there is a question of whether all the liquidity in markets have killed off measures of risk in markets. What are you looking for? I mean, are these going to be the first indicators, higher VIX readings, that there is some danger percolating underneath?
Yeah, it's a great point. And boy, I do think the Fed, one of the side effects here of all this policy is the pricing mechanisms that we rely on are certainly distorted and don't give us the same clean signals. I think you can look at something, Lisa, as basic as realized volatility, and that's just simply the day-to-day changes in the S&P. What's the magnitude of them? And I mentioned we're going below 10 in realized volatility. That's basically saying the S&P is moving kind of 0.5%, maybe 60, 70 basis points a day. That's just not enough. So I think that's one. It tends to be the case that market vol events don't just happen out of nowhere. They tend to build. So what we'll have to see is more frequency of 1.5% moves. That'll move the VIX back up to a little past 20. I think we're supposed to as well, of course, watch the 10-year. We've gotten to this period where we hit a holding pattern. We settled in at 160-ish. And as John was referring to before, the action is really not been so much in 10s. It's not that much in 2s. It's really more in the 5-year part of the curve. And I think
what's he doing? Auditioning for the real yield?
Carry on, Dean.
I would love to be on. But no, I think, looking at, for example, something like the 2s 5 spread, I think there's a tremendous amount of information there. And again, the markets effectively said, look, the Fed's promises are still good roughly out to 2023. Past that, we start to get worried. So if you start to see the 2-year sell-off, that's the market effectively really pressing the Fed.
Dean, before you go, received a note from you about a month ago, and I think we're all urging you to get better. And for people who don't know what I'm talking about, Dean, I know you were in a pretty serious accident, jet ski accident, a couple of months back with the family, your 2 sons. Dean, can you update us on that? In your words, my personal VIX hit an all-time high. How are you feeling now?
Yeah, I'm doing a lot better. We did have an accident on a vacation. I'll tell you one thing. So the concept of the PVIX is, we all go through struggles, and one of the things you realize when you're on your back is the amount of help that people are willing to give in the healthcare industry or just generally is tremendous. So thanks to my incredible nurse, my wife Frances, I'm back on my feet, almost, and back in New York. And, really looking forward to the progress from here. And thank goodness my kids are okay as well.
And Dean, looking forward to giving back as well. You do a lot of work with a charity called Macro Minds, and I'd like to give that a shout out right now, Dean, because I'm looking forward to working alongside you in the coming month. Here's a line from you. Kids whose parents went to college are 7 times more likely to go to college themselves. Dean, what can we do about that?
It's tough. I think it's a kind of pick up a shovel and get in motion. Obviously the government's trying to do a lot, but I think it starts from the ground up, and it's just really trying to make an impact locally. I do think that unfortunately, the education shortfall has always been more of a systemic, self-reinforcing idea, but the pandemic has made it just so much more difficult. I mean, I think as parents, we've all seen our kids struggle through Zoom and class every other day. If you started with less, it's just that much more difficult.
Dean,
so just trying to push back on that.
Recovering and giving back. You're a good man, and too many people on Wall Street get a bad rap. Dean Kernett, Macro Risk Advisors CEO from New York City. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. President Biden goes before a joint session of Congress tonight to try to sell his historic spending plan. The president wants money for childcare, universal pre-kindergarten, and tuition-free community college. He plans to pay for it with tax hikes aimed at high-income earners. Republicans already have announced their opposition, and some progressives are calling on the president to do more. President Biden's plan would do away with private equity's most lucrative tax break. Fund managers rely especially on a share of the appreciation in the assets they oversee. That's known as carried interest. Those profits have been taxed as capital gains. That tax break would go away under the president's plan. He also wants to raise the top rate on capital gains. Saudi Arabia is in talks to sell a 1% stake in Saudi Aramco to what's described as a leading global energy company. The sale could be worth about $19 billion. According to Crown Prince Mohammed bin Salman, the kingdom is looking at a deal as a way to lock in customer demand for the country's oil. Investors weren't satisfied with Microsoft's quarterly report. Sales and profit beat estimates for the ninth time in a row, boosted by rising demand for cloud computing services, but shares lower pre-market. Some analysts say recent gains in Microsoft stock had led to swollen expectations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I can do as a leader of this organization.
Right now, mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, the party, makeup will bounce back.
We need better public policy, and we need companies to step up.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Apple's a company that's been a master of supply chain over the years and has continued to look for ways to diversify the supply chain. As best we can tell, demand remains robust across product lines and across geographies. We're again expecting 20% plus growth across, really all the product lines as we move into this quarter.
Apple reporting after the close later today. Will Power, their Baird senior research analyst from New York City this morning. Good morning. Alongside Lisa Bravitz, Tom Keene, I'm Jonathan Ferro. Here's your equity market price action this Wednesday morning. On the S&P 500, equity futures going absolutely nowhere. Yields higher by a single basis point on a 10-year to 163.42. Euro dollar negative by a little more than a tenth of 1%, 120.73, and crude positive, $63 and about 56 cents. We advance a single percentage point almost, Tom, going into the Fed a little bit later this afternoon.
An important conversation, John, and what we try to do at Bloomberg Surveillance is to do earnings and do corporate analysis differently. We spend a lot of time on the financials and less on the product. Amit Daryanani at Evercore ISI is truly one of the Uber bulls on the street. His price target to get your attention this morning is up 30%. Amit, thank you so much for joining us. How do you get to such a bullish stance? Is it about their ability to persist in creating free cash flow?
Yeah, thanks for having me. Fundamentally, yes. Our take on Apple has always been, this at the end of the day is much closer to a consumer staple company like a Coke or a Pepsi or a Procter & Gamble, or a luxury goods company for that matter. And if you look at those assets, consumer staple luxury goods, those assets can be traded in a 27 to 30 times free cash flow multiple, versus Apple that trades around 21 times today. And so our price target is really driven by the fact that we think that valuation gap will close as people appreciate the fact that Apple is less of a hardware tech company, more of a consumer staple company.
I mean, what do your conversations with the buy side sound like right now?
I think at this point, investors are kind of caught in between two dynamics, if you may. The near-term stuff is numbers are poised to be very good in the near term. Estimates should be really good for March and June. The flip side of it, the longer-term concern, I think, should become as you get into the back half of the year, really September and then December, compare start to get difficult. And that's, I think, the angst investors have, which is how can the stock keep working when the compare start to get difficult in the next, call it, 9 months.
In addition to that, Amit, it's the margin story. If you get the product mix shifting, as you point out, away from the iPhone, do the margins hold up? Do they?
They should, right? If you look at the services gross margins, they tend to run very consistent in the high 60s kind of range. Product is in the low 30s. So to the extent you believe the narrative is about monetization of the install base, which we think it is, then gross margins should steadily keep walking higher, which also means free cash flow should steadily keep improving for them.
There was a time when people were looking to services as a potential ongoing cash stream for Apple, especially if they do not come out with new revolutionary products. Has that narrative shifted, Amit?
So I think services continues to surprise folks, right, in terms of the growth it's had. So I think the faith in services doing 20% growth has been there. I do think the incremental part that's come out in the last 2 years is an appreciation that the wearables business, which is another $40 billion revenue stream that they're on track to have, is going to keep doing well. So I think we've had a little bit of diversity of the monetization install base. It's services plus it's wearables as we go forward. And I would say there's incremental excitement, cautious excitement on new products, especially around Apple Car and AR/VR headsets that you could see in the next couple of years from Apple.
In the meantime, though, they are struggling with the supply chain disruptions that a lot of companies have been. Are you expecting them to detail at all the steps that they're taking, perhaps giving more details around that $430 billion spending plan in the United States to try to shore up their supply chain?
To your point, everyone that has reported so far has talked about some of the problems with the supply chain and component availability, logistics costs, and so on. Apple is not going to be a whole lot of different. The only thing I would kind of point out and say is, listen, Apple is typically the biggest customer any semiconductor company has. They procure between 8 to 14% of semiconductors components in a given year. So they are big, which means they will get more than their fair share of allocation. So I'd be surprised if Apple gets on a call and says, we couldn't hit delivery schedules because we didn't have product. I think they'll be fine from that front. I do think they'll talk a lot about what the investments in North America mean, what supply chain diversity especially for them overtime limits. I do think they'll talk about all that, but I do think their scale will provide and shield them from some of the issues they'll heard from other companies.
Tell me about the price target. You're way out in front of the street. How far behind is the street from where you are, Amit?
Oh boy. Listen, I think the street tends to focus on iPhone cycles, hyper-focus on iPhone cycles, I would argue, and less appreciate sometimes the monetization narrative that Apple really has, which means people get exceptionally bullish when you are going through a good iPhone cycle like the iPhone 12, and they get somewhat more tepid after you go past that, right? And I do think that's the wall of worry people have to go through. I think in our stance, our take is this is not about iPhone cycles, this is about monetization over time.
Amit, we've got to leave it there. Always great to catch up with you, sir. Amit Daryanani, Evercore ISI Senior Managing Director, and together with Dan Ives, the most bullish on the street.
Yeah.
175 the price target over at Evercore. Likewise at Wedbush, the median price target over the next 12 months, 151. Of the analyst community, Tom, 32 buys, 9 holds, 3 sells.
Well, this is an important thing. I take these price targets very seriously because it's really what these guys are compensated on. And I would note Tyler Radke moments ago to $310 on Microsoft. So Citigroup, John, has a 20% plus a 22% lift in Microsoft to their price target, as we saw Amit with a 30% plus lift at Apple.
Shall I repeat that line from Satya Nadella of Microsoft? Over a year into the pandemic, digital adoption curves aren't slowing down, they're accelerating, and it's just the beginning. Lisa, that is a bullish line in that press release.
And it's borne out by reality. I mean, look, even if people go back to the office, listen, how about kids that have been home for the past year working remotely? You think they're going to give up their newfound love of screens and their newfound permissiveness by their parents who are absolutely looking for anything to
occupy them?
Why are you looking at me
like that,
I'm just
Lisa?
saying,
you're
theoretically.
Lisa, you're looking at me. I see you looking at me.
I'm just saying.
Tom feels seen.
It's not just you. It's literally every parent out there. And the kids reshaping their feeling for screens, that goes to a bigger bill, and Apple reaps the benefit.
What do you make of these return-to-work plans, Lisa, from the various banks? They're slowly starting to drip out ahead of the summer.
The bifurcation between the U.S. and European banks, I find fascinating.
Yeah.
U.S. banks saying get back to the office, we expect you here. European banks saying work from home is the new reality, and we're cutting office space.
Do you know what I love about that? Yes, it's the last bit. We're going to do this for you. Oh, and we're going to cut the office space.
Well,
in other words, the European banks have seen a gap here to cut costs. But we're doing this for you.
Yes.
Of course.
Where do you think we're going to be in a year? Seriously, where are we going to be in a year?
I don't know. I think we're going to be more surprised by how quickly things go back to normal than by how much has changed.
I am in that camp.
I would agree as well.
Dan Skelly, Morgan Stanley, Head of Equity Model Portfolios, as I take a couple of minutes just to digest and process the fact that we all agreed on something. So maybe we're definitely wrong. This is Bloomberg.
Let's agree on that.
can just scan all the incoming mail, all the incoming luggages, it's going to be a massive time saver. And it means that we can capture a lot more of the illegal wildlife trade that's currently going undetected.
So our focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
If you can just scan all the incoming mail, all the incoming luggages, it's going to be a massive time saver. And it means that
this is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
To tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Wednesday, the Fed decides. The Fed is on hold, waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solution.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Wednesday, the Fed decides. The Fed is on hold.
As things normalize, you're going to see a shift back towards services, and that means taking some of the pressure off the goods sector.
The amount of liquidity that's out there, $4 trillion plus in money markets, savings rates near all-time highs, all of these augur well for the continuation of the bull market.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
It will be, I think, temporary inflation for the course of the next 12 to 18 months.
The good news is long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Julian Emanuel calls it the most important day of 2021. We are thrilled you're with us for the conversation at hand. And, John, what we heard there in the opening montage was the optimism of the haves. President Biden tonight is going to talk about the rest of America.
An address and a $1.8 trillion aid plan for families in America, the United States of America, and a big change down in Washington, D.C. But as Lisa has repeated through the morning, again and again and again, this is a lot of multi-trillion-dollar plans piling up, Tom. Their proposals, can they be executed? Can they be passed?
The polarity here is absolutely remarkable. We talk about boom Microsoft, boom Google, boom Apple. And yes, the markets, John, you mentioned the shock of where we are in late April versus the beginning of the year. And yet the rest of America really has a labor struggle.
We're up more than 5% on the S&P 500. We've hardly talked about it. We're up more than 30% on Alphabet year to date. We've hardly talked about it. There is a cyclical story embedded in big tech. We've hardly talked about it, and you saw that in the Alphabet numbers. But that's the story. Main Street versus Wall Street. Wall Street's had a great 12 months. Now the conversation shifts to Main Street and what's going to happen with labor costs. What's going to happen with the costs elsewhere, inflation, raw materials, transportation. That's where things get interesting for me from a market's perspective. How do you get exposure, leverage, the reopening, and a cyclical upturn with all of this going on around you?
All of this going around you, this most important day of the year. We welcome you on radio and TV right through to David Weston tonight in the President's address. And Lisa Abramowitz, what is so important here is not so much the politics of Washington, but how you get Main Street back and linked with Wall Street.
And that's what a lot of people are focusing now. And people are saying that for a long time, markets outperformed Main Street, outperformed the fundamental economy. And perhaps we're shifting into a period of time where it'll be the opposite. And we've heard that from a number of people. Yet what does that look like when you see the profits that we're seeing out of the likes of Microsoft, out of the likes of Alphabet?
Now, it's going to be interesting to see. John, I want to go to the data. Instead of doing a full data check, a little bit of red on the screen, dead in the water, we do have a modest lift in yields. Why, John?
Through 160. We've talked about the auctions through the week. A couple of tricky ones so far on the supply side of the story. Going into the Fed, yields get a lift. We're through 160. Right now, we're up another basis point to 163.60. I just can't believe how little we've talked about the Federal Reserve over the last 2 hours on this program.
Well,
we have a Fed decision and Chairman Powell news conference.
Let's go to the why of that right now as we go to 2 p.m. this afternoon with a great lineup of guests. John, are we just waiting for June?
Message received. Message received. Everybody seems to understand the message from the Federal Reserve, and yes, I think we're waiting for June when we get a new set of forecasts. And what's fascinating about that is we often wait for a new set of forecasts, but this is the Federal Reserve telling you they're no longer dependent on the forecast. So why are we waiting for the June meeting at a new set of forecasts?
I will have to see, but what I like there is the view forward, John, and how you partition this on radio and TV. We've had a lot of different conversations, many of them optimistic, and Daniel Skelly joins us now with Morgan Stanley Wealth Management, their head of market research and strategy. And Dan, I really want to cut to your beautiful note where you say you need courage to look out 2 to 3 years. How do I get from the panic of 2021 and look out to 2024 or 5?
Yeah, that's really interesting viewpoint today, Tom, because when you think about it, Morgan Stanley is trying to distinguish between its long-term view, 2 to 3 years out, and its short-term view. And as you know, we're a little tactically cautious here in the short term, given how far markets have moved and given we may be lapsing some of these peak rate of change on earnings and policy, et cetera. But to your point, when I look out 2 to 3 years, I'm extremely optimistic. There are several mega trends here that will probably make this cycle hotter for the next several years, including a very powerful consumer rebound that goes on, talking about pent-up demand for services, including digital investments, which is really one of the main takeaways from the COVID experience. It was a massive digital wake-up call. So we're going to see investment in technology through many sectors. That's going to be a boom to the economy going out. And then lastly, it's all about demographics. We're actually going into a bullish time in terms of demographic shifts where the millennials, who are now a bigger part of the population than the boomers, are reaching their peak earnings in investing years, and that's going to drive flows.
Dan, let's pick up on a couple of pieces. The first one, peak rate of change. This cycle is so unique and so different that we're seeing peak rate of change right at the beginning of the recovery. Just because of the nature of the slowdown, it was mandated reopening mechanical pop back. Why is rate of change so important still, given how unique this cycle is?
Yeah, so everything is happening just faster, Jonathan, to your point. And so looking back at previous cycles, this recovery is happening twice as fast, to your point. And so that's certainly running up against some headwinds now in terms of earnings rate of change. When I look at just earnings season thus far, and we heard a mixed bag overnight, some reported above expectations, some below. When I look at earnings thus far, we're halfway through. Over 80% of companies have reported beats, and yet the average stock reaction on the day of report is down 20 basis points. So why is it important? It's important because we're up 80% off the March 23, 2020 lows, and it simply means that we could be due for a little bit of a pause here. It doesn't mean we're diverging from the longer-term bull market, to be clear.
There's an issue that you and Mike Wilson and the team have brought up repeatedly, and that's execution risk on the cost side. Labour markets tightening up, maybe harder to hire, harder to meet that demand with supply. Yesterday, what we saw from big tech was a cyclical story embedded in those big names that we haven't discussed enough. Dan, is that going to be the cleaner way to leverage the cyclical trade without the worries about higher costs?
Yeah, that is an interesting way of looking at it, Jonathan. We are certainly actively looking at tech and being selective in some of the growth space. And as we've talked about in the past, we're going to do more outside our houses finally this year, but we're never going back to 2019. And you're already hearing big financial companies talk about hybrid models, how much time they allocate in the office, and what that's going to do, frankly, for the demand for cloud, digital services. So, kind of looping back to your original question, we see these trends going on for several years. There is some cyclicality embedded, particularly in the advertising leverage names. And that's what you saw, over the last 24 hours. And so we do think that's a opportunistic thing to play.
On the flip side, do you think that the underperformance of the Russell 2000, of the classic small caps, which has been the traditional cyclical play, that underperformance will continue?
We do, and we saw, Mike Wilson, our strategist, downgrade small caps going back over a month ago. A well-timed move after being quite bullish for a year. And to Jonathan's point earlier, small caps, smaller companies are one of the areas that really acutely feel the cost pressures and have limited ways of offsetting those cost pressures. So yes, we do see small caps continuing to struggle here near term as things adjust. And we want to also, in the overall equity portfolio, move up to quality and focus on those companies that have pricing power and are going to be able to pass on those costs to customers.
When you talk about cost pressures, and you talk about a hot cycle over the next 2 years, yes, perhaps shorter than past, but still very hot relative to what we have seen, does that cohere with an inflation break-even rate right now that I'm looking at over the next 2 years of 2.66%? Over 5 to 10 years of 2.3%. These are not astronomical figures, albeit some of the highest levels that we've seen in years.
Yeah, absolutely. And I think that's a function of just the complacency and a little bit of the lull that has set in for investors following the last cycle. I think there's some key differences between this cycle and last. I think you're going to see that manifested in the labor markets. We're seeing drastic labor supply shortages. You're going to see that play out in geopolitics, which has certainly diverged since 2008, 2009. And you're seeing the ramifications of some political and trade dynamics in chips and technology. That's causing inflation in certain areas. And so things are different. I think the biggest takeaway, really, why this time is different and why that number might be too low is fiscal, right? And you're going to hear more tonight, as we've talked about potentially more spending. We'll see if there's the math and the support for that in the Congress later on. But nonetheless, we see fiscal leading to higher inflation.
Daniel Scully, out 2 to 3 years, have you seen use of cash change? Do you see a corporate behavior that actually changed use of cash? I don't see it with Google.
You're seeing the ramifications. Yeah, that's true. You're seeing more of the buyback trend that had defined the last cycle. Let's see what happens with capital gains and taxes, Tom. What happens with the treatment of dividends? Do dividends become a more attractive source of capital return going forward if they're somewhat more insulated in terms of the capital gains tax issues? So, I tend to agree with you. I think some of these really big companies have tremendous cash forwards, and we're going to hear more from the banks, frankly, later this year as they continue to see reserve releases and earnings improve. They're going to be buying back more stock. So I think it's a combination of a lot of the things we've been seeing. Yeah, that's true. You're seeing more of the...
Dan is going to catch up. Dan Skelly, Morgan Stanley Wealth Management Head of Market Research and Strategy. Tom used to cash a $50 billion buyback over at Alphabet and tons more over at Apple over the last decade.
Yeah, I just did, John, and you can do this on the Bloomberg, folks. We have this huge advantage we feel within financial TV worldwide and radio worldwide, in that we're all working on the Bloomberg while we're talking here. John, if Apple got back to where they were on their balance sheet of cash, they need to find how to spend $25 billion fast.
And I think they know the best way of doing that, don't they? Because we've seen that repeatedly over the last several years.
That's a huge number. That's an unimaginable number. They need to figure out a delta of $25 billion today to figure out how to get back to a comfortable cash rate.
Do you want another big number from Morgan Stanley? 1.25 million. That's the estimate for payrolls. You brought up payrolls a little bit earlier. Yeah. May 7th, payrolls, 1.25 million is their estimate. Right now, the median, 900K.
And Lisa, I think this is so important. We're going out to Michael Feroli's. We're going to find 7 million employed here through the summer.
Is this substantial progress? Does this count for Jay Powell? Will he address that?
We'll find out with special coverage a little bit later on TV and radio. You're staying late today, TK. Looking forward to the show. Equity futures 41.79. Unchanged on the S&P.
He's speechless.
He's so upset now. You got a late afternoon, Tom. I'm looking forward to the show. I really am.
What about the surveillance now?
You can take it in the pantry. Futures unchanged. Isaac Boltanski coming up next. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Tonight, President Biden will unveil a $1.8 trillion plan to expand educational opportunities and childcare for families. It will be paid for in part by the largest tax hikes on wealthy Americans in decades. Amongst the legislation's provisions, pre-kindergarten and community college would be free, and the child tax credit would be extended. Meanwhile, fund managers would lose their carried interest tax provision, and the top tax rate for individuals would go back to 39.6%. Fed Chair Jerome Powell is expected to maintain aggressive support for the economy. Fed policymakers wrap up a two-day meeting today. They're all but certain to hold interest rates near zero. They're also expected to repeat a pledge to keep buying bonds at the current pace of $120 billion per month. And Boeing burned more cash than expected in the first quarter, about $3.7 billion. The jet maker is still recovering from the pandemic. In March, Boeing resumed deliveries of the 787, and it hopes to boost the 737 production in early 2022. Deutsche Bank is working on plans to allow staff to work from home up to 3 days a week. That would be one of the most flexible return-to-office policies amongst large international banks. Deutsche Bank has repeatedly said it wants to cut costs by reducing office space. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
With more vulnerabilities need to be supported for the benefit of the world.
Part of the healthy aspect of the debate going on in Washington right now is that there is an element of both Democrats and Republicans that think that the spending proposals may be a tad too aggressive and that we have to do it in a more reasoned way. But again, the countervailing point to that is if we start raising taxes, that itself is also a self-fulfilling prophecy.
Julian Emanuel, BTIG Chief Equity and Derivative Strategist, calling today possibly the most important day for markets in 2021. An address from the President of the United States in front of Congress, a Federal Reserve news conference later, and a proposal from the President for a $1.8 trillion family aid plan. Throw in some Apple earnings too. Here's the price action this Wednesday morning. Good morning to you all. Alongside Tom Keene, Lisa Abramowitz, Jonathan Ferro. Equities not even up by a point. Up a quarter of 1 point on the S&P 500. In the bond market, yields up a single basis point to 163.42. Euro dollar negative to 120.68 and down 0.2%. The focus without a doubt on Cupertino, California and Washington, D.C.
Oh, it is. It's going to be on Apple. It's going to be interesting to see. And, you know, we saw it with Google yesterday. There's a lot of optimism here, a summary that maybe things will look out better, but the nuance will be in the call. Right now in Washington, Isaac Boltansky with us with Compass Point with a very sharp note. And he really, I love the phrase, Isaac, from rhetoric to reality. The idea that we're loaded with rhetoric tonight. When does the reality click in? 11 p.m. tonight, or do we have to wait 11 weeks?
I would argue it's already starting to click in, and at least that's my takeaway from investor calls. You know, what we're going to get tonight, Tom, is an incredibly ambitious and expansive proposal that would, you know, intended to remake our economy in a way that we haven't seen since the Great Society under LBJ. But the reality is, it's not going to happen. And one of my favorite lines, and the one that I think we should keep in mind as we listen to the president speak, is the president proposes, but Congress disposes. And really the question for investors remains, what will Congress agree to? And the subtext there is, what will the centrist Democrats in the Senate allow?
Okay, but I want to go out to your climb of Ohio Wesleyan University. I mean, they've got to sell this thing out where maybe the election is actually pretty close as well. How do the moderate Democrats around the acreage of Ohio Wesleyan adapt to their president and to their liberal wing?
One of my favorite lines, and the one that I think we should keep in mind. I think that the main point there is that, and this is, I think, an important timing point to highlight, is that Infrastructure Week is going to last another 5 months or so, Tom. It's going to be iterative. It's going to be time-consuming. It will include myriad bruising fights over really detailed and nuanced policy issues, from like-kind exchanges all the way to stepped-up basis. It's going to take another, I think, 5 months, most likely until September or October, to get something done. But my view is that there is a window of both political and legislative opportunity that Democrats will seize on, and that we will get something. We're not going to get what the president calls for tonight, but we will get something of significance.
Isaac, given your experience in Washington, D.C., what is likely between the $2.3 trillion infrastructure spending, the $1.8 trillion American Families Plan? What's realistic?
Look, I think that right now we should focus on physical infrastructure. I think that clearly has a considerable amount of support on Capitol Hill. I think there's actually bipartisan negotiation now, even though I wouldn't bet on that. I still think that we have to go through reconciliation. So I think we should focus on physical infrastructure. And then on the tax side, here's my framework. Anything that's seen as narrowing the gap between wealth and work has a likelihood of being included in the final package because it dovetails with the Democratic economic fairness agenda. So here I'm talking about the higher tax bracket, I'm talking about the increase in capital gains, and I'm talking about the end of stepped-up basis.
Well, let's put some numbers on that. Equalizing the treatment of earnings in capital gains. The band is quite wide, the spread is quite wide right now. Isaac, how narrow do you expect the spread to get? What kind of numbers are you thinking about?
Yeah, look, I think that anything that we hear tonight should always be viewed as a negotiating marker, not a red line. And I think the White House has been clear about that. So we will not see a capital gains rate of 43%. I think that ultimately that will be negotiated down to something closer to the 28 to 30% range. I think there are a number of reasons for that. We have the centrist Democrats, but also I think there's an awareness that we want to incentivize long-term investment. Furthermore, there's an equilibrium where if you raise it too high, no one wants to sell. And so I really think it's fair to assume 28 to 30% on that end, again, for the highest earner.
Well, let me just add an additional question in then, Isaac, because what they're trying to achieve is to close that carried interest loophole as well. And from what I can tell, and you tell me if your interpretation is different, that they're trying to do that by equalising the treatment of capital gains and wages, and the end outcome would be closing that loophole. Now, if they can't equalise that, can they just close the loophole by doing something else? And do you think they should do that?
Yeah, I think you hit the nail on the head. And it's highlighted in the fact sheet here. Their focus is really on capital income broadly. And so capital gains and dividends, by the way, were included. And if we just talked about increasing that threshold and ending stepped-up basis, you really handle the carried interest issue in its own right. Now, I'm telling you, I don't think that they get all the way to treating as ordinary income. So there will be a focus on a more narrow fix to carried interest as well. I think this time Democrats are finally prepared to close that, especially with the overarching changes to the rate for capital gains. And again, I can't underscore how important it is, the end of the stepped-up basis.
Isaac, great to catch up. Good to hear from you. Isaac Boltanski, taking the realist approach to the situation down in Washington, D.C. Tom, what we'll hear later, a proposal, not necessarily going to be the thing that gets done.
John, I admire that you get into the nitty-gritty there. I was scarred forever, and I think it was 1978 where I actually sat down and read the entire, I believe it was the Tax Reform Act of 1978, and realized 6 months later that was the dumbest waste of time I ever did. Because all this stuff is malleable and changes, and I avoid the nitty-gritty as much as I can. It was good to hear that on, the carried interest.
There's clearly a broader philosophy here, Lisa, whether it's achievable or whether you take some steps towards achieving that broader philosophy. Maybe that's the ultimate goal.
The idea here that the $1.8 trillion plan that President Biden is going to lay out today includes $800 billion of tax cuts and credits for middle and lower income individuals while hiking taxes on the upper income, talking about the redistribution of wealth. That is what this plan sets to lay out.
Guys,
that's what it's setting out.
The broader plan here is to get reelected and to keep the House Democratic in November of 2022.
So what's new? It's
John,
always
that's
Operation Re-election. I agree with you. It's always Operation Re-election, and the risk is that they overstep their mark.
Well, and
they outreached a little bit too much.
And I wonder how much adding on this $1.8 trillion plan so soon after the $2.3 trillion proposal actually helps them get that through, or actually
Lisa,
undermine some of those efforts.
Well taken. Just the back-to-back here. But, John, over the weekend, I believe I saw the difference is like 5 seats in the House.
Yeah.
That's nothing.
Skinny margins, looking to do really, really big things. And ultimately, as you point out, Tom, what's important, not how this plays out in D.C., how does the electorate feel about it?
The good news is David Weston is not as cynical as we are.
I'm looking forward to the coverage later. Tom Keene, you're so fired up this week. From a man in cash, very, very agitated about capital gains.
I am.
there's renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine. Are dependent on those vaccines, so questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is...
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. Access the financial world on demand. Hear from leading economists, policymakers.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
60 minutes away from the opening bell in New York City. Your equity market shaping up as follows. Futures unchanged on the S&P 500, 41.79 on the Nasdaq, down by about 0.1%. Alphabet absolutely flying. The cyclical story embedded in big tech, not talked about enough. The market gets it. Alphabet up by more than 30% going into the earnings, coming out of the earnings up another 5%. The cyclical side of the story, ad spending nice, cloud revenue good. Later, Apple. Switch up the board in the bond market, 2s, 10s, 30s. This is how we shape up. Your yield up about a basis point on a 10-year to 164. Let's call it 164 or 163.78. 30s at about 230, 230.51 to be precise. We're still grappling with how quickly this cycle is moving. Think about a beach ball, pumped up with low interest rates and stimulus and fiscal relief as well, held beneath the water, a mandated slowdown in America. You remove the hand, the ball goes flying. And that's the story in this economy as we snap back. What does it mean? Switch up the board for commodities. It means copper absolutely flying. What I wanted to bring you is just to think about where we've been over the last 10 years. At the top of the last cycle, 2010, 2011, early 2011, we saw 10.160 on copper. Right now, 98.24. The difference between now and then, just thinking about the people who had to take over at Rio, Sam Walsh, Jean-Sebastian Jacques, Rio Tinto, taking hold of way too much volume and capacity in the bust after the big super cycle that China fueled. This time around, the leadership of the likes of Rio, BHP, Anglo, those big global miners listed in London are going to be so reluctant to add capacity.
Sounds like a
and that's why so many people
are so
much bullish on copper going forward from here. I can't keep a straight face. I'd love to do LME Week later this year. Wouldn't you like to do that, Tom?
I would love to do that.
Wouldn't that be awesome?
I was over there years ago, and, we were in the bar, we had little umbrellas and the drinks and all that.
Should we explain what LME Week is?
LME Week is just,
together.
It's like where everybody gets together. And what's great about this, folks, is it's not that it's one big party, but seriously, John, it's a lot of really, really intelligent people whose idea of short term is 10 years.
So the way it used to go is that Cadolco would come, Chile would talk about selling copper prices, Tom. The way it's changed over the years is that the brokers used to take up an individual hotel on Park Lane in Mayfair, as you remember, and you'd go from hotel to hotel, from broker to broker, just to see what was going on in the world of metals and mining in London. I understand the parties aren't what they were, and of course I'm not sure it even happened last year, Tom, but I'd love to see some of that stuff come back. Just bring some life back to the city again.
Yeah, it may come back to bring life back to global Wall Street as it is. We welcome all of you. You heard Julian Emanuel call this the most important day of the year, and we have been remiss to look at our economic data. Michael McKee joins us now as he prepares for his important press conference this afternoon with the chairman, and he has some of the tea leaves here. Michael, start with the trade balance. I care, don't I?
You care. It's very interesting that as we recover, we seem to be buying a lot more stuff from overseas. We don't have a complete breakdown, but the initial numbers for the March advanced trade goods deficit, $90.6 billion, and that's notable because that is the largest U.S. monthly trade deficit ever for the month of March. It's definitely going to subtract from second quarter growth.
What's it mean for twin deficits before we get to inventories? I mean, is this something that guys like you, it's on your radar to worry about the combination of our fiscal debt, the speech tonight, and also this record trade level?
Well, there's a lot going on, and the person I'd hate to be today is the Forex strategist, because how do you combine the idea of a massive stimulus that in theory should boost U.S. growth on the dollar and this huge trade deficit? So it's going to be interesting for them to try to figure out what's going on. Exports were up 8.7% during the month of March, but imports up 7.6%. These are big percentage changes historically.
Lisa, that number I've never framed in my brain, let alone seen. A negative 90.6 is jaw-dropping.
And the idea here is that some of the stimulus money that U.S. households received ended up going overseas as people tried to pack their inventories with new cars and all sorts of toilet paper and toilet paper products. There is a question, though, Michael McKee, as you sit in Fed Chair Jay Powell's press conference virtually today. Is there anything that could come of this meeting that truly will be groundbreaking for Wall Street?
Probably not, because, for two reasons. One, the Fed knows that whenever they say anything about changing the stance of monetary policy, there's going to be a reaction in the markets, and so they don't want that now. And the second reason is because Joe Biden is speaking tonight about fiscal policy, his big program, and the Fed doesn't want to get drawn into that. So I would expect him to be quite quiet.
Michael, we're among friends here. That's not what we care about. Lisa was alluding to how rude they were last time with you. Are you going to get elevator music again when you ask a question?
I hope not. I think Jay Powell was anxious to call on people and avoid their questions.
Maybe in honor of the passing, the death of Al Schmidt, the giant of music recording, he did the room and created the sound of Africa by Toto. So maybe they'll play Toto when you ask your question today. Michael McKee with a really important question today. Look for that in the press conference with our...
At the very end. Just at the very end.
Leave Michelle's there. Leave him for the end. Leave him for the... We begin with Torsten Slok with Apollo Global Management and their chief economist. Torsten, when you see this data and the historic moment of trade, are you elevating your GDP estimates and lengthening the boom economy?
Well, it is certainly very revealing for how strong the economy is. When imports go up so much, it is certainly, as Lisa was saying, a very strong sign that the stimulus checks have been buying a lot of consumer goods. That's been showing up in trade. We also have, generally speaking, that the economy is getting a lot of tailwind from excess savings in the corporate sector, excess savings in the household sector. And on top of that, the reopening, of course, just continues now with the discussions now just yesterday of the mask mandates changing. So this economy is doing very well. And the numbers this morning on the trade balance just confirms that your picture of the ball underwater that's coming up up is certainly a good analogy. We are seeing an economy that's coming back very strongly.
Well, let's talk about inflation, price pressure. As you pointed out, Torsten, this isn't just base effects. It's too easy to sit here. It's almost lazy just to say it's the base effects. We all know the base effects. It's more than that, isn't it?
It is, and I think this is a very, very important discussion for today, as Mike McKee just was mentioning for the press conference and the Fed. I mean, the Fed will continue to tell the dovish story about the unemployment rate is still 6%. This is just base effects. There is nothing really to worry about here in the near term. We're still waiting for the economy to come back to full capacity, or the unemployment rate to come back to a lower level, which could be around 3.5%, which we were pre-pandemic. But as you're saying, John, if you look at the data for a number of different indicators, not only are inflation expectations going up for the household sector, you're also seeing that it's getting very difficult to find workers. Some companies are now paying workers just to show up for an interview. You're also seeing in a number of different indicators when it comes to the ISM, the regional Fed surveys from the Richmond Fed, from the the Dallas Fed, and the Denver area in particular, but also the Kansas City Fed. They have shown significant pressure, in particular in the manufacturing sector. And all this is pointing to higher input costs. And as you just spoke about copper prices, that makes it more expensive to produce. And the big question is, what happens if input costs go up? The two things can happen. Either margins can get squeezed, or selling prices, meaning inflation, can go up. And we are seeing more signs of this not just being base effects. There is very strong demand in the economy pushing prices higher.
So how is your outlook different to the Federal Reserve's right now, Torsten?
So I think that in the near term, and if I type ECFC Go on my Bloomberg screen and I do the quarterly profile of how does the consensus expect core PCE over the next several quarters, it is quite impressive that the expectation is inflation will go up in the next quarter or two, and then it will come down and be exactly 2 going into the end of this year and into next year. I think the risks are beginning to rise that Larry Summers is right. Or as Olivier Blanchard has been saying, this is not just overheating, there's a risk that this is like starting a fire. So there is a chance that inflation could be overshooting 2%. And the Fed might continue to say, well, that's okay. We have flexible average inflation targeting. We are allowing inflation to overshoot. But the big question is if long rates are also just going to take a relatively relaxed approach to inflation overshooting 2%. So I would say, John, to your question, that the key issue here really is that if inflation does begin to overshoot 2% for an extended period, one does need to look very carefully at how long rates, will long rates just say, okay, that's all right, we accept that? Or will long rates begin to say, well, wait a minute, if I'm a bond investor and I see higher inflation, that erodes my returns, and therefore I need to be compensated for that risk.
What does an inflation fire look like? Not just burning hot, but a fire. I mean, are we heading back to 1970s? When we say that, people scream, no way, we're no way heading back to that. But parse out the new inflation fire.
Yeah, that's a very important question, Lisa. I would say the new inflation fire is very similar to what we had in the late 60s, where inflation gradually went up and it stayed at a relatively elevated level. In this world we live in today, the levels of inflation, of course, are different relative to what we had in the late 60s, from 65 to 1970. But in my book, that would be inflation at or above 2.5 on core PCE, which, as you know, is the Fed's preferred measure of inflation. If we get to those levels, and in particular if we get there just for several months, then I do think that bond investors will really start to become worried. That's not my baseline scenario. I still think that inflation is under control, but we do have a few months here where we could risk some turbulence in credit, in equities, in risky assets because of this issue that rates risks and inflation risks are more elevated. And the final point on this is, have a look on your Bloomberg screen on rates fall. Implied fall in rates is very, very elevated. So the MOVE index, for example, is very elevated relative to, say, VIX, which has just come down. So what is the shock that people are so worried about in rates markets that people in equity markets don't seem to care too much about? Same thing with credit vol. It's also very low. So there is a disconnect between volatility. Implied vol in rates markets is very high relative to how low implied vol actually is in almost all risky assets. And I think that's telling us something about how investors are thinking about the inflation risks for the next several months.
Torsten, really smart. Torsten Slok there, Apollo Global Management Chief Economist. On the story in the American economy right now, to bring you some of those forecasts from the ECFC screen, the median estimate for CPI for the economists that we track here at Bloomberg, 2.6% for 21. Then the drop down to 2.1%. That's what Torsten was getting at here, Tom. That seems to be the view right now, in line with the Federal Reserve. Some doubts raised by Torsten and maybe captured by volatility and rates.
I sort of feel like I felt 12/31/20, John. You know what? There's a consensus. There's a zeitgeist out there, if you will. And boy, has it been wrong in the past. Why is it going to be any different now?
Listen to the corporations.
Exactly. That's exactly what I've been saying is listen to business. They're buying back stock.
Coming up on the Open, we'll continue the conversation. JP Morgan Asset Management CIO Bob Michael joining us. Looking forward to that chat
on the real
a
yield
little bit
as well?
later. I don't know. I'll ask him, Tom. Do you want him to drop by?
I think you could see that.
He might stay at work late, a little bit later on Friday. We'll do the show at 1 p.m.
Somebody earlier was auditioning
What time's the Fed show?
I don't know. My people
starts at 2 p.m.
It starts at 2 p.m. When's it finish, Lisa?
Well, 2:30 is the press conference.
2:30 then.
I think
then Tom carries on until 3:34.
Yeah, we just go across the street
right?
and get a beverage of our choice.
Sleep under your desk.
From New York City, Julian Emmanuel calling today what could be the most important day for markets in 2021. The take from BTIG. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden goes before a joint session of Congress tonight to try to sell his historic spending plan. The president wants money for childcare, universal pre-kindergarten and tuition-free community college. He plans to pay for it with tax hikes aimed at high-income earners. Republicans already have announced their opposition, and some progressives are calling on the president to do more. And President Biden's plan would do away with private equity's most lucrative tax break. Fund managers rely especially on a share of appreciation in the assets they oversee. That's known as carried interest. Those profits have been taxed as capital gains. That tax break would go away under the president's plan. He also wants to raise the top rate on capital gains. The UK is working on a digital coronavirus passport. The British initiative is based on an existing National Health Service app. It will be updated or adapted even to help travellers prove they've had a shot or tested negative for the virus. France is starting to test a tracing app updated to contain records of shots and tests. And Spotify has raised its revenue projection for this year. The leader in music streaming increased subscription prices and attracted more advertising. Price increases for a range of products will take hold in markets including the US and the UK. Global news 24 hours a day on air and on Bloomberg Quick Hits, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year. Almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
All of the inputs are going to go up a great deal in terms of their cost. 16 months of inventory needs to be produced in 12 months to not only satisfy current demand, but to refill the supply pipeline. All of that's going to take place now, and that will cause some delays, and it also will cause prices to go up.
David Balin with Citigroup, really one of our best conversations of the day. Thrilled you could join us for that on radio and TV, and we drive forward the conversation. Now, certainly what has changed, and John's mentioned this off the London Metal Exchange, is commodities, not all commodities, but most commodities lift up, and some of them with a vengeance. Oil off when Lisa was buying at a negative price point, up to $60 a barrel. Now we see it within copper and the surge there, and palladium at a record high the other day. Paul Wallace is one of our most interesting people at Bloomberg News. He's got that romance of him, of jetting around the world in commodities, covering the space for years, and we're thrilled Paul Wallace could join us in Dubai this morning. Paul, from where you sit in the Middle East and in North Africa, is it the beginning of the commodity cycle people have waited and waited and waited for?
Hi, Tom, and thank you for that introduction. Sadly for the Middle East, a lot of people are suggesting, including in this region, that if there is a commodity super cycle, that oil might not be part of it. For various reasons. Metals are obviously flying. Metals have the advantage of sort of being major beneficiaries of the green energy transition because of how they're needed in things like EV batteries and wind turbines. With oil, we've obviously seen a huge rally this year. We're up about 30% for both Brent and WTI, but that's come off the back of huge production cuts by OPEC Plus. And even though they've raised output in the last couple of months, they're still down about 6 million barrels a day or something. And that's, I think, what's going to be key for the rest of the year, just how quickly do the likes of Saudi Arabia and Moscow bring back those spare barrels.
And Paul, this goes to a larger debate within the commodity sector, and just to stay at a 30,000-foot view for a second, this idea that producers are more disciplined this time around. John was talking about that with the copper producers, with the miners, in all levels. They are more disciplined, which means that prices could go that much higher, especially with all of these infrastructure spending plans. Is that consistent with what you've seen, that discipline really remains the presiding sentiment among producers of all sorts of commodities?
It really does. As you mentioned, it seems to be the case with sort of non-oil commodities, but it's also definitely the case with oil at the moment. I mean, you've got OPEC Plus, which is a 23-nation grouping, extremely diverse. You've got everyone from Saudi Arabia to Russia to Iraq to Nigeria to Angola. And these governments all have different needs. I mean, they all need the money because in some way or another their economies took a big hit last year. But the amazing thing is they have managed to stay cohesive for almost a year now since they began their oil production cuts at sort of during the height of the first wave of the pandemic. A lot of people wrote OPEC Plus off. They said it's only a matter of time before the alliance falls apart and every producer just thinks it's free fall and they pump as much as they can. But that's not been the case, chiefly because of what Saudi Arabia and Russia have done. They've managed to keep things together. And as I said, they're holding back about 6 million barrels a day at the moment, which is a lot of lost revenue because obviously revenue is production multiplied by the price. If you cut your production as much as they are, then you're going to take a hit as far as revenue is concerned. So it's been quite impressive as far as OPEC Plus is concerned.
Paul, we talk about this in the context of earnings. Company after company have come out and said that their input costs are surging. Based on your conversations with the producers themselves, both in the shale patch and the oil patch in the Middle East and elsewhere, do you think that these inflationary pressures, these input cost increases, have staying power well beyond what people are certainly counting?
I think so. I think we are getting to that point where certain companies that use a lot of commodities for their for making their products, or countries that are heavy commodity importers, are hurting. And as an example, in the oil market, the most obvious case has been India. In the last few months, India has been speaking out about how oil prices have gone too high too fast, and it's actually criticized Saudi Arabia and effectively blamed Saudi Arabia, saying that it's Saudi Arabia's fault that OPEC Plus is not raising production as quickly as India would like. So I think we are getting to the point where the people who don't, let's say the people in the companies that don't benefit from rising commodity prices are starting to speak out, and that could be something that puts sort of downward pressure on them. I mean, oil has kind of been flat for the last 5-6 weeks, and I think part of that is because importers are under strain.
Paul Wallace, thank you so much. A brief from Dubai, Bloomberg editor for oil, energy, and commodities in the Middle East and Northern Africa as well. It is a most interesting Wednesday. An open question, Lisa Abramovitz, what will you focus on?
Today, I'm curious about Chair Powell. I'm curious how he's going to tee the line between some of these earnings that we get and all that inflationary pressure and this idea that they have the tools to keep it in check and that they will continue to remain incredibly accommodative. I'm also very interested to see what Apple and Facebook have to say and what Apple's going to do with all that cash. You think it's just going to be buybacks, right?
Well, I'm going to go to use of cash, and I don't know what they're going to do. I don't have a clue what they're going to do with it. There's a lot of speculation and rumors on it. We'll wait till we see that, and our team will assist on that. But I'm going to dovetail them, Lisa, and that the boom that we see in big technology and among the prosperous that the president will come up with tonight, I would bet that will be directly addressed by Chairman Powell. He has been press conference after press conference, a growing tone of concern, Lisa, over the Fed's project started in Chicago with President Evans there, with the basic idea of the inequalities and growing inequalities of the nation.
Right. Substantial progress in labor markets. It doesn't just mean a number. It means also equaling out the playing field a bit more, because this pandemic hit the lower income individuals so much harder, and those are typically the individuals who lag behind.
And growing evidence there. I think just in the last number of weeks, Lisa, we were actually talking about this at the dinner table the other night, how the bargain before was the upper decile and the lower decile did well, and that's changed now to where it's just the upper two deciles, say, and the lower decile really hasn't participated in this pandemic.
And we can dovetail that into the conversation about the savings rate and how much excess savings people have. Is it because people receive checks from the government, or is it because wealthier individuals didn't go on vacations and saved all that money? And are they going to be the big spenders if you can only go on so many vacations?
Don't tell Pharaoh, she just nailed it. She just totally nailed it. That was the best slide. That was the best slide. Yeah, the mics really worked, folks.
Yeah, exactly.
That was the best slide in Peter Hooper's 55-page deck yesterday on the massive savings of the haves in America. This sets us up for an extraordinary day here at Bloomberg News. Much more than finance and markets. David Weston leading our coverage tonight of the President of the United States, and before that, earnings with the close, and before that, I think there's a Fed show at 2 p.m. Stay with us.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
To tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season. President Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Today, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio. Days in office addresses a joint session of Congress. COVID, the economy, the plan forward. Today, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is What a day we've got lined up for you. From New York City for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now. 30 minutes away from the opening bell. Equity futures unchanged. We begin with the big issue. Investors preparing for Chair Powell.
What does the Fed do? The Fed is telegraphed a do-nothing policy for the time being.
They have boxed themselves in since their last meeting.
We're just being bombarded with economic information.
The data is not just better, it's better than expected.
The longer that they hold,
If the data not only surprises to the upside, but persists to surprise to the upside,
the harder it is going to be to move off that.
The Fed is going to get what it wants.
As we continue to see inflation heat up.
and the Fed is going to be more patient. Powell can sit tight for a while. That's part of the Fed's, mantra right now.
They're not going to change.
But the question is, can they continue to do that?
Their clock on inflation is going to start ticking.
The clock is ticking. Let's bring in the Bloomberg team. Michael McKee, Kelly Lyons. Morning, Mike.
Good morning, John. Yeah, it's you know how we always say it's not what they do, it's what they say. Well, today for Jay Powell, it's what you don't say. He doesn't want to upset the markets, but the eco data has been coming in stronger than expected. Just this morning, we got the advanced trade balance is a $90.6 billion deficit. That's the biggest ever. Imports come in up 6.8%. The dollar figure, the biggest ever. So the economy is really expanding quickly. Muscle memory might say you listen to those people in the markets, and when that happens, you start to raise interest rates because they are on guard, but they have a different plan now. You take a look at this chart here, and you can see on the left-hand side, that's what they used to do. Inflation going up, they'd raise rates. But right now, on the right-hand side, inflation's going up, and you can see how inflation expectations have just rocketed up recently. They're not raising rates. That's their bet. The bet is that financial conditions are even easier, and they can keep the economy going, because if you look at the next chart, you see that inflation, along with financial conditions, continue to decline. Now, this is the Goldman chart. This is the lowest financial conditions, loosest conditions ever. But look at where inflation is right down there with them. The Fed doesn't think it will diverge, or not quickly. And if it does, well, Jay Powell will say, we have the tools to deal with it. The problem with that is the tool is raising interest rates. And if you look at this one final chart here, you can see what happens. The Fed starts raising interest rates, and they go too far because, after all, it is a blunt instrument, and we get a recession. So the markets are going to be worried one way or the other about how the Fed reacts. And as inflation goes up, it's going to be a delicate dance all through the year. On Friday, rather, we get the PCE numbers for the month of March, expected to jump from 1.6% to 2.3%. How do the markets react to that? And what does Jay Powell say ahead of time?
For this meeting, Mike, it's going to be the least anticipated meeting of the Federal Reserve in about 12 months. Is that good news for this Fed?
Well, it is. If Powell can get away without saying anything that moves the markets, they're going to be happy because they don't have enough data at this point. They say they're waiting for the data.
Yeah.
They don't have it. And until they get it, they can't really give you a determination. But Mr. Market always wants a determination.
Always. Mike, good to catch up. What a day we've got ahead for you. The Fed chair in a news conference, a Fed decision later on, an address from the President of the United States. We've got to down through a $1.8 trillion spending plan for American families too. And on top of that, some Apple earnings after the close. Let's get a price action. Here's Kaylee.
Not a busy day at all, John. As you and Mike just said, we aren't expecting any major fireworks in terms of market reaction for the Federal Reserve decision today because we aren't expecting to hear a whole lot. That doesn't mean traders aren't going to be paying attention to any talking about tapering, anything they say on inflation. But long and short of the story is that they aren't expecting any changes really for some time. When you look at the way markets are pricing the Federal Reserve hiking rates, right now, a rate hike of 25 basis points isn't seen until the end of 2022, nearly 2 full hikes priced in by the end of 2023. Now, those bets had been pulled back earlier in this month, but they are starting to tick up again. As for the Treasury market, it has been a relatively sleepy couple of weeks with the 10-year yield hovering below 1.6%, but that has changed in the sessions leading up to this Fed meeting. The 10-year yield is up 10 basis points, 9 basis points now in the last 4 days. A 5 basis point move yesterday alone, and today we are higher once again to just under 1.63%, the highest level in about 3 weeks. And what this really all boils down to, John, is inflation expectations. We have seen a boom in commodity prices, everything from the ags to the industrial metals, and that is feeding into the inflationary narrative. With that, we've seen break-even rates picking back up pretty sharply. The 10-year break-even rate, which is how the market is gauging inflation expectations over the next year, is sitting at 2.42%. That is the highest since going back to 2013, and you can bet Jay Powell is going to have to try and dance his way around addressing that today, John.
Looking forward to that presser a little bit later. Full coverage, special programming here on Bloomberg. Kaylee, thank you. JP Morgan's Bob Michael saying the only thing markets want to hear is when the Fed plans to begin the tapering process. He writes the following: our expectation is that Jackson Hole in August will be the perfect time for tapering talk. Enough strong growth and inflation data will be evident over a number of months. But for now, he'll brush those questions aside. Bob joins us now for more. So, Bob, let's start here because I know it's where you're focused too. A 5-year chart of where this 2-year yield has been. And over the last 12 months, it's lost a heartbeat. I talked about that through this morning. What does it take to unanchor, de-anchor the front end of the yield curve? What's the catalyst for that, Bob?
Well, hi, John. I've heard you use the analogy of the Fed is effectively holding a beach ball under the surface. And that beach ball, one of the beach balls, is the 2-year Treasury yield. So as long as they taper and continue to buy 80 billion or so in short duration treasuries every month, they're going to keep the 2-year Treasury pretty close to the Fed funds rate. We've looked back over history. It doesn't always stay there. If you go back to 92 to 1994, after the S&L crisis, it got to 175 basis points away. There's a lot of room for the 2-year to rise. I don't know if it goes 175 basis points, but 50 to 100 basis points above the Fed funds rate once the Fed begins to taper and get out of that market.
Normalization is a word that gets used, Bob, a lot. And I'm uncomfortable with the word because I'm not sure what getting back to normal even means anymore for this Federal Reserve. Your timeline for so-called normalization, what informs that, Bob?
You know what normalization means to me? It means letting the market set the price for the cost of the U.S. Treasury and other businesses and households to fund themselves. And right now, we're not doing that. The Fed is doing it for us, and other central banks are doing it for us. So they need to find a graceful way to exit the market and let market dynamics take control. For us, it starts with tapering. It starts with your action hero, Super Michael McKee, at the press conference, boxing Jay Powell into a corner and asking him if the Jackson Hole August meeting is the right time for them to start the tapering conversation. They should start tapering by year end, do it gradually. They don't want to be too disruptive. And I think by 2023, begin to normalize rates. And I think over the next 5 years, we'll see a 3% Fed funds rate and a 4% Treasury. Now, there's a lot of policy response around that.
Yep.
We've got, proposals coming out of the administration for stimulus with tax reform as part of that. So that could change all of that. But to me, that's a normal, rational trajectory to get to something that looks reasonable.
Bob, let me repeat those numbers. 3% Fed funds at some point in this cycle, 4% 10-year yield. I wish you were on the program yesterday with Mike Collins of PGIM. Take a listen to what he had to say to me in yesterday's show.
We hit 175 on the 10-year, Jonathan. As you know, that is effectively pricing in, what I call the Fed's perfect world or dream scenario. Yields tend to peak when the rates of growth peak, and we're going through a peak growth rate right now.
Bob, let's pick up on that final line. Yields tend to peak when rates of growth peak, and we're going through a peak growth rate right now. Why is peak growth a useless concept as far as you're concerned for the trajectory of this 10-year yield?
Because it's an artificial growth rate. The government shut the economy down. It's reopening. Now there's a lot of stimulus in the pipeline. Things are reopening. We're talking about additional stimulus coming, perhaps another $4 trillion. That's a lot of growth coming down the road. I also go back to 2018. We almost got to a 3% Fed funds rate, and we almost got to a 4% Treasury, and that was in an era of austerity when the central bank go-to policy was to talk about fiscal restraint. This is all about fiscal stimulus, and this is all about MMT.
Bob, a conversation that you and I will continue. I'm looking forward to catching up with Priya Misra of TD as well. Bob Michael of JP Morgan there. Stay in close. He'll join us in a couple of minutes' time. Let's turn back to this market. Unchanged on the S&P 500 at the moment, but the earnings story over the last 24 hours has got to be Alphabet. For more, here's Abby.
The earnings story is very robust indeed, John. Beneath that calm surface or flat surface, big movers. And you were just mentioning Alphabet, parent of Google. Shares are set to open at a new record high. This after the company put up a blowout quarter, beating adjusted earnings by 17%. To put that into perspective, that is almost $21 per share just for the quarter. That's extraordinary. This on $45.6 billion. That was also a 7% beat. Their business boomed on the pandemic and now on a reopening blitz around marketing. In addition, they announced a $50 billion buyback, so really satisfying all of their investors. A new all-time high, most likely on the open for Alphabet. Turning to some other movers, though, to the downside, Microsoft, they put up a really strong quarter. They beat sales and earnings for the 9th quarter in a row, but with the stock up 50% over the last year, investors wanted more. Texas Instruments, they beat, but the second quarter sales outlook is only in line. Discovery, a big miss there. That stock really plunging on this. They're streaming and ad sales week. And then finally, Pinterest, they beat, but they're warning on slowing growth on U.S. reopening, which is obviously a positive for the economy. So it's interesting to see all these stocks that did so well a year ago as we went into the lockdown. Now we're seeing the reverse, John. That stock down sharply.
Payback for pull forward. We've seen that at Pinterest. Kelly Lyons mentioned it earlier. We saw it at Netflix last week as well. Alphabet. This is such an important story. We've spent the last 6 months thinking about a better economy and how to get the exposure to that better economy and how to leverage this cyclical upswing. We focused almost exclusively on the traditional cyclicals. You've looked at industrials, manufacturing names. What's intriguing about that in the last 24 hours, 3M, one of those classic names that you would look for cyclical exposure from, has focused on raw material costs, transportation, the stock traded lower. Alphabet, a big tech firm, has the cyclical story embedded in it without the concerns about raw materials and transportation costs. And the market gets it. We're up more than 30% year to date on Alphabet. And it's the perfect barbell. You know how many people come on this program and talk about the barbell? On the one side, the secular growth stories. On the other side, the cyclical story. That's what Alphabet's got. The cloud story on the one side. And on the other side, it's got this ad business. And that's why the stock is up again this morning by 4.6%. And Facebook is higher as well. More still to come on that ahead of the opening bell. And markets preparing for the big event on Capitol Hill. President Biden unveiling details of his historic spending plan. That conversation up next with JP Morgan's Bob Michael. Priya Misra of TD Securities joining us too. From New York City, 20 minutes away from the opening bell. Equity futures unchanged on the S&P 500. Julian Emanuel of BTIG calling this what could be the most important day of the year for financial markets for 2021. Do you agree with that? That's the Julian Emanuel view of the world this morning. This is Bloomberg. Julian Emanuel of BTIG.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy, and we need companies to step up.
Wednesday, the Fed decides. The Fed is on hold, waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
Valuations, particularly, sort of the technology landscape, gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty. Sort of the technology landscape, gotten to some extraordinary levels. So I think it's not a surprise.
I think it's a good thing that the administration put forward a plan to invest in America that is paid for. That's the responsible thing to do. And I believe that everyone should pay their fair share. Compared to what Republicans did when they had the presidency and the majorities in Congress, they passed a tax bill that vastly benefited the wealthiest Americans while leaving a huge hole in our budget.
Representative Stephanie Murphy supporting President Biden's outline for funding his American Families Plan. Republicans across the aisle pushing back on a number of proposals.
I'm really concerned about what President Biden is laying out, dramatic increases in the capital gains tax. You add the Medicare 3.8% surcharge, you add state taxes, it's going to put capital gains rates with state plus federal north of 50%. That's a big problem as it relates to global competitiveness and encouraging savings and investment. It's a radical move by the Biden administration, and I won't support it.
He won't support it. Many others won't either. Joining us now is Bloomberg's Emily Wilkins, joining us now from D.C. Emily, we'll hear from the president later in an address to Congress. That's a proposal. What's achievable?
What's achievable here might be far less than what the president is putting forward. We've already heard West Virginia Senator Joe Manchin, a really key moderate, one that everyone in D.C. keeps their eye on, come out and say that he wasn't super happy with the tax proposal the president has put forward. He thinks that the government might need to look instead at how much taxes they are getting from companies, making sure that companies are paying their fair share, that loopholes are closed, that necessarily raising these tax rates might not get the result that the government's looking for if these loopholes still exist for companies and wealthier individuals. Well, however, there is an urgency among Democrats to get something done. There is a willingness to get something done. It's going to be a little bit more difficult this time than what we saw on that $1.9 trillion COVID package because there is just so much more in this bill. But they've got some time to get it done. The kickoff speech is tonight for the second part of this plan for the tax proposal. Congress already has some ideas of what changes they'd like to make. Leaders already have an idea of where members in their caucus stand. And I think we're going to be seeing Biden's proposal get tweaked a little bit as lawmakers get their hands on it and it starts going through the legislative process in Congress.
Tweaked a little or maybe a lot. Emily, it's good to catch up. Emily Wilkins down in Washington, D.C. The events today just piling up. A news conference with the Federal Reserve Chairman Powell, a decision a little bit later. Then we have the address in front of Congress from the President of the United States. Throw some earnings into the mix too. Take a listen to what BTIG's Junior Manuel had to say.
Between hearing from the world's largest company by market cap, Fed Chair Powell, and President Biden, particularly in this environment where we're having such an intense debate about inflation and whether economic growth is really in the low sixes, as consensus states that it is, or really more like 8%. and whether the Fed will have to react to that. And of course, we're going to hear that we're going to have more spending and higher taxes tonight from President Biden.
And how do we process all of that? Priya Misra of TD Securities joins us now, alongside us still Bob Michael of JP Morgan. Priya, let's start there. The next fiscal steps are increasingly really, really difficult to process and price in this market. How do you approach it?
Hi, John. So yes, I think, we've heard, so some of these have been leaked, some of the proposals, but I think today is going to be important. I don't think the market's pricing in a $4 trillion. Just because it's too early, we still don't have all the details. All the Democrats are not on board. There's a bunch of issues around SALT, around why aren't we doing this through a bipartisan process. I think today kickstarts the process. Then we see how the negotiations go through. But I think the Democrats are serious. And when I think of the opposition from the Democrat side, I think there's plenty of negotiation there that can get them on board. So the market has to start to process impact on growth and inflation. And then all the tax offsets. What does that mean for Treasury supply? That's something that the rates market is spending a lot of time on. What's the impact on the deficit? So over the next few months, I think we'll have to start pricing it in. I think it's an unequivocal positive for growth and inflation. On the Treasury supply front, depending on the tax offsets, it may not mean a whole lot of Treasury supply, but we have enough to contend with in any case.
Well, at the moment, it just seems like the uncertainty around these plans has taken away the tailwind that we had behind higher Treasury yields going into the end of March. That's faded. The emphasis has shifted. They were the words of Mohammed Al-Arian on this program the last couple of weeks, Bob. The emphasis has shifted to redistribution away from pure fiscal deficit spending down in Washington. How do you get your hands around the next steps? And with Priya's question in mind, do you think we're taking it seriously enough? The threat of more spending in Washington. I call it a threat, so don't criticize the use of that word too much. The threat of spending for this bond market.
I think that's a really good question, John. And look, I'm a 40-year debt investor. I spend every day worrying about how this debt will be paid back and where the revenue will come from. And now we're talking, in addition to the $3 trillion from CARES and the stimulus bill, another $4 trillion from the infrastructure bill and the American Families Act. So that's a lot of spending. Priya's right. That's a lot of growth and inflationary pressure. That means the Fed is so far behind the curve. If a lot of this comes through, their catch-up has a long way to go. Maybe that first dot of 4.25% a decade ago doesn't look unreasonable. Then I start thinking about, what does that mean for the Treasury market? Well, it's going to take a while for the taxes to come through. They'll be collected over years, not months or quarters. So a lot of that's going to have to be funded with the Treasury market, which makes 1 5/8 or 1.6% look ridiculously low. It looks like yields at a minimum have to double or go higher once the Fed allows the market to set prices again.
Torsten Slok was on the show with us on Bloomberg Radio and TV a little bit earlier, Priya, and he was talking about the higher rates volatility that you don't see reflected in equities so much. And I just wonder whether this is part of that. The higher rates vol, just reflecting the uncertainty around fiscal spending and the uncertainty around inflation too.
So I think rates vol is compressed largely by the Fed. I mean, if the Fed, there's the QE part that's keeping real rates low, that's keeping the long end low. But there's also this front end, the FAIT framework, is keeping the front end pinned. If you don't allow the market to price in hikes over the next couple of years, it's very hard to see how the long end can get completely unanchored. So I actually think the Fed is deliberately keeping rates vol low, and that's allowing real rates to be low, that's allowing risk assets to do well, which is why today's meeting, I don't think we'll get that signal this meeting. But Chair Powell has said we're a long way away from that sustained further progress. When does that long way become we're getting there? We think it's closer to year end. So that's when that rates vol really starts to kick in. I don't think the Fed can communicate so well that there's absolutely no impact of tapering. I think we run the risk of another taper tantrum. That's when I think every risk asset will have to pay attention to rates vol.
Yeah.
I just don't think we're there yet right now. I think the Fed wants to be really patient.
Priya, laser focused on the language you just used, one single word, allow. Bob Michael, does it come down to the Fed allowing these things to happen?
I think it does, and Priya's right. To a large extent, the Treasury curve is tethered to the Fed funds rate. Even in our minds, you can't get the 10-year much above 2% with the Fed at zero, because then the break even dynamics of staying in cash look very poor. And of course, you get the flows that come in from overseas. Once they start to let go of the market with tapering and then telegraphing when they're going to raise rates, that's when you'll see where the market will price all this debt.
Bob Michael of JP Morgan, Priya Misra of TD. Guys, always good to catch up. Thank you. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, the big tech earnings parade marching on with Apple, Facebook reporting after the close. That conversation still ahead with Franklin Templeton, Stephen Dover, and Troy Gayeski of Skybridge Capital. 7 minutes away from the cash open in New York City. Equity futures up 2 points. We advance to 41.80. This is Bloomberg. Futures up 2 points. We advance to 41.80. This is We're about 5 minutes away from the opening bell this Wednesday morning. Good morning from New York City. Equity futures up 2. We advance on the S&P 500 just a little bit. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Citi upgrading Viacom CBS to a buy. 56 price target. The analyst expecting upcoming results to fuel a rally after shedding more than half its value in just 6 weeks. The second call from Cowen upgrading Ralph Lauren to an outperform. The analyst citing an underappreciated international business and improving digital trends. And finally, BMO upgrading UPS to market perform with a 195 price target. The analyst highlighting the company's productivity initiatives and better than expected quarterly results. That stock is down by about 1/3% after a big rally yesterday. Up next, the big tech earnings parade continues. Apple, Facebook after the close. That conversation still ahead with Franklin Templeton, Stephen Dover, and Troy Gayeski of Skybridge Capital. From New York, this is Bloomberg. Skybridge Capital. From New York, this is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
All of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
25 seconds away from the opening bell in New York City this morning. Good morning. Going into that cash open, equity futures, the price action there just a little bit muted. We're going nowhere on the S&P 500, up a little more than 2 points. On the Russell, we're negative about 0.2%. On the Nasdaq, down by about 1/10. Apple, Facebook, after the close. There's your opening bell this Wednesday. Switch up the board into the bond market, going into the Fed. Yields creeping higher in yesterday's session. Some soft auctions this week. Yields higher just a little bit today. We're through 160, 162.71, and off the highs of the session today. In the FX market, euro dollar negative 0.2%, 120.68. Crude higher, traveling north up by a little more than 1% to $63.74. That right there is your cross-asset price action this Wednesday with your movers at the market desk. Here's Abby.
John, we are looking at a tale of two stories for big tech, and of course I'm talking about Alphabet and Microsoft. Alphabet opening at an all-time high. Microsoft shy of that $2 trillion market cap. Alphabet, of course, put out a huge blowout quarter, beating sales and earnings, helped out by the cloud and ads, the pandemic spending, plus the reopening toward marketing, also a $50 billion buyback. Microsoft, on the other hand, beat for a ninth quarter in a row, top and bottom, but the stock up 50% over the last year. Investors wanted more. As for some of the chips that reported, AMD, this stock is sharply higher. They put up another big beat. Their second quarter sales forecast also beat. Teradyne, which offers testing equipment for chips, soaring up 6%. They beat. They offered a strong outlook, so strong, in fact, Stifel is calling it a quote-unquote showstopper. To the downside, though, Maxim Integrated down 1%. They beat. However, they have suspended guidance, something that no investor wants to hear, so there won't be a call there. Texas Instruments, a strong quarter, but the second quarter sales forecast, unlike AMD, their competitor, just in line. And then finally, just to make it a little bit more macro relative to the reflation trade, it is in order, John, because of course we have yields up for a second day in a row. That's helping out the banks, that yield curve steepening, and oil up for a second day in a row as well. So big oil and smaller oil higher, green on the screen for some of those reflationary sectors.
Those sectors have ripped year to date in 2021. Thank you, Abby. Thank you very much. 41.91 on the S&P 500. A marginal move higher on the session, up by about 4 points. Your intraday all-time high, 41.94. Right now, we're just short of that. We printed that, of course, on April 26th. Just below that all-time high at the moment on the S&P 500. We've talked a lot about the cyclicals. We need to talk about the cyclicals within big tech. Alphabet just blowing it out of the water in yesterday's session after the close, of course. Microsoft have been leading some of the gains recently, too. Let's get some of the price action over the last year with Bloomberg's Kelly Lyons. Kaylee.
Well, John, the bar for some of these big tech companies has been extremely high because they have seen their business booming over the course of the pandemic, and their shares have been bid up accordingly. But what that means is that a lot of good news has already been priced in. When you look at the S&P 500 information technology sector as a whole, it trades at a forward PE multiple of about 27. For Microsoft, which you were just mentioning, it trades at a premium of 33 times forward earnings. That's why you aren't seeing the reward in the shares for a solid earnings report after the bell. Good just isn't good enough when so much has been priced in. You kind of have to leave expectations entirely in the dust, like Alphabet did. Now, of course, over the course of earnings season thus far, the information technology sector is up about 1.6%. That's basically in the middle of the pack on a sector basis, in line with the broader market in terms of headline performance over the last 2 weeks or so. But for the companies housed within the tech index who have reported results already, the average share price reaction the day after reporting is 0.25% to the downside. Of course, earnings season is not over yet. We have more mega caps due after the bell today. Apple and Facebook, they, along with the other mega caps we've already gotten, make up a large chunk of the $18.6 trillion in market cap reporting over the course of this week. For Facebook, I'm watching two things. One, ad growth? Are they going to benefit from a digital advertising boom in the way we saw with Alphabet? And then also user growth. Are they going to have seen the pulling forward of growth like we saw play out with Pinterest overnight? Then for Apple, Macs, iPhone sales, that's going to be important. Any commentary around the semiconductor shortage could be as well. But again, John, it comes back to the question of will any kind of beat be rewarded given the valuation that stock enjoys, John?
It's a good point, Kelly, thank you. Certainly rewarded over at Alphabet. Listen to this line from Microsoft and Satya Nadella. I repeated this a little bit earlier this morning. I'll do it again for you. Over a year into the pandemic, digital adoption curves aren't slowing down, they're accelerating, and it's just the beginning. That's the line from one of the biggest companies on the planet. It's just the beginning. The secular growth stories, the cloud business over at Alphabet doing nicely. I think a lot of people looking for more of the same maybe from Amazon tomorrow too. Franklin Templeton, Stephen Dover joins us now. Troy Gayeski of Skybridge Capital with us too. Stephen, I want to start with here with the cyclical plays. Spent a lot of time talking about energy, the financials. To see the cyclical story embedded in a stock like Alphabet performing so well, just a reminder of these big tech plays and how they're hard to ignore, Stephen. Spent a lot of time talking about energy, the financials. To see the cyclical story embedded in the stock.
I think that, I mean, what a week and what a day with so many different announcements. We're still very positive on the cyclicals. Today we're talking about all these amazing earnings with the technology stocks, but you do make the point that it looks like cyclical stocks are still having a lot of opportunity. But I think the difference with cyclicals is this first quarter isn't really indicative of what we need to see. We need to see forward guidance, and we need to see how they're going to do through the rest of the year and forward.
Some of the concepts, pent-up demand versus payback, you saw that in Pinterest. Katie Lyons talked about that earlier on. We saw that in Netflix last week too. Then there's other secular growth stories that accelerated last year, Troy, that are still accelerating. You see that in the software story. You see it in the cloud business. It just seems to me that things are getting a little bit more nuanced, Troy, as the year progresses, that it's not some big blanket macro trade as it was maybe in the last 3-6 months.
Oh, yeah, certainly. There's going to be more differentiation and dispersion going forward than there has been in the past. And, you know, if you think about dispersion last year, it was mainly big cap tech and growth stories from really the pandemic bottoms in November. And then from there, you know, it's cyclicals and value outperformance, right? But, you know, I think you hit on a very key point for investors to focus on is that where you can find secular growth stories that also have cyclical upside, combined with attractive valuations, that's really where the hedge fund industry is most focused. So whether it's large cap names, you know, like Facebook or Amazon or Google, or if it's more smaller tech names, 125 billion market cap for Applied Materials, for instance, which is a cyclical and secular growth story. That's where the hedge fund industry is focused, as well as, you know, certain big growth opportunities in healthcare, particularly in biotech for cancer therapeutics.
Troy, you went through the bullet points of what you'd be looking for, and then I stopped and thought, at acceptable valuations. Troy, that's the tough part of this piece, isn't it? I can think of the companies, Alphabet being one, the Walt Disney Company being another. They've got that barbell embedded in the stock, the reopening play. They've also got the streaming content too. Then we get onto valuations. How useful are valuations right now, Troy?
Well, they're more useful now, given that, you know, money supply growth is still moving at a breakneck pace, but certainly not the frenetic pace of, you know, 120% annualized Q2 of last year. We're down to about a 16-18% annualized growth rate. So that's the trick, right? Is not overpaying. You know, finding areas where, you know, you're paying a reasonable valuation. You can't find anything cheap, right? I mean, like, just to argue that banks are cheap or energy is cheap is ridiculous, right? But if you can find things at 18 times, 22 times, 24 times forward earnings that have very good free cash flows, which is another metric that hedge funds are very focused on, you know, relative to history, which is encouraging for the broader market. That's where we think we'll see more of an alpha proposition. And then again, in terms of big growth, you know, the market really hasn't been paying as much attention to biotech the past 3 months. Had a very strong, you know, close to last year, and then became an orphaned out of favor sector. But that's where, you know, you have 20-30 years of work coming together for advanced cancer therapeutics. In particular, not exclusively, there's obviously orphan diseases as well, where you can have the double, triple potential, which obviously you're not going to get in any mega cap stock right now.
Stephen, I was just going through your note, and it just seems to me that you've become a little bit less bullish recently. Is that a fair characterization, and can you tell me why?
let me give some nuance to that. If we
Please.
look, you're talking about valuations, and if we look at valuations since last June, the valuations have basically been flat. All of the progress in the market has come from earnings growth, and that's what we're looking at going forward. And especially with the cyclicals, they have to come through for the rest of the year and actually come through with earnings. And what typically happens is that the multiples, as we get into the growth, the multiples start to fall. So we're just pulling back some of the gains that we've had. We've been very bullish for this last year. So in your portfolio, you have your allocation, then you have that amount that's come from the gains. And we think some of that should be pulled back. So just to be clear, still very positive on the market as a whole, but there's not as much upside as we saw over the course of this past year. And so now we'd be looking at a little bit of a pullback.
Stephen, just in terms of the conversation around price pressure, how is that shaping your outlook as you look at markets at the moment? Just to cherry pick one data point, 3M yesterday. We weren't talking about the big cyclical upswing with that stock and how they'd leverage it. We were talking about transportation costs, raw material costs. Seems to me that the emphasis has shifted here away from just the cyclical upswing and towards maybe margin pressure. How are you processing that, Stephen?
We are really trying to think that through, and that's a great debate inside the firm. One, in terms of inflation, but when you look at commodity prices, to what extent that's just kind of passing through because of lack of supply we've had over the course of the last year, or to what extent that's going to be more permanent. At this point, we think it's passing through. We think supply will catch up, but that's an open question and something we really have to keep an eye on.
Stephen, it's good to catch up and good to hear from you. Just to get some insight to the conversation you and the team are having at Franklin Templeton. Stephen's over there. Troy Gajewski will be sticking with us. Let's head back to the market desk and get some movers at the market desk with Abby.
Well, John, we've been talking all about tech and earnings this morning, but another big factor is just what all of you were talking about, of course, these rising input costs. So let's take a look at one of the top sectors on the day, and that is, of course, the energy sector. We have some of those energy movers sharply higher: Devon Energy, Marathon Oil, Occidental Petroleum, E&P. This, as oil, one of the most important input costs, continues to rise sharply above $60 a barrel. Taking a look at some of the other companies, the materials companies such as Freeport-McMoRan, U.S. Steel, Nucor, and 3M, a bit of a mixed picture. So we finally have Freeport-McMoRan, the copper mining company, down just a little bit. U.S. Steel as well. Nucor, on the other hand, another steel company, is higher. And then 3M, which you've been talking about, those rising input costs yesterday, down because of that. Today, bouncing back just a little bit. It's going to be interesting to see how this debate does play out, whether or not it can be absorbed. But one thing there's no doubt about, if we take a look at commodities on the year, absolutely soaring. Copper up 27%, corn up 34%, and there it is, lumber up 79% on the year. Incredible.
What a rally. Abby, thank you. Much more from Abigail Doolittle. Through the open, about 11 minutes into the session, equities doing okay. A little bit later, the sector price action with Abby. Up next, Bitcoin absolutely ripping. And Troy Gajewski of Skybridge Capital taking a big position and allowing it to grow into a decent slice of his broader portfolio. We talk about why next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. they had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. Only from Bloomberg. Start exploring to see what's moving the markets.
There's always the chance that there's sort of volatility, but as a reminder, I mean, Bitcoin is the best performing asset class of the last 10 years, and so we remain bullish that this is a great, compelling product for users.
Bitcoin surging 80% this year alone. Violent price swings doing little to sway interest, with Wall Street now moving to advance crypto offerings for clients. JP Morgan becoming the latest to highlight the rally, writing the following: Bitcoin descent has been steeper than any other financial innovation or asset bubble of the past 50 years. I want to bring in Bloomberg's Kaylee Lyons for more. Hey, Kaylee.
Hey, John. Well, it is 2021, therefore we cannot go a day without talking about cryptocurrencies. Usually it is Bitcoin that gets all the headlines, especially with the kind of volatility we saw last week. But now Ether is starting to come back into the limelight on the rebound. Ether hit a record high of $2,717 earlier today. We're off those levels now, but that was after the European Investment Bank sold 100 million euros of digital bonds on the Ethereum blockchain network. Just the latest example of the kind of institutional embrace that has inspired the rally we've seen this year. And John, just to put that rally in context, Ether has surged more than 1,200% over the last 12 months. That dwarfs the move in Bitcoin. It's only up 610%. I say only, but again, it looks unimpressive in comparison. And with the boom in the price of Ether this year, its market cap is now above $300 billion. Still has a long way to go to catch up to Bitcoin, which is worth more than $1 trillion. But John, even Dogecoin, which was originally started as a joke, enjoys a market cap of $40 billion. That is the reality of this moment in time. And if you look at the returns on cryptocurrencies themselves, yeah, they've been juicy, but it is nothing compared to the upside you would have gotten if you invested in crypto-tied equities over the last year. Galaxy Digital Holdings up nearly 3,000%, Marathon Digital by 7,600%, and John, Humble, which is a data transactions company that uses blockchain, is up 323,000%. I'm just going to leave it there because I think that number speaks for itself, John.
Unreal, it does. Katie, thank you. Troy Gayeski saying it's highly unlikely that Bitcoin has seen its top. He writes the following: Bitcoin is still the best macro trade. Don't sweat the volatility. Troy's back with us for more. Troy, we've had an ongoing conversation about this over the last couple of weeks. Just build on that. Don't sweat the volatility. Why?
Well, look, I mean, the reality of cryptocurrencies and even Bitcoin, which is by far and away the largest and deepest, is that if you make an investment today or you make an investment in early December like we did, you have to expect multiple 20 to 30% pullbacks in the bull market phase. And you also have to realize that perhaps all your analysis is incorrect and you don't have nearly as much upside this cycle as you did the previous two. But that being said, I mean, the combination of still extraordinary money supply growth, we still think we're in the early innings of the adoption cycle. As you mentioned JP Morgan and Morgan Stanley and Japanese gaming companies getting involved, and we're still, this bull market is still younger than the last two in terms of length. And we could see many rational reasons why there's less upside this time around, and it's a longer bull market. But it's really hard to argue that it's going to be a shorter bull market. There's really no fact or basis for that, in our opinion.
Troy, how do you make the decision how much of the portfolio should be dedicated to it, and your tolerance levels around how much you allow it to grow into the overall portfolio? How are you making those decisions? What process do you go through?
That's a great question, John. And so, look, initially, it's based on how much at cost you're willing to risk. Like any investment, right? We view it as any other theme. If you're wrong on the thesis, if you have some type of exogenous shock, how much are you willing to risk? And for us, we had roughly a 5.5% at cost position at a weighted average price of about 18,500. And then as it grows, for good reason, right, due to outperformance, you have to manage it relative to other exposures in your portfolio. And this is very important. You have to look at what your mandate is. And remember, our mandate is to generate the best absolute and risk-adjusted returns with as low a beta and correlation as possible to other assets. And so what we've seen is, with the addition of Bitcoin, our beta was already low. It's gone down even further, even though our mark-to-market volatility, which we think will be more in the 8 to 12% range versus 4 to 8% range, has gone up. So it's an interesting dynamic, right? You're increasing expected return, you're increasing mark-to-market volatility, but you're also simultaneously marginally decreasing your beta and correlation to other assets. And so if that's your mandate, you're continuing looking at that relative to other opportunities in the portfolio. And right now, again, when we look at other asset classes that are liquid, that we think have significant upside, we just don't see anything that could potentially double by the end of the year. Now, that's not to say individual stocks or late-stage privates can as well. But this is the liquid market, right? You can evolve the position, you can trim it. We've made the decision not to add to it further, even in pullbacks. But liquidity is a very important aspect of this as well.
Troy, I'm very interested in the investor conditioning that we're going through right now with this asset class. And I just wonder what we'll think it's most useful for in the years to come as we go through that conditioning. And I think a great example is the Japanese yen. Anyone that comes into financial markets is often asked, why is the yen a safe haven? And you can sit there and talk about how it's used as a funding currency. You can talk about Japan's maybe net foreign asset position as well, how that's positive. But Troy, when it comes down to it, it's because it works. That's ultimately why you consider the Japanese yen a safe haven, because it works. And I just wonder how Bitcoin will be used in the broader portfolio as an asset class in the years to come as we go through that conditioning.
Yeah, look, and that's where the parallels to gold are so important, at least from our perspective, in that, gold was a completely orphaned, under-owned assets for years, really since the early to mid-'80s through the late '90s. And then it went through an adoption cycle, and whether it's hedge funds or asset allocators decided, hey, you want 0, you want 1, you want 2, you want 3%. We'd expect, again, as this marketplace matures, that Bitcoin will be the store of value winners, right? We don't ascribe much value from a transaction standpoint. We hope we're wrong. There are many smart people that think that's tremendous transaction value use. But we think it's going to be the dominant store of value, the digital gold. And then Ethereum and digital fiat currencies will be used more for actual transactions. That's how we see it shaken out. And so the question as an allocator, right, is right now, if you're concerned about currency debasement, if you're concerned about the potential for more meaningful inflation, you obviously see asset inflation before your eyes and everything. You mentioned copper and wheat and lumber. My goodness, if you're concerned about that at all, you don't have that many liquid choices. One would obviously be gold. Two would be Bitcoin, and the marginal flow dollar is clearly going into crypto because gold already had its adoption cycle. That being said, we are surprised gold is off from its August high. I wouldn't have suspected that. Why sell gold to buy Bitcoin when you can there's so much cash out there? But that's been the price action, of course, the last 4 months.
I'm trying to keep an open mind on a topic. because it's become very tribal and quite aggressive on either side of the trade, as you know, Troy. It's good to catch up and get some clarity in your perspective too. You know I respect it. Troy Gajewski there of Skybridge. But a sector price action, just briefly. Here's Abby.
John, well, the S&P 500 is less than a point away from an all-time high, so the bulls are out, really being led by communication services. That's all about Alphabet. So it's a battle between communication services and Alphabet on top, and then tech on bottom being weighed on by Microsoft. You also encouragingly have two of the reflationary sectors higher, energy and financials. Overall, a bullish day. Let's see whether or not we get that all-time high. Again, less than a point away.
Abby, thank you. Up next, your market moving events. What a day we've got coming up for you. From New York, this is Bloomberg.
Let's see whether or not we get that all-time high. Again, less than...
Abby, thank you. Up next, your market moving events. What a day we've got coming up for you. From New York, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America. Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts.
25 minutes into the session in New York City, your equity market looks like this, up 7 points on the S&P. We advance 0.2%, very close to intraday record highs on the S&P 500. Here's the trading diary. The market moving events through the next couple of days. 2 p.m. Eastern, Chairman Powell with a decision and news conference a little bit later. Facebook and Apple reporting after the closing bell. President Biden addressing Congress this evening, 9 p.m. Eastern time. Then first quarter GDP tomorrow morning, and rounding out the week with US core PCE this coming Friday. Is that enough for the diary in the next couple of days? What a busy end to the week. From New York City, this was the countdown to the open. Continue the conversation on Twitter at Ferro TV. For our audience worldwide, this is Bloomberg.
right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Months after Hurricane Maria, experts estimate that it will take years before these services are restored island-wide. Huge swaths of the island are still without power. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest-hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents.
I'm working on the devastated side.
Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. Dr. Sally Priester is a physician, but it didn't account for obstacles like this. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
One of the risks that you run is people going from Ghost in the Machine. Those are the folks that we're trying to reach. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage
So we're state of Puerto Rico, right here.
and delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City. You can see San Juan from here.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on.
On this stop, we caught word that a man living alone.
One of the challenges is to find those people that are at the end of these roads that need help. We decided to take a little detour, come up here and check out and see what's going on.
Pero ¿por qué estás solo? I'm asking about why he's alone right here. He said things of life happens. Well, I'm here by myself.
So ¿dónde vive acá? En la parte de...
I'm asking about why he's alone right here. He said things of life happens. I'm here by myself. This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you can affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other. There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue, and it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based. Technology was only the first level help that we could get to find each other. Everything else was like
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949, in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980,